tend to be less reliable because you just don't have as much liquidity in the market. So if somebody's buying gold today, or that doesn't necessarily translate. I'm buying gold, so therefore I'm selling the dollar. You don't get those correlations as tight when there's not as much liquidity. But I do look at correlations. I look at the cross rate effect, meaning that if the euro dollar is doing something specific on a major cross, that's going to influence how I look at the rest of the euro crosses as well. So I can say, well, the euro dollar is really, really selling off today. So therefore, if I'm trading a euro cross, meaning like the euro New Zealand currency or the euro Canadian currency, I might be looking more as a short side trade in that because of the cross rate effect. So there are several different things that I might look for as a currency trader, but typically they're all the same things. It's kind of boring, but people always think that trading is some glamorous thing, but it's really quite a boring process that I follow every day.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
Okay, so I asked this question to Nicola Duke, who I know is a good friend of yours, when she was on the podcast about Fibonacci's. So why do you think Fibonacci's work? Like, why is that something, why do you think that's something useful to watch for, especially the 61.8?
Well, Fibonacci is such an interesting concept. First of all, Fibonacci's really go back to the mathematicians and how we have come to the conclusion that almost everything natural has some sort of Fibonacci ratio attached to it, whether you're talking about the distance from your forearm to your wrist, to the distance to your wrist to your pinky finger, the distance between your pinky finger to your pointer finger, on a horizontal basis, to a leaf in nature, or pretty much everything. Everything has like a Fibonacci equation and a number that really correlates. And what's interesting is that it can be translated into human emotion. That's why when everybody looks at a move and they say, okay, that was a strong move in the market, and now we're getting a pullback, a 50% pullback, automatically relates to somebody in their head subconsciously that was now it's half off. It was so much more expensive, but now it's half price. If it's a 618, it's like a natural emotional response area for people. And so if you know that about traders and about people in general, the herd mentality can really be used to your benefit. And knowing those Fibonacci ratios really is where the herd mentality is meeting. So why it becomes so important and so valuable, in my opinion, is when you can match up different Fibonacci's based on different viewpoints of the market. So I might be looking at the euro dollar, saying, okay, well, there's this big move from 110 to 115, and it's pulled back to where we're at today at 111.50. Oh, great. That's pulled back about a 618 or maybe 62% retracement. But then I can look at it from somebody who's on the short side, saying, okay, I was short from here to here, from 114 to 113, and it's extended itself 161% extension, and it's now gone so far where I've almost have to take profits at this point, where I can get different Fibonacci ratios, whether it's a pullback or an extension. If I can get them to line up at a certain point, the more what we call confluence or clustering, the more Fibonacci's I can get to line up at a certain point, the more I can argue that we're going to have a turning point, whether it's a bounce or it's a pullback from that specific area. And it's something that, I've always found very fascinating, but I think it has more to do with the human emotion component behind the market than anything. And as a trader, I try to capitalize on that. I always think about this one simple concept when I trade the markets. When people are buying, I want to be the one selling it to them. When people are selling, I want to be the one buying it. So that's why when there's a pullback in the market, and we just had a strong move higher or lower in the dollar, if it's pulling back, people are selling it, they're just trying to get out, they're rushing out the doors, I'm looking at a strategic place to be a buyer. And when people are rushing in to buy the dollar or sell the dollar, they're just rushing in to get in, I'm usually I want to be the person selling it to them. And so keeping that in mind, that always keeps me thinking one step ahead of everybody else. And using Fibonacci's helps me strategically find those technical points on the chart that I think are going to be those turning points where, it switches from being, all the buyers coming in to the sellers coming in, or vice versa.
Okay. So you're pretty much using it as something like a read on the market psychology, I guess.
Yeah, absolutely. Yeah. And trading is all about, I know that's drawn a lot of computer algorithmic type of trading that are trying to beat the humans, so to speak, in the markets. But really, it all comes back down to human emotions and what's driving it, and understanding what's driving those emotions, and at what tipping points that people get. They get too antsy where they have to sell, or they feel like they need to rush in and buy. Kind of understanding what other people's positions are in the market and where they're coming from has really helped me a lot. It's kind of like, I'm sure you've heard this before, interviewing so many traders over the years, Aaron. Trading is like playing chess, but when I play chess, I'm playing against a lot of very advanced people in the markets, and they might be trying to think 3 or 4 steps ahead. I'm trying to think 4 or 5 steps ahead of everybody else. So that's where a lot of these fibs come into place, because I can look at the market and say, well, if they were buying up here at 114 and here we are at 111, at what point do they get nervous? And at what point do they need to feel like, I need to get out here? This is my do or die. Well, as they start to exit the market, that's where I start thinking, okay, well, as they're exiting, those masses are exiting, I want to start looking to be a buyer. And so I always try to take an approach that way. And then, there's a lot that goes into it, obviously, but at that point, just saying, okay, if I want to be a buyer here, where's my risk, and at what point do I need to get out and say I'm wrong? Because I will be wrong, and I am wrong quite a bit, just like every trader out there. But being able to manage your risk is also an equally important part of trading.
Undoubtedly. So earlier you referenced the 618 Fibonacci, yes. and you talked about how you'd like to see a retracement to that level when looking for an opportunity to buy a pullback. How much variance do you give that level? Like, I presume that you're not expecting that the price is going to pull up right on the cent or at that very level. Like, how much variance do you give that level to say whether it's held or not?
That's a great question. Levels are levels. Whether you're using a support level or a Fibonacci or some sort of horizontal resistance or whatever, or channel support resistance, anything technical, I have to look at it as a zone, a zone, and I have to keep it in the context of what chart I'm looking at too. I do consider myself a fairly active day trader, but I also like to swing trade the markets, and I tend to take a lot of positions that I might be in for a day or two, depending on the environment. Like this week, I tend to be a little bit more active just because the market's not giving me, opportunities to sit in the market for several days at a time. So, but the reason why I needed to make this point is because it depends what chart you're looking at, and you have to realize that every level, whether it's a fib level or a resistance or whatever it is that you're looking at technically, levels are meant to be broken and they're meant to be probed above and below. So you very rarely stop right on a fib, and that's why I always say that technical analysis is not, you don't look for perfection. There's a lot of imperfections and there's a lot of, error for judgment. You have to gauge for that. So if there's like a 618 retracement and it's like, let's say we've seen a multi-week run higher in the euro and it's about ready to come down, or it's been coming down. Well, if I see the 618 it being at, let's just say 111, I would expect that there would be a move below 111, maybe to 110.80, maybe 110.70. But I want to see how the price reacts around that Fibonacci. How buoyant are we? And so that's when you start looking at, what chart are you actually referencing? If I'm a day trader, I might be looking at an hourly chart. I'll be looking for how do those hourly candles respond around that level. If I'm going to take more of a swing or position approach to the market, I start to look at the daily candle. Okay, are we going to close above or below it? And Japanese candlesticks have proved to me to be such a valuable tool in the markets, because that a Japanese candlestick and how you read that candlestick is how you read price action, especially for the day. Those daily candles are so important because it can tell you who got caught holding the bag today, in the markets, whether you're trading, an individual stock or you're trading currencies or any instrument for that matter. Those candlesticks can tell you, hey, there were buyers early on in the day. Somebody got caught, buying early in the day, and by the end of the day, we closed at our lows. Those people that bought at the highs are probably going to be really nervous and selling tomorrow. So understanding the anatomy of a candlestick is equally important. So if you factor that in with some of the fib levels that you're dealing with, it can become a very powerful way of trading, especially when you're trying to time your entries to get in or out of the markets.
Okay, so you talked about the what was it? The close of a candle and sort of the open the following day.
Yeah.
Are they still as important as they might be in like equity markets? Because in FX you're trading pretty much around the clock for what is it, like 6 days a week? Is the open and close, is it still as important?
It is. It really is. I find it extremely valuable. You'll notice that most brokers that you use, whether I know you're in Brisbane, and that's correct, right?
Yes.
You're okay, and you're in Brisbane, and I know Australian traders that have their charts queued into their brokers closing at a New York close. So that means your daily candle is probably closing at a 5 p.m., which was just 45 minutes ago. They would have that daily candle close no matter what part of the world they're in. European traders the same way. And the reason why so many brokers in the FX will use a North American close, because it's the very end of the day for the world. So if you talk about where you live in Australia, whether you're talking Australia or New Zealand, you guys really kick off the next calendar day. So North American traders really have the closing price, and it's really important. And I've had so many European traders say, "Well, my close, my candle looks a little different," and their brokers are closing at the London fix, let's say. And I always tell them, hey, try to find a broker that actually gives you a daily closing price, or can close has the option to close the candle at the New York close, because that really, I think, is the most important if you're dealing with a 24-hour market.
Yeah, I could see how that could get confusing, especially for newer traders. Now, just backing up a little bit, you started out your career as an equities trader, and then later on, I think it was around 2002, 2003, you transitioned to trading Forex, and you've been trading Forex ever since. I mean, was there anything that was particularly difficult to get used to when you were coming over to trading currencies, and what was the appeal for actually doing so as well?
That's a great question, and I'll tell you, Aaron, the hardest part for me to understand at that point was, oh my God, the markets are open 24 hours a day, and realizing that I couldn't. For so many years, I used to just say, okay, the market's closed, and and even back when I first started trading, there weren't pre-market and post-market trading. The market was closed; it was closed. It's like, okay, the day's over, and then they started doing pre and post-market trading. But that really just kind of kept you in the market with very illiquid situations for a couple hours at a time, like it is now. But when there was a 24-hour market, it took a little bit of time to understand that. Wow, okay, it may be the evening here in the United States, but, things are rocking and rolling over in Sydney and in Hong Kong. And it took me a little bit of time to understand that we look for major overlaps in the market. So, when the Asian, I would say, the Pacific area where you're at, when the Asian markets overlap with the European markets, you get this massive amount of volatility, and then also when the European markets and the North American markets cross over, you get a massive amount of volatility, and then you kind of get a dead time. The liquidity kind of tapers off as European stocks close, and kind of understanding that part of it was definitely a learning curve, and I think if I had kids at the time, like I was just starting that chapter of my life where my wife got pregnant maybe a year or two later. If I would have had kids at the time, it would have been a little bit more challenging, not knowing, and not knowing, because I found myself up at 9, 10, 11 o'clock at night, monitoring my positions where I hadn't done that before, getting up a lot earlier than before, just to be around during the European hours. So that was like one of the big, I think one of the big challenges for me. But it was also a lot of fun, and it seemed like to me it provided so much more opportunity. And I'm somebody who's always been very passionate about the markets. I love trading the markets. I think I'm in front of my computer probably a good 15 hours a day. And even if I'm not in front of my computer, I'm running around with, my phone watching quotes. So I'm pretty much got a beat on the market as long as I'm awake. And so it provided, in my opinion, a lot of opportunities too, and ways to take advantage of the markets that I hadn't seen before in the past.
Okay, so you brought up an interesting point there, and it's actually something I wanted to ask you about. Your actual main trading hours. So you said you're pretty much in tune with the markets for about 15 hours a day. What are your main trading sessions like? Within those 15 hours, are there like a few hours where you're most active?
Yes, there are, and one of the drawbacks to living on, I'm on West Coast hours. I don't actually live on the West Coast of the United States, but I trade during West Coast hours 7 months out of the year. One of the drawbacks to that is I do get up extremely early. Because that's when the European markets are opening, and you've got most of the traders in New York or Toronto, that are really sitting down and getting in front of their computers. So, I get up extremely early, and my day's pretty busy until the European markets close. Once the European markets close, the liquidity tends to pare back a little bit. So my busiest time is like I explained to you, when you have those overlaps, when the European markets are open and the North American markets are open, and you get that New York Stock Exchange open, if you will. That is a very busy time of the market. That's and it's early in the morning for me, but I guess I'm an early morning guy, and I've always have been. So it kind of fits to my schedule.
Okay, so for like a newer trader who might be listening to this right now, as someone who's just starting out in trading, especially Forex, Do you think it's a good idea for them to be tuned into the market for, let's say, 15 hours a day, or like not necessarily like sit in front of their computer glued to the screen for those 15 hours, but maybe checking their phone, checking quotes, seeing what price is at? Is that something that is beneficial, or is that almost unhealthy, or like too much noise for someone who's just starting out? Like, is it good to have like a time where they're engaged with the market, and then at other times when they're completely switched off from it?
Yeah. I think the reason why, and I don't want to scare anybody who's new, the reason why I spend so much time in front of the computer is more of a product of my what I do. I'm a full-time trader. I also I have a company called Forex Analytics, where I have a team with Nicola Duke. Obviously, she's we analyze the markets. We put out analysis for traders throughout the course of the day. So I kind of, it's been my job, and with being the chief currency strategist of WiseTrade, that I kind of have to sit in front of the computers all day, and it's what I do. But for somebody who's a new trader, I really don't think it's so important. But it also depends what you're trying to do. And the great thing, whether you're trading currencies or whether you're trading the markets in general, I think you can approach the markets different ways. You can say, well, all right, well, I just want to be an active trader. I want to kind of get in and out, over the course of a couple hours, and then, be out of every position and be done for the day. Well, then you look for those great overlapping times, whether it's where the Asian, so it'd be like midday for you, like the Asian markets and the European markets where they cross over. That's an active time to be in the markets. You could really, be in there to, take advantage of some quick opportunities, be in and out, and be done for the day. The flip side to that is if you work a full-time job and you're like, okay, well, I'm just trying to tackle the markets more, just try to make some extra income, then you probably are taking a more of a longer-term approach to the market, or a position type of approach. You're going to use some more of a macro backdrop behind what you're doing. I'm buying the dollar because the Federal Reserve is actively raising interest rates. Great. Okay, I'm only looking to buy the dollar. So then you're looking for those opportunities every few days where the dollar has pulled back, and you're looking to take advantage for a day or two as it pulled back, and then you can buy the dollar on the cheap and then spin out of it a day or two later. And if that's the type of approach that you're taking, I really don't think you need to spend that much time in front of the computer looking at all the different screens. What I do like, though, Aaron, and one of the things that I've learned as being a trader is I've always got some sort of position on, no matter how small it is. I've always got, even like this time of the market where I know the liquidity is kind of poor. I've got positions in the market that I keep open based on whatever reasoning I've got to buy or sell the currency. But I do it because it forces me to always be looking at quotes, because if I'm looking at quotes, I'm always keeping a beat on the market. The markets are not like a bike, and I've found this to be so true over the years of trading. It's not like a bike where you can just, I haven't ridden a bike in 5 years and I pick up a bike and just ride. In the markets, it takes some time to get your head re-engaged back into the game. So by having a position in the market, I call it a marker. I have a position in the market. I may not be making a whole lot of money. I may not be losing a whole lot of money. But what I'm doing is I'm forcing myself to keep an eye on prices. So this way, I'm always keeping an eye on price action, and it keeps me aware of, oh, hey, the euro was just trading at 115 the other day, and now it is at 113. But we've had a real big, pullback just over the course of the last couple of days. Why is that? And then it forces me to find out the reasons why that pullback has occurred, and therefore I'm always engaged in the market. It's kind of like I'm riding a bike, and I'm still on it. I haven't hopped off it. I'm still kind of on it, even though I might not be, riding too quickly or being too overly aggressive with my bike riding, if that makes any sense.
It does make sense, and it's quite interesting. It's So what if you don't have? If there's nothing that's really like standing out to you as being a good opportunity to get into the market, you still just put a very small position on regardless? Am I understanding that right?
I always find something to do. There's always something happening. In my opinion, there's always, especially in the currency market, there's always an overarching theme that's driving the market. So whether it's you know, I'm extremely bearish to the Kiwi, so I'm going to have some sort of Kiwi short exposure going at all times, or I think the dollar is extremely bearish, so I want to keep some, you know, dollar shorts going at all times, and then I'm extremely bullish the yen right now, so I might have a small short dollar yen just to it helps me keep an eye on the market. I tend to have something running almost all the time, but that's my own personal strategy. I don't necessarily think it's right for everybody, but it's something that I do because, like I said, it forces me to stay engaged in the markets.
Okay, sure. So talk to us about those overarching themes, you know, macro events, economic factors. How important is it to have a grasp on those sorts of things as a Forex trader? Like, would you suggest someone trades Forex purely based on technicals and price action, or economic factors and those other few things I mentioned, are they really important to have a grasp on too?
That's also a great question, and I feel that having some sort of base understanding of why the markets are moving up or down is important. I really do, and because if you're just looking at charts, it's kind of like driving with, you know, one hand over your right eye, or even with one eye closed. You're not seeing your periphery. You're not seeing everything around you. So I think having a basic understanding of what drives the currency market is good. You know, there's a you know, website called Investopedia. It's such a great resource for traders. You know, no matter what instrument you're trading, I think that's a great place to start, just trying to understand what drives individual currencies. There are some, you know, economic events, if you're not aware of them, they can really alter the outcome of whatever you're attempting to do in the markets. And that's why it's important to know, you know, what news events are coming, you know, like, you know, tomorrow, for example, I know people are going to be listening to this at different times, but tomorrow in Australia, there's a couple key events of the week that if you're not in tune with knowing that those events are happening tomorrow morning in Australia, it could really influence, you know, what you're doing with the Australian dollar. So, you know, I think there's a lot of great resources though that'll help educate you, the individual trader out there.
So, where's a good place to be in tune with those type of events that are coming out, that are scheduled for release? Like, is there a website you can get all this information from?
Yeah, there's a few great websites. First of all, I think that if you're using any of the big brokers, FX brokers, no matter, you know, who you're using in the market, they are going to have some sort of resources for you. Whether they have their own analysis team or they contract that out to another team, they tend to offer some analysis and probably a schedule of events on their site somewhere, you know, depending on what broker you're using, but most of them will offer that type of information. One of the websites that I love to use is Forex Factory. They've got a forum. I don't read through the forums because I don't like to get caught up with what everybody else is saying about the markets. I don't like anybody influencing my take on the market, but I like to see what events are coming, and if you go to their calendar, they've got a really intuitive calendar to use. It's very easy for the average trader to go and look at it and say, oh, you know, there's an important event coming up in Australia or in Europe. So that Forex Factory is great. There's also a team of traders. They have a free site. It's called Forex Live. Wonderful team of traders out there. I really have the utmost respect for all those guys behind that company. The guys that started it, I know, and I've been associated with for the last several years. I've communicated a lot with those guys, and the guys that run it now are all very sharp individuals. So I have a lot of respect for them as well. And that's a good place to get started. You might feel a little lost as a new trader. You might say, "Oh God, I don't really understand that." But don't worry, it takes time. It's not something that it happens overnight. But the more you read and the more you learn, the more comfortable you're going to become with what's happening around you globally. But it is a global market, and it's important to have an idea of what's happening in each of the respective currencies and countries that you're trading.
Right. Okay. No, really awesome answer, Blake. I appreciate you sharing that with us.
Sure.
So one other thing I'd like to talk about while I've got you here is Forex brokers. Now, there's a few different things I want to ask you around the subject, but let's start with leverage. So, as we know, many people are attracted to Forex for the huge amounts of leverage that are available. How do you use leverage, and what advice would you give to less experienced traders using leverage?
I'm so glad you asked that question. The leverage is not important to me. I could almost trade on a cash basis, but that just happens to be my situation. It's not the situation of everybody, because I understand. Hey, I'm trying to get started, and I only have a small account. I feel I can't. It's hard for me to get around in the equity markets because I need more money to buy buy shares or stock. It's just more difficult. So they come to the Forex market because of the leverage. I try not to think so much about the leverage. I try to think about the risk associated with each trade. All right. So what I mean by that, Aaron, is like, let's say I'm buying one lot of the euro dollar, whatever lot it is, whether it's a regular lot or it's a micro lot or however your broker coins it. If you're buying a lot of the euro dollar and you say, okay, I'm going to buy it at 111, but I only want to risk down to 110. What I always tell people is figure out, because whenever you trade, the first thing you should ask yourself before you even get into a trade is, what is my risk? That's question number one. Most people have it backwards, where they say, okay, well, I'm going to buy the euro. I'm going to buy it at 111. I think it's going to 120. Great. What's your risk? That's the first question I'm going to ask. At what point do you think you're going to be wrong? At what point do you have to pull the plug and say, all right, I need to get out of this thing? Well, if you bought it at 111 and it goes down to 110, you have to figure out how much money that's going to cost you to be wrong. And you go, okay, well, if I bought the euro at 111 and I sell it at 110, I'm just going to use easy numbers here. I'm going to risk $100. That's $100. Great. You're risking $100. Now, if you have a $1,000 account and you risk $100, you're now risking 10% of your account. I don't care what margin you had available to you. You're losing 10% of your money in one trade. That's unacceptable. Now, if you say, okay, well, I'm buying the euro at 111, I'm going to sell it at 110. If I take a loss, I'm going to lose $100. Well, if you had $10,000 in your account and you lose $100, now you're losing 1% of your trade. I feel that's more, that's more acceptable. That's within maybe somebody's risk parameters. So again, it's not about the leverage. It's about what your risk is in that particular trade versus your account value that you have. Because, I could take a trade buying the euro and selling the euro, buying at 110, and if I take a risk, or if I take a loss in it and I get out at 110, that risk to me might have been $1,000. And if I have $100,000 in my account, I'm risking a percent of my trade. A percent of my account in that trade. That's acceptable risk for me. But if you only had $10,000 in your account, that's not acceptable risk. That means you have to adjust your position size accordingly to sustain, the whatever you think is appropriate risk. And I think if you have that approach to your trading, Aaron, and you have reasonable, risk parameters. And I say reasonable, I don't think you should risk more than 1% in any one trade at any given time. That's just a nice rule of thumb that's very easy to remember. But I think if you stay within those type of risk parameters, it doesn't really matter how much leverage you have. You shouldn't exceed that the leverage the broker will give you, because leverage is, as you've probably heard before, it's a double-edged sword. It can work against you in mean ways. And so if you're mindful of the risk you're taking in every single trade and making sure that that risk is manageable and it's within reason, you shouldn't have a problem with the leverage that they give you. The leverage they should give you should be ample, more than ample. I don't know if that answered your question.
No, it does. And it's a really good way of looking at it. Risk first over anything else. I think that's a really good point you bring up. You also said in your answer there, and I think this leads to my next point, is if you're starting with $1,000 account, let me rephrase that. So it seems as though in Forex, a lot of brokers will let you open an account with a lot lower minimums. I think some are maybe even $500. Could be less. I'm not really sure. But, in your opinion, what's the absolute minimum someone should begin with as an account size who is genuinely serious about trading as a career?
I don't think I can answer that question, because I don't, anybody who's listening to this podcast, I don't think can, I can't make a roundabout assumption that everybody fits this one bill. But I do think that account minimums like that are $500 or $1,000, I really don't think that's realistic. That it seems to me that it's more like a hobby. It would be a hobby for somebody. If you're really serious about trading, I really think that you should have a bigger amount in your trading account, but also still managing it the same way, like maybe a $5,000 account, or maybe a $10,000 account, or maybe even a $2,000 account. But when you start getting in the accounts less than $10,000, you're dealing with what they call, well, at least a lot of brokers will call a micro account. And it's great. It's one of the benefits of trading currencies is you can really, people always say, Blake, should I practice trade on paper? I'm like, why? Because if you can trade a micro lot and you get into a trade and you lose 50 cents or you lose $1, it actually, you still feel the emotion, whether you're losing $5 or whether you're losing 50 cents or you're losing $500 or $5,000. You still feel the emotion of that. Oh my God, I did it right or wrong, and it kind of forces you to make the good decisions, even when you're trading with such little amounts. But the great thing about currencies is you can really test the waters with such little amounts. Even so if you're really serious about it, I think you got to stay away from the minimums. And if you're not in that camp and you say, well, I can't really get there, well, then you should save up to get there, before you really, get in the markets. And maybe in the meantime, you practice. You practice on paper just so you understand the trading platform that you're using. Because being able to execute and knowing what you're doing when you need to do it, it's like I'm getting in the euro, I'm getting out of the pound, I'm getting in the Aussie. Whatever you're trading, you want to know how to execute that trade instantaneously. So it's more of second nature. So even if you're like, well, I'm not quite there to have, $5,000 in my account, but I'm saving up. Well, in the meantime, understand, the macro environment. Take some time and go through those websites that I gave you just to learn a little bit more before you're really putting real money to use.
Yeah. Now, that was a good answer, Blake. I think you got to the point I was trying to lead you to, even though that probably wasn't the best way to frame the question. But no, I just wanted to bring up that subject of these very small account minimums that are available through some Forex brokers. And still on the subject of Forex brokers, it does seem as though you've got to be quite selective on the type of broker you go with, especially in Forex. There seems to be, some sketchy brokers knocking about.
Yeah.
What should traders be wary of when selecting a broker, and what are the tells of a reputable broker?
That's a great question. So I'm going to give you just a real easy answer. Stick with the big names. If whatever the big names brokers are, those are the ones that you want to stay with, because they're usually highly regulated by the government which they reside in, whether it's in the UK or it's in the United States or even in Australia. Just use the biggest broker you can find. I know, a lot of people don't want to do that because they're like, I don't use big banks. I like to use a small bank. But in the currency market, you want to make sure that your broker is being regulated pretty extensively, and that's why we have a couple brokerage firms in the United States that are publicly traded companies, and that means that they're extremely scrutinized from a regulatory standpoint. That does not make them immune from losses, because obviously if you know anything about what happened with the Swiss National Bank decision a couple years back, when they really wrecked some big UK brokers, but at least you'll be more protected being with a bigger broker, in my opinion. Some of these smaller outfits, you have to be a little weary. And if I'm gonna put my money into a brokerage firm, it's going to be with a firm that has a reputable name on the street.
Okay. All right, Blake. Well, let's wrap this up. Man, it's been awesome speaking with you. Thank you so much for doing this. I appreciate it.
I thank you for having me on here. I've heard about you over the years. You do really great work, and I'm honored to be a part of it.
No trouble. Thank you. Where's the best place for listeners to go to find out more about you?
Well, I'm on Twitter. I'm Pipzar, and by the way, Pipzar was a client given name many years ago. So I always have to preface people like, hey, this was a handle that one of my clients gave me years ago when they initiated a car czar. Somebody called me the Pip Czar because I traded price interest points, and so that's where it came from, and it just stuck. So on Twitter, I'm at Pipzar, and if you go to our site, Forex Analytics, and that's spelled analytics with an X at the end, not like CS, it'd be X. Myself and several other team members, we provide analysis throughout the course of the day, and you can see our blog there. We have a lot of write-ups on different exotic currencies and crosses and whatnot, and also I'm the chief currency strategist at the Xauuisd Trade Group, and that means that I host webinars throughout the course of the day. So if you follow me on Twitter, every once in a while I'll send out a link where you can log in and listen in, and it's free. It's not a sales thing. I 3.5 hours a day of just basically analyzing the markets and answering questions from individual traders like yourselves, and we talk about what's moving, and that's we cut through all the financial TV show crap where it's us, what's moving and what's not, and let's take a look at it. So
excellent. And I should probably just mention your Twitter handle is spelt PIPCZAR. That's correct, isn't it?
That's correct. Yeah, PIPCZAR. Correct.
Good one. So go follow Blake on Twitter. And once again, Blake, I hugely appreciate you coming on, man. Thank you very much.
Thanks for having me, Aaron. It was a lot of fun. I can't believe how fast time flew by.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Study
and play come together on a Windows 11 PC.
And for a limited time, college students get
the best of both worlds.
Get the Unreal College Deal. Everything you need to study and play with select Windows 11 PCs. Eligible students get a year of Microsoft 365 Premium and a year of Xbox Game Pass Ultimate with a custom color Xbox wireless controller. Learn more at windows.com/student offer. While supplies last. Ends June 30th. Terms at aka.ms/collegepc.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's happening, guys? Here we go for another episode. This time I'm joined by Michael Halsmore, who runs quantstart.com. This is a site which is very popular, very well known amongst algo traders. Now, just for a little background, prior to trading, Michael studied computational fluid dynamics and was the co-founder of a tech startup before getting involved in a small equity fund as a quant developer, where his key role there was cleansing data. Now, I know that may not sound overly sexy, but as you'll soon hear, we actually get into the importance of having clean, good quality data, especially when you're running an automated strategy. Now, today, independently, Michael trades his own short-term algorithmic strategies. He consults to hedge funds on machine learning and quant infrastructure, and also has a keen interest in space exploration. We discussed many interesting topics, some of which include thinking about risk management from a portfolio level, trading multiple automated strategies, the role of common sense in parameter optimization, where to start if you're interested in programming, and where to turn to if you get stuck, plus a whole lot more as well. Now, I will say I was really stoked to bring Michael on. Like he'll tell you, I've been bugging him for quite some time to try and make this happen. So I do hope you'll enjoy this episode. Anyway, guys, let's get right into it. Here it is, my interview with Michael Halsmore.
Why not? We may as well get started. Yeah, sounds good to me.
So, I mean, one of the first things I wanted to ask you about, as someone who lives in the UK there, what's your take on the whole Brexit situation?
Well, okay, so I'll get political for a second. So I'm not particularly keen to that we've left. I would have preferred to have stayed in. I voted to stay in. I did most of my sort of professional development, if you like, in London, and many of my colleagues, not only at university and in the workplace and through various roles I've had, have all been EU nationals for the most part, and so it's very natural for me to think of the UK as a kind of a sort of outward-looking European country. But obviously, 52% didn't agree, and we things went a bit south, certainly in the forex market for us. I hope. I mean, I don't know if you've heard just today, but we've got a new Prime Minister now, or will have very shortly, in Theresa May, and maybe this will calm the market somewhat a little bit. But my personal view is the damage has sort of been done, really, and that banks are going to make good on their promises and move out to Dublin, Frankfurt, Amsterdam, lots of centres where they can get access to a much larger pool of hiring talent, really. So that's my take on it.
So, I mean, what do you anticipate will change, like, as a result of this for someone like yourself who's living in the UK? Like, what do you anticipate might change moving forward?
Okay, so I mean, firstly, if you're an EU national, your status is up in the air right now. There's, nobody knows really what's going to happen in terms of when we're going to kick off this Article 50 process of, leaving the Union. So I'd be worried, frankly, especially if you're studying, because a lot of quants do come from an academic background, principally postgraduate research or sort of more technical undergraduate research, and they might now be thinking, well, should I stay in the UK? And I've got a lot of anecdotal stories, about students who are going back to their home countries in the EU now rather than staying in London. So it's going to reduce London's sort of hiring pool quite significantly. And I think the banks will just catch on to that. And because it's so easy for the banks to sort of move operations these days, everything's computerized and automated. I think we'll see a lot of shifting out, banks to other parts. And so it just makes it that bit harder for even the UK students to find work, because now they have to really, if you like, compete with the continent, whereas before they didn't have to necessarily compete. They had access to it all. So it just makes it that bit trickier, and that just makes things a little bit more expensive and difficult.
Okay. So, what was I going to say? So, now that we've got the heavy stuff out of the way, straight into it. Before we get into the actual trading part of your background, I believe that you were involved in a couple startups before you even came to finance. Can you tell us a little bit about some of the startups you were involved with?
Yeah, that's right, actually. So to sort of frame this in context a bit, when I was doing postgraduate study, I was very interested in fluid dynamics. Okay, so the equations for fluid dynamics are very, very similar to those that are used in options pricing. So the whole Black-Scholes model and all the which was really popular at the time, because in sort of 2005, 2006, because everyone was trying to sell mortgage-backed securities, and so they needed a way to price these financial assets. And so it was very, very it was quite straightforward at the time to go and work in quant finance if you had any sort of background in sort of statistics or engineering, fluid mechanics, that sort of thing. So I'd also, over a long period of time, sort of taught myself web development and programming, and then doing more postgraduate research, learn more sophisticated programming, if you like. And what I was thinking at the time is I was either going to go into quant finance or go into technology startups, which, nowadays everyone and their dog wants to build an app. But at the time, it was a bit more of a cottage industry. And so I started a startup straight out of postgraduate research with a friend of mine. And it was actually a social network, sort of a bit like Twitter, but it was for building, for posting jokes. So we did quite well for a while, and we did get some funding. Ultimately, it didn't work out after a couple of years. We didn't really find the right business model, and so we parted ways. But straight after that, actually, one of the investors who invested in this actually put me in touch with a friend of his who was just starting a sort of small equities fund, and they needed a quant developer, if you like. So this is, for those who don't know, a quant developer is somebody who codes up in programming languages all of these sort of statistical algorithms, generally derived from the sort of what would be known as the quant trader or the quant researcher. So it's the sort of other half, if you like, of quant trading. And so this role, which I was in for about 2 years, was sort of really where I cut my teeth, if you like, in learning the ropes in sort of institutional mindset of how these sort of funds actually go about their trading. So it was a very, very good kind of baptism of fire, if you like, good education in quant finance.
Okay, so that was really your first introduction to trading, was through...
Yeah, that was my... So up until then, I'd largely been, sort of theoretical, if you like, much more interested in the sort of mathematics of it. But this was my first proper, live trading exercise, at the coalface. So it was definitely really eye-opening, I think, in terms of, what happens when theory meets practice, and then seeing what really happens in the real world, not in the textbook, if you like. And I think it formed a lot of my early sort of key takeaways, lessons, because we were, there's a lot of volatility in that period. I think around 2011 there was some pretty chunky volatility. I remember I think that was the era of the Japanese tsunami. I think that was then, and so there was a lot of turbulence going on in the markets at the time. So it was very interesting to sort of work through that.
Okay, so tell us a little bit more about what you were actually doing, in your role as a quant developer with the fund. Like, what were you doing on sort of a day-to-day basis? Like, what would that look like?
Okay, so the prime task really of a quant developer is to build what they would call the trading infrastructure. So these are all the kind of modules or components that form an entire end-to-end automated trading system. So a lot of that actually is actually to do with data, obtaining data and cleaning it. So there's a huge amount of work, probably vastly underestimated actually, it goes into getting hold of good financial data and then cleaning it to make it robust enough to be used in proper statistical analysis. So a lot of my sort of early role was sort of setting up a database and making sure that all of the financial data from all these different vendors was clean. And by clean, I mean was free of sort of what they would call spikes. So this would be, the price suddenly becoming 10 times the amount just because of a typo, and then reverting right back to the normal level again. Or just making sure that corporate actions such as dividends, stock splits were all accounted for. Obviously, if you look at a raw price feed and it drops by 50%, you might think the world is coming to an end, but in actual fact, it's just done a sort of stock split. And we had to make sure that all these were married up because these signals were going straight into a live, continuous algorithmic system. And so we didn't want any sort of bad data going in that would obviously trigger a trade that was really nonsensical. So a lot of work goes into this data cleansing. In fact, there's a sort of small anecdote. The quant trader that I worked with at his former role, he told me that they had about 4 to 5 PhDs. Their entire day job was just obtaining data and cleaning it for the rest of the team in a larger fund. So there's a lot of investment going into data cleansing, and it's not really something that's very often discussed in the kind of quant blogosphere, if you like, because it's not really a sexy topic. Nobody really wants to talk about, running through reams of terabytes of data to clean it. But it's one of those things that's absolutely necessary in a kind of institutional setting. So that was sort of the first part, really, the data cleansing, and then the rest of it really involved sort of being very careful and testing each of these components or modules that did a particular task. So the risk management module, the sort of portfolio and order management module, the execution module. So all of these were sort of isolated components that talk to each other, and they all needed to be tested. And a lot of that testing involved trying to throw bad data at them in order to get them to break in ways that you don't expect. So a lot of it is really just coming up with these sort of quirky ways that these systems might fail in the real setting, and then just absolutely making sure as much as you can that they are going to be as robust as possible. Because once you've deployed it live, if bad data gets in there, it can cause all sorts of havoc, as you can imagine. There's plenty of stories around of things that have gone wrong in algorithmic trading. So that's roughly what I was doing, just making sure these systems were sort of impervious to harm, if you like.
Okay, very good. That's really interesting. I want to ask you a little bit more about data a little bit later too. So I've made a note of that. Were you ever sort of hands-on? Did you have any input on how the actual strategies traded? Were you involved in that aspect of the fund?
Well, we had quite an alternative means of actually obtaining strategy. So what we did is we were sort of scouring the internet for lots of alternative data sources. Not your we did use traditional pricing data, but we also used a lot of documentation and sort of text data, natural language data, and used that essentially to augment our signals. So we would take a lot of blogs, a lot of more structured kind of data, and then try and sort of mix it all into a big pot, if you like, that would produce us lots of consistent and agreeing signals, at which point we would trade based on that, rather than relying too much on any one sort of indicator or any one particular mechanism. So we tried to have all the stars in alignment, if you like, before we took some trades. But I was, so the way the actual sort of trading mechanism worked is we would have sort of weekly meetings where the quant trader would present new strategies that he had determined and come across, and then we would try and break them down into their sort of constituent components and then try and fit them into our system. So I didn't have any direct input into the sort of development of the trading strategies themselves, but I was pretty intimately involved in their implementation, if you like. So the quant trader, the quant researcher's goal was really to find new ways of, I guess you'd call it generating alpha, if you like, finding signal. And my goal was to try and slot that mechanism into the system that we already had in such a way that it was risk managed and the position sizing would not sort of go outside our risk bounds.
And what markets, I'm just curious, what markets were you mostly trading there at the fund?
So initially, probably like everyone else, we were trading very liquid kind of large cap US equities. The brokerage that we were using was very cheap to trade those. And I think later on, we actually also expanded into what I guess would be a sort of fund of fund mentality, which is where we found other funds and we allocated a certain amount of our portfolio to these other funds, which were doing so a lot of them were what we called CTAs, commodity trading advisors, so kind of quant trend following funds. And so we had our own internal strategies, but we also had part of our portfolio allocated to external managers. And so that made for quite an interesting portfolio construction and risk management approach. So probably quite different from a lot of quant funds, which completely internalize everything. But we were trying to go for a sort of diversified approach, not our own strategies as well as others.
Okay, cool. So why did you leave the fund? I think you mentioned you were there for around about 2 years. What led to the decision to go out and trade independently?
So a couple of things. I think we had some difficulty trying to secure the next institutional round of funding. So we had what I guess would be called a sort of friends and family round right at the start, which by technology startup standards was quite high, but for quant hedge fund startups was pretty good. It was average, but we needed to sort of go to the next level and really attract institutional investment. And it was tricky. It was a tricky environment to raise money in at the time, and ultimately we didn't manage to do so. So we sort of disbanded. And then I continued doing a lot of software development at the time, which is what I was really, I was really a programmer, if you like, quant programmer. And so I ended up doing a lot of consulting in machine learning and data science, which was, again, at the time, only just really becoming a thing, if you like. And then all the while, I was sort of building QuantStart. And eventually got to the point where QuantStart was becoming a good fraction of my sort of income, and now I sort of only periodically do consulting for sort of smaller funds in the kind of machine learning and software development quant infrastructure. So I'd sort of do a mix now. So that's how I ended up where I am.
No, that's really cool. And are they funds that are local to you there in London, or are they international? Like who?
Yeah, so I've mainly been helping a company that's based out in Zurich, but they have a UK office. But I've also been helping a local UK fund periodically on a sort of advice basis to help them get their infrastructure up and running. Because you'll find that a lot of sort of early stage quant funds are run by ex-portfolio managers. Now they're used to having a lot of IT infrastructure behind them. They can pick up the phone and just ring the IT department or the quant dev department when something goes wrong. But once they branch out onto their own, they are usually, they're very, very good on the strategy development, very, very good on the statistics and portfolio management, but they lack kind of infrastructure deployment skills, if you like. So this is how to take their strategy and put it into the cloud or put it against a brokerage. And that's where there's a lot of scope for bringing in a kind of quant developer to help them get off to the right start, rather than building a kind of house of cards of software that doesn't really isn't robust enough. I mean, obviously, while this may not be a problem in retail trading, it is a big problem in institutional, that they need to be very compliant. There's a huge amount of compliance and regulation that needs to be followed, and it's one of the big headaches of the industry is the amount of sort of time that's spent just taking care of compliance. And this is something that you don't really have to worry about too much in sort of normal retail trading settings, because you're trading on your own account. But when you're trading others' money, it's a very different story. So a lot of building these systems is about making sure they're compliant, and the regulators and the compliance is all happy.
Let's talk a little more about how you're actually trading today. Can you share some insight to the types of strategies that you yourself are developing and trading to this day?
Okay, so my sort of focus with trading tends to be probably I'll sort of say that I tend to think much more on the portfolio level about trading rather than the individual strategy level. So I will the sort of main goal, if you like, in quant trading is well, in fact, trading in general probably is you're trying to maximize your expected returns, if you like, your expected value, but you're also trying to minimize your risk, your sort of long-term risk. So with those two constraints, I tend to see that at the portfolio level. And so what I would tend to do is put in strategies into a kind of already existing portfolio if I believe they will either reduce the risk of the portfolio going forward or increase its expected returns without bringing in too much new risk. Okay, and that is generally how institutions think. You're basically always worried about these two factors. It's not, when it's your own, personal account, it's not so much of a problem, risk management, because if you've got the stomach for it and you understand that, the strategies you're trading are going to have chunky drawdowns at some point, you just have to sit through them when you come to see them in live trading. So risk management is different for retail, but in institutional settings, it's much more stringent. There's a lot of things you can't do, and you've got to be conscious of the fact that you're managing others' money. So a lot of the consulting I do is really of the latter type. So the sort of trading I'm involved with at the moment is mainly making sure that a lot of the stuff is risk minimized, which maybe it might sound a bit counterintuitive. That a lot of people concentrate on the strategy and what strategies are you running and how's your alpha generated. But I would say a big piece and a vastly sort of ignored piece in the kind of retail sort of quant sphere is risk management, because it's one of the ways that you can actually make more money, in my opinion. To have a very good, solid risk management system will actually make you more money over the long run, because you're not losing as much money. I think people forget that it's not just about making money, it's about preserving the money you already have. So a lot of what I do is I spend time looking at risk management. My personal view on kind of the strategies, as you say, is that they're quite easy to find. Trading strategies are really abundant in the literature. They're all over the internet. There's plenty of blogs and forums, podcasts, obviously. There's also hundreds of research papers that get published on every day on new trading strategies. So I don't think that it's difficult if there's such to find them. I think it's very hard to test them and make sure that they are doing what they say on the tin, but finding them is not really difficult. So I tend to stick really with some pretty simple stuff. I tend to stick with the sort of trend following and sort of mean reversion type strategies, but bear in mind that I tend to think on a much more of a sort of portfolio level. So I'll have a few strategies running at once, rather than concentrating on the sort of world's greatest trend following strategy, or the world's greatest mean reversion, if you like. So really diversification across lots of different strategies. That's my approach.
Okay, so when you highlighted risk management there as being, one of the most important factors in your eyes, are you looking at risk management from a portfolio level or on an individual sort of strategy level?
Generally on the portfolio level. So obviously, two strategies can produce opposing trades. And if they're in your portfolio at the same time, you have to decide what you do. Do you not trade? If somebody wants to go long an instrument, another one wants to go short an instrument by different fractions, you have to net that out somehow. So I tend to think of this not on the strategy level, but on the portfolio level. So I mean the obvious tools are things like the Sharpe ratio and your maximum drawdown. They're the sort of bread and butter of portfolio management. But the other sort of risk management techniques I tend to think about will include, at least at the institutional level in consulting, I'll be thinking a lot about average daily volume limits. So if we're trading on more niche markets, are we likely to be hitting anywhere near a good fraction of the day's average volume? Because if you are, then you're having a substantial impact on the market itself, at which point all of your prior sort of analysis, your back testing, if you like, is essentially rendered useless, because you're interacting with your own market at that stage, in a way that's heavily modifying it. So things like making sure we're not too sector dependent, and that the risks that we don't want to take, for instance, are hedged out. If we're running a strategy that's supposed to be neutral, we don't really want to be exposed, say, for instance, to US equity market broadly. So you'll hedge that out, and therefore you're only, as much as you can, you're trying to concentrate on the risks of your actual portfolio, not of the wider risks to the rest of the world, if you like. You don't want to be subject to sort of huge market fluctuations if that's not what you're trying to trade.
Okay, and are all these considerations built into your risk management module, or are these things that you're monitoring with some discretion?
So I tend to automate everything as much as I can. The reason for that is because I think it's very easy psychologically. I think they call this recency bias, which is very easy to sort of look at, the last week or today's, activity as something that is very, new. Oh, we've never seen this before. It's never happened before. But in actual fact, if you step back through time, there are plenty of cases where sort of terrible things have happened in the markets. It's just that people forget. And so as a quant, you're constantly trying to eliminate all of these sort of psychological biases, and that's kind of baked in to your risk management. And you have to have quite a strong element of trust that what's happened in the past will probably happen again in the future in terms of bad things happening, and that it's not just different today. So it means it's the main reason for this is it's measurable and it's objective. You're not going on hunches, you're not going on gut feels. You're sort of eliminating all of your own biases as much as possible, and then it's only down to the raw maths and statistics of it, if you like. If that makes sense.
Absolutely, no, 100% makes sense. I mean, that's one of the things that attracts me, on a personal level to quantitative trading as well.
Well, I would say as a flip side that people do have a tendency to get very myopic as well about, blindly following the numbers just because the numbers say things. I mean, statistics is not a perfect art by any means. It's a tool to help you make decisions fundamentally. And sometimes, if you've got incomplete data, or you don't have the entire picture, then statistics won't magically tell you that things are the right way to do it. I think there is a sort of discretion that does come into it, but the discretion happens at the research phase before you implement the trading strategy, I think, if you like. So that's where the discretion comes in.
Blowing ad budget on metrics that look great till the CFO sees them, that's bull spend. And marketers are calling it out in Dashboard Confessions.
I remember telling my boss, it'll be good for the brand, when leads were slow. Yeah, it wasn't.
Cut the bull spend. LinkedIn lets you target by company, job title, and more. Advertise on LinkedIn. Spend $250 on your first campaign and get a $250 credit. Go to linkedin.com/campaign. Terms and conditions apply.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
You described a lot of the strategies that make up your portfolio as trend following or mean reversion, but just the trend following, I mean, often when we hear the term trend following, we sort of think long-term trades that could go for 3 to 12 months maybe, or sometimes longer. Are these the types of strategies you're talking about, or are you talking about sort of intraday trends that you're following?
So I tend to trade on a sort of more shorter time scale generally, and the consulting I do tends to be with funds that are also thinking on a more shorter timescale. Now, the reason for that is because when you're trading over longer timescales, while you do have, while there is probably more, I guess, signal per trade, if you like, you know, that it's harder to predict the future much further out. So if you are taking like a big global macro sort of bet, then you know it's likely it can pay off, but the problem is that it's very difficult to draw any conclusions from 1 or 2 or 3 or 4 long-term trades in a statistical sense. You can't use traditional statistical theory to say easily whether those trades happened by chance or whether they were, you know, part of your skills, if you like. So the quant traders like shorter term trading principally because it gives them more trades to analyze. Now, it is probably harder per trade to sort of get some signal out of there because there's a lot of sort of short term fluctuation that really is not, I don't know how to say, it's not really underlying signal flow. It's just literally short term wiggles. But the thing is, you have access to a lot more trades, and therefore you can start applying statistical tools that will say, did these series of trades that I placed that were profitable come about simply because I flipped a coin the right way, or is it because there is some underlying profitability there that I've captured? So I tend to prefer working on the shorter time scale for that reason. Now, the other problem with working at the shorter timescales is that you're competing with a lot of funds that have a huge technology budget to play with, and you know, vast teams of quants that can go ahead. So you have to really look for sort of more specific areas that are just unattractive for these funds to play in, because otherwise you're not likely to have a strong edge against them. Because if you think about it, they're doing this all day, every day, with tens or hundreds of people. So they will likely know a lot of the edge. So I tend to look for things where there's a lot of capacity constraints. You know, that if they've got huge amounts of money to deploy, a large assets under management, AUM, then they're not going to be interested too much in low capacity strategies, because it's not worth their time to to put small amounts of money against these smaller niche markets, because they need to deploy a lot of capital, and therefore they need more liquid markets, if you like. If that makes sense.
Absolutely, yeah. That was a brilliant answer, Mike. So generally speaking, what's the logic of your strategies for buying and selling? Like, are they based upon traditional technical analysis? Are they based upon order flow? Are you trading pairs, or what are some of the factors that tell your strategies when to buy and sell?
Okay, so for mean reversion, I guess we can have a look at that. I tend to use a lot of time series analysis. So there's a huge wealth of statistical tools that you can bring to bear from kind of econometrics time series analysis, such as co-integration, and which is quite a well-known mechanism. So that essentially states that there is a sort of fundamental, I guess what you'd call physical relationship between two assets or two or more assets, and just by virtue of them of how they're structured. So the sort of canonical, perhaps sort of slightly silly example is when you have two share classes on the same asset. Okay, they are both going to be tracking the underlying movement. So I think I wrote recently about Royal Dutch Shell, the big oil major. There's two share classes there, and they will trade slightly differently themselves, but there's no sort of getting around the fact that they both have to track the underlying performance of the company in the long term. So they share a structural relationship. Now it's quite hard to trade something like that because the structural relationship is very tight. But in other situations, and a sort of good sort of fertile field for these sort of things is to be found when looking at things where you have like physical commodities as well. So I think so. A lot of assets that track these physical commodities will have structural dependence, which can be detected, if you like, via these kind of co-integration and stationarity techniques. And once you've detected this over a lot of assets, which gives you the ability to diversify, you can then use pretty straightforward actual trading signals. They're really not really much more complicated than if the signals diverge dramatically, in a traditional pairs sense, then you buy in, and if they converge, you sell out again. So the sort of secret sauce, if you like, to this is in optimizing the parameters as to when you buy and when you sell. As everyone's well aware, the devil's in the details, and so I would spend a lot of time perhaps using simple trading strategies, but spend a lot of time actually optimizing the parameters of those strategies in order to not only sort of maximize the returns, but also minimize the risk. I mean, there's a lot of risk in doing mean reversion. It's if you get it wrong, you can get it very wrong. So you have to be very careful and quite sure when you're placing a trade. So that's roughly the process I do. So I wouldn't say there's any major. I don't use any really incredibly special sort of mean reversion techniques. I just tend to be very cautious about my parameter optimization, making sure that what I do have is very is pretty robust, if you like.
Yeah. Okay, so just a couple things based on what you said there. Time series analysis, what's that actually referring to? Could you just maybe explain that? Give us a brief overview of what exactly is time series analysis.
Yeah, so the basic idea is that you've got a set of points of data, each of which has a sort of day or time point associated with it. And usually the sort of obvious example is pricing data. So what you might want to look at with one of these time series is you might take Google or Apple stock price and you'll say, is this time series actually increasing? So is there actually an underlying trend there? Or is it just a series of random steps up or down? Okay, because if it's the latter, then it has no predictive power whatsoever. They call it a random walk. So even though something may look like it's gone up over time, there's actually no ability, if you like, to trade it. There's no predictive power in its past data to give you new data. So what time series analysis is really all about is taking a kind of historical series and saying, do the previous days or previous weeks of data, do they tell me anything about what the likelihood of the next day or the next week's data are going to be? Because if they don't, then there's absolutely no point in using it. But generally you find that there is a little bit of predictive capability. It's not much, but generally because markets are very efficient, but certainly once you start looking at more structured niche markets, you will certainly see that the technical term for this is autocorrelation. It basically means that you can predict partially tomorrow's price based on previous day's prices. And if you have what they would call a sort of positive autocorrelation, then you will hope that you could use that to exploit what is essentially an inefficiency and then make a trade based on it. So time series analysis is all about understanding the kind of autocorrelation structure of past data so that you can use it to predict the future structure, if that makes sense.
Yeah, and I know you've written about this extensively on QuantStart, so what we might do is dig up a couple articles and we'll link to those in the show notes. How does that sound?
Yeah, it sounds great. So, I mean, there's obviously, the way to think of this really is that it's all about modeling. So you have to, you're coming up with a model, which is essentially an idealization of reality that has, is either can be quite simplistic or it can be very complicated. And, the simpler it is, the more easy it is to interpret and understand, but the less it will match the real world. Whereas the more complicated it is, it's much harder to understand and much harder to interpret, but you would hope that given enough data, it will match the real world a lot better. So a lot of time series analysis is really about understanding these different models and accounting for different events that happen in financial markets. So shocks to the system, like Brexit, I guess, could be considered a bit of a shock. The market was fully expecting a Remain vote. In fact, it was pretty much a dead certainty, I think, before the results came in. And so this would be considered like a structural shock to the market. And so time series analysis has to take in not only the kind of day-to-day fluctuations, but also account for these sort of left field structural shocks if they're to be useful. Because otherwise, if they don't take them into account and they are happening in real life, then your model is not really matching reality in any real sense. So it won't be profitable to trade it.
That was a really good answer. The second thing I wanted to ask you about, based off what you said just before, was optimizing parameters. Like, how do you approach this? What's your approach to optimizing parameters?
Okay, well, I'll firstly say that it is probably one of the hardest aspects of quant finance or quant trading in general is parameter optimization. I mean, it's not only difficult in a theoretical sense, but it's also very practically difficult. I mean, it's quite easy to convince oneself in backtesting that you found the world's greatest strategy simply by varying your parameters. So the classic example is the moving average cross strategy. You might adjust the two moving average look back windows, and then you might find that some particular obscure combination gives you a great result on that particular data set you've looked at, but as soon as you put it into practice, it fails completely. So that's what's classically known as overfitting. Which is where you've constructed your model so closely to the historical data that it doesn't account for future changes, if you like, very easily, and so it falls apart. And this is really common. It's probably one of the biggest pitfalls in sort of quant trading when people get started. So there's a couple of ways of dealing with it. I guess there's no sort of way of completely eliminating it, but there are ways of reducing its impact, if you like. So the classic statistical mechanism is known as cross-validation. So the basic idea with cross-validation is that you can sort of randomly partition your historical data or your previous data into batches, and then you try, using your model, if you like, on all of these different batches, and then you take a kind of average of what they produce, so that it's almost like you're giving it 10 separate universes to have a go at, rather than one big universe, if you like. And that statistically is a lot more valid, and it makes it more likely that it will perform better as it goes forward. So that's the key sort of technique in statistics and machine learning to deal with this. There's a few different variants of it, but it's all related to this rather sort of esoteric statistical concept known as the bias variance trade-off. And in trading, probably the best way to deal with parameter overfitting is with this cross-validation mechanism. So thankfully these days it's quite easy to do. A lot of the quant tools, especially in programming tools that I use, they have kind of built-in systems for just performing cross-validation, or CV, as a lot of people call it. So it's much easier nowadays to actually come out with a much more robust backtest than it was, say, even 10 years ago, when you had to program all this stuff yourself over and over again. So that's the key way I deal with parameter fitting. But I also, you also have to actually step back and look at what you're actually doing. I mean, if you look at a sort of moving average cross, for instance, and you're just randomly adjusting the look back windows until you get, a nice result, you've really got to say to yourself, why is a sort of 50 period or 206 period or 138 period moving average good? What's special about 138 compared to 139 or 150 or 160? So you also have to have a kind of physical intuition and say, does this really make sense? Is there really something that is happening on a 138-day scale that is not happening at 136 or 135? So, a lot of it does come down to common sense as well, if that makes sense.
Yeah, totally. So you dropped the word machine learning there. I'd love to ask you a bit more about that.
Okay.
That cross-validation, is that a machine learning, what's the right word, tactic? I mean, is that... Yeah, it's
a method that is sort of comes over from a field known as statistical learning. So, I mean, in quant finance, you have, or sort of theoretical statistics, if you like, you have two camps. You've really got the sort of traditional statisticians, and then you have the kind of computer scientists, and machine learning is like a marriage of these kind of two worlds. One of them is very, very good at data analysis and interpreting data, and it's used extensively in things like clinical trials, all the kind of bread and butter statistics stuff you read about in the newspaper. And then the other is all about, the computer science is all about taking huge amounts of data and sort of trying to find patterns within it, in a very different way. And so statistical machine learning, if you like, is kind of a marriage of those two worlds. And cross-validation is a sort of technique that was born out of that marriage, I think. So it's a nice kind of sort of heuristic process for, doing parameter optimization that is pretty objective. You can see the results of it. It's not hand wavy. You're not just saying, oh, this looks good. It is a very kind of objective approach.
Sure. And do you use machine learning in any other aspects of your trading? So there we kind of talked about, optimizing parameters and the back testing process. Do you use it in any other areas of your trading as well?
Yeah, definitely. I mean, it's very widely used. I think the canonical example that people have of machine learning is, what is tomorrow's price based on some model of all the past prices? Okay, a bit similar to time series analysis, but with different models. So that does occur, certainly, and I've talked about it a lot on the site. But in institutional settings, machine learning is generally used for things which you might not expect. So you might be looking for. So let's take, for example, people who run ETFs that track stock indices. So something like the SPIDER ETF that tracks the US S&P 500. So they have a kind of physical mandate to buy and sell shares in the S&P constituents as and when they get knocked out. Okay, so that is a sort of structural thing that's happening in the market, and they will obviously do their best to try and minimize the impact of this sort of necessary trading that they have to do in large block sizes. You can imagine some of the big funds that have to do this and sell in and out. So they try their best to kind of mask these big orders so that the hedge funds don't sort of look at them and go, aha, we know what you're doing there. We can sort of trade based on the fact we know that you're going to be dumping a large block of shares in the market. So machine learning is a good way of finding these patterns of how I guess there's essentially execution patterns of how these big funds are dumping or buying these shares on the market. So what might not be structurally evident to the sort of naked eye will, over a long time period, be very structurally evident to a kind of machine learning tool, because they can learn from these sort of huge amounts of data that the S&P relies on. So you might also find it used in situations where you're trying to predict spreads of a particular or stock or trading asset that you're interested in, because if you can, while you may obviously want to try and predict direction, it's also very useful to be able to predict spreads, because if you know in the next time period or the next month or whatever that spreads are going to be slightly higher, you may want to downvote or downweigh the possibility of making a trade in that period because it will be more expensive. And again, this is a kind of rather than increasing returns, this is sort of decreasing costs, if you like. So that's another area where it's used. So it's used a lot in these kind of non-traditional ways, and by non-traditional I mean predicting tomorrow's price from kind of historical prices. But probably the final or an additional use for it is in much more non-traditional data sources. So there's a huge amount of social data, videos, images, tweets, satellite data, lots of what would typically be called non-numeric data, non-pricing data. And machine learning techniques, they absolutely excel at kind of finding patterns within these. So you can think of a simple example where you might have a hedge fund that's paid for a lot of real-time satellite data over crop fields in certain parts of the world, and by aggregating all of these sort of crop images, they can ascertain whether there's going to be a good crop yield or bad yield in the future. And so that is a sort of perfect example of where machine learning techniques absolutely excel, because they'll be using that to sort of say, this field is not as healthy as we thought, this field's a bit more healthier than we thought. And so it's very non-traditional. You're not using pricing data at all. You're really just using, physical image data. And that's where machine learning can really excel, I'd say.
Yeah, I was going to ask you about that because I saw you'd written about it on QuantStart, and it blew my mind. Like, I had no idea this sort of thing went on. That there was satellite imagery. Like, who would have thought that could have been used to generate trading ideas? Like, that's so wild.
It is wild. I get the thing is, hedge funds are so competitive nowadays. There's so many of them, and it's a lot easier to start a quant hedge fund, than it was. Still very expensive and tricky, but it's less tricky. And as such, you've really, if you're pitching to an investor, you've really got to sort of say, what is my secret sauce? What are you doing differently from all the other trend following or mean reverting funds out there? And so in this sort of desperate quest for alpha, a lot of these funds are turning to these kinds of sources of data. So I think I mentioned probably the post you're referring to is, looking at some of the car parks of some of the big retailers, via satellite imagery and seeing how many cars are parked there, because that will give you an indication as to, what their earnings are going to be like in the next quarter, which, again, it does blow your mind a bit to think that people are doing this, but it happens in all sorts of different ways. There's a lot of websites that will track aircraft and ships around the world. And so a lot of hedge funds will use this kind of maritime traffic data to see, whether oil's being stored or, and therefore what the kind of supply demand imbalance is. Obviously these are all models, there's only so much you can do. You're always seeing a piece of the puzzle, but, even that is sufficient, if you like, to have an edge, a very direct, kind of clear physical edge over the rest of the market. So that's what a lot of these hedge funds tend to specialize in. And so you can imagine then the importance of obtaining, cleaning, and sort of analyzing this data becomes a sort of first-class citizen, if you like.
Yeah, no, that's really incredible. So just leading on from machine learning a little bit to artificial intelligence, I mean, do you think artificial intelligence has a place in the future of trading?
I mean, firstly, AI is quite a broad term, but I think probably what we're talking about here is something called, at least there's one specific area of AI, which is probably reinforcement learning, which has become very famous recently because of a firm called DeepMind, which is actually based here in London. They built some AI tools to sort of defeat that sort of ancient game of Go, which is a very complex strategy game. I know they are doing a lot of work about trying to apply that to any National Health Service data here in the UK. So, all of our hospital records, anonymized hospital records. So in terms of trading, they use a process known as reinforcement learning for this sort of stuff. And the basic idea with reinforcement learning is that it's the sort of third pillar of machine learning. And the idea is that you have what they would call an agent who is essentially pretty dumb and sort of wanders around in whatever kind of space they have, and then tries to do stuff, and they get rewarded or punished depending on what actually occurs. So, in trading, this would obviously be, you'd have a sort of stupid trading bot that would periodically buy and sell randomly, and then it would be rewarded, if you like, by making money and penalized by losing money. So by doing that over and over and over again in a kind of simulated way, the sort of reinforcement learner would eventually and hopefully learn through kind of structure of what's going on in the trading data, how to get better. So I'm pretty confident, although I'm not 100% sure, but I'm pretty confident that there must be a lot of secretive work going into this area in some of the big quant funds. You can sort of see, because one of the great ways to tell what quant funds are really up to is to look at who they're hiring and what type of people they're hiring. So there's a few sort of quant job sites around, and if you see what sort of skills they're currently looking for, it does give you a bit of an indication as to what kind of research areas they're thinking of looking at. So I've seen a few reinforcement learning demands. So I'm assuming it is going on. But as you know, it's a very secretive world, and people aren't generally willing to share too much. So.
Yeah. Very interesting indeed. One more subject I'd like to dive into with you is just programming in general. So, a question, you probably get it all the time, it's a very common question, is what language should someone use for algorithmic trading? Like, how do you address this? Because I know there's not like one single, one-size-fits-all answer. So, I mean, what would you suggest?
Okay, so there's kind of two answers. There's the short one and the long one, and I'll give both. So the short one is that I tend to use Python, which is becoming really popular these days, even in institutional settings, principally because it's really easy to learn, even for complete beginners who've never done any programming. And it's kind of fast enough for doing things. But the main reason is that it has a lot of what they would call libraries. Okay, so these are sort of modules that other people have written to do lots of different things. So there's hardly any need usually to implement lots of sort of simpler stuff yourself. You can just find somebody else who's already done it, and usually they've given it away for free. Then you can just sort of import it into your projects. So that's the short answer is I would go with Python for those reasons. The longer answer is really, I mean, it's sort of like asking what's the best way to drive from the south of Australia to the north of Australia. I mean, that would depend whether you're wanting to get there really fast, in which case you take a Ferrari, or whether you want to carry 10 tons of food with you, then you take a big HGV truck. So the question really needs to be framed in sort of what do you want from your algo trading. I mean, if you're doing high frequency trading, sub-second trading, where you need really, really rapid execution speed, then you would use something like C or C++, or even some of the high frequency trading firms. They write their own custom chips. They make their own circuit boards a lot of the time. So they're really, they really optimize to the nth degree for speed. But if you're doing longer term trading, Python is pretty sufficient. It does. There are areas where it doesn't do so well. It's not so good at really deep statistical analysis. It's not designed for that. It is, it's a general purpose programming language that, a lot of websites are written in it, for instance, and scientific applications. It's not a statistical tool like R, which is, was designed from the ground up to be a kind of statistical environment. R is also very heavily used in hedge funds for research, but equally, R doesn't have Python's ability to sort of talk to everything very easily, and it's not very good for actual algorithmic trading infrastructure. It's great for doing the research, but it's not so good for infrastructure. So in some sense, you use the right tool for the job. Python is probably the sort of jack of all trades, master of some. So it is a kind of good sort of one size fits all language. I use it for all my own stuff. I use C++ occasionally for things I really need to be fast, but I almost always use Python, and I have done even in institutional settings. A lot of my sort of colleagues, they also all use Python. It's great for machine learning, but it really comes down to what it is you're doing. So the short answer is Python for pretty much everything except HFT, in which case you should use C or C++, really.
Okay. So do you have any tips for how to actually learn how to program? Like for someone who's currently, a non-programmer, what would be the most efficient way for them to learn a new language and make sure that they're really learning the right things about that language?
Yeah, definitely. So these days, it's really easy, no matter what platform you're using, so Mac, Linux, Windows, whatever, to actually install Python. On Linux, it sort of comes with it anyway. But on Windows and Mac, you can download a free tool called Anaconda by a firm called Continuum Analytics. And it basically just gives you this sort of really easy interface to just get started with Python. So obviously that's a bit of a blank canvas, but it does mean you don't have to worry about any of the complicated installation. So once you've downloaded that and installed it, there are quite a few resources to go and learn Python programming. So I think if you're a complete beginner and you've never done any programming before, the best resources are some of these online MOOCs, massively open online courses. So there's Coursera and Udacity. I think Udemy. I can't remember I think that's the name. And they all have a kind of introduction to Python course. Now, what that'll teach you is the sort of bare bones basics of how to actually program. So these will be things like sort of looping, so how to sort of do a procedure over and over again, how to make decisions within programming languages, so what they would call branching or if-else. So these are sort of basic programming concepts. So you'll learn all this kind of bread and butter programming skills, but also probably be building reasonably interesting projects. So I think once you've spent a few weeks, maybe a month or so, getting to grips with the basics, you'll be at a point where you can start experimenting with algo trading libraries. So now that some of them are very complicated, there's obviously a lot of complication in algo trading. So you could just get started by downloading some pricing data and then sort of trying to plot it and then running some very simple indicators over that. And I use a tool called Pandas, which is the Python data analysis library. It's also free. So all of this stuff, just to clarify, it's all free. Don't need to pay for any of it generally. It's all open source. And then once you've had a go with that, you'll get used to the interface, and you can start taking some of the ideas that you may have for algo trading and then applying them in Python. And thankfully, there's a good community of people who do this, and there's a great sort of quant blogosphere. I think if people should definitely check out a website called Quantocracy, which I'm sure you're pretty well aware of. It's a kind of link aggregator, if you like, for quant finance websites, and loads of the bloggers on there put a lot of tutorials out on how to use R and Python for doing quant trading, and there's loads of what they call snippets, little pieces of code that you can sort of just almost copy and paste, if you like, to have a go, and then step through line by line to see what's actually being done. And that gives you a good start, I think, into algo trading, and then you can just build up from there. It's really a never-ending road. I mean, I tend to think of myself as still learning all the time. You're always a student, really, in quant finance. You're never a master, I think. Yeah.
Yeah, now that's really good advice, and I liked your comment about just sort of going through line by line and trying to work out what's going on here. I mean, I've been learning Python myself, previously a non-programmer, and I don't really quite feel comfortable calling myself a programmer yet. I don't really feel like I'm at that level, but definitely putting a lot of effort into learning Python. That's one of the things I found really helpful, was actually looking at some reasonably basic algorithms that other people have written, which I might have pulled off Quantopian or something like that.
Yep.
And just going through each line and just commenting, using your hashtag at the start of the line, so it's a comment, so that that line is ignored, and just writing what actually happens on each and every line, like what's actually going on there. I found that really helpful. So no, that was a really good point.
Well, Python's very good for that. I mean, it's one of the most readable, by design actually, it's one of the most readable programming languages. It's designed to sort of almost look, like how you would describe a recipe to somebody. There's very little hidden stuff going on a lot of the time, if that makes sense.
Yeah, it does. So here's a question. When you're coding a strategy, or when you're coding, I guess, anything at all, where or who do you turn to if you get stuck?
Right. Okay. So I tend to. So that's a tricky question. So where do you tend? So I tend to have problems usually with sort of particular statistical algorithms, I guess. I presume you're talking about me, or are you talking about in general?
Well, yeah, I did say you, but I'm maybe thinking that was not the right term. I maybe thinking it would have been better if someone else, like if someone learning to program. Right, let's take it that way.
All right. So yeah, if you by you mean somebody who needs help. So it depends generally on what sort of issue you're having. I mean, there are some great forums. So there's obviously Reddit, which has a lot of subreddits for quant finance and Python programming. I mean, it was started by the sort of computer science-y kind of side of things. So there's loads of Python question and answer sort of sites. There's one of the best websites on the internet actually for any kind of programming or quant related question is something called Stack Overflow or Stack Exchange. So it's absolutely, you can generally find any question imaginable, somebody will have answered it. So usually what I tend to do, if I have an error or something's going wrong, I just copy and paste the error straight into Google, and usually Stack Overflow will be the first link that comes up. You look at it, and it'll be someone else who's had exactly the same error, and they'll say, what's going on here? And then there'll be usually a brilliant explanation beneath about what it is and how you can fix it. And I know that may sound a bit unstructured, if you like, but that I can personally vouch for the fact that some of the top software developers use this method all the time. When they need help, they just Google the error message, and so that's one way of getting specific help for errors. But if you're having trouble coding a particular algorithm, some of the best places to ask, you can ask a question yourself at Stack Overflow, but more likely there's going to be somebody who will have done this. So let's say, for instance, I want to do a mean reversion co-integration tool or whatever. I've got some statistical test. I'll just type the name of the test into Google, followed by Python. And usually in the first 10 links, there will be some project or code snippet that allows me to sort of go, I see how it works now. I understand. And so that is, that's generally my mechanism. But I guess a lot of this sort of behavior or intuition comes from when you do, a sort of research degree in general. You're quite constantly doing this. So it becomes quite intuitive after a long time to kind of search for help in this manner when you're doing some kind of postgraduate course. So I think this is why a lot of quants tend to come from that kind of academic background in general. because they're quite used to sort of going and seeking help and looking at papers and figuring out how to take those papers and put them into code. So it's a good skill that I think anyone should really try and learn, even if they're not interested in academic study. I mean, it's a very, very good skill set for sort of retail quant traders, is to take papers and code from elsewhere and try and figure out what it's doing, if you like.
Absolutely. And I loved your suggestion of Stack Overflow too. I mean, I know that's got me out of trouble quite a number of times. It's such an awesome resource. Okay, Mike, well, let's start to wind this down. And there was one thing I wanted to just try to squeeze in, and, you know, trading aside, I believe you're pretty big into space exploration. I mean, I'm keen to hear a little bit about this. Is it something that you're pursuing? Are you pursuing anything in this arena, or is it more of just an interest?
No, it's so when I said I did fluid dynamics at uni, it was actually in rocketry. So it's an area known as computational fluid dynamics, or CFD, and so you're trying to simulate. I was essentially trying to simulate a certain type of engine, like rocketry engines, and I've actually recently been thinking about, as a sort of secondary business to QuantStart, is to sort of get back into kind of analysis again. So CFD analysis for kind of different situations. So yeah, I'm mad keen on space exploration. I probably don't talk about it as much on QuantStart, if ever, but I do make a bit of a noise about it on Twitter, certainly. But yeah, so I am actually possibly going to be working with a company that does is trying to do satellite design and launching in the UK. Unfortunately, I'm not allowed to say too much more about it at the moment, but it's looking relatively hopeful. And so I think I won't be directly involved on a day-to-day basis, but I'll probably have a sort of advisory capacity, because a lot of, like quantum finance, a lot of space exploration is really about testing. You're constantly trying to manage risk. In quant trading, if you launch a strategy and you lose a bit of money, it's painful and not, it's never fun, but you can yank the strategy out and turn it off. Whereas with rockets, if you launch it and something goes wrong, it blows up. At best, nobody dies. At worst, obviously, people can be killed. So you have to, the level of risk and mission criticality is absolutely, it's very different from other industries. But I think quant finance could probably learn a lot from space and the way they deal with risk. They won't launch anything until they're pretty much certain that it's not going to fail. And I think a lot of traders, myself included, actually could probably do with using more of that sort of risk management mentality, because I think it would reduce losses quite substantially.
Yeah. Well, that's awesome. You'll have to keep us posted on the details when you're allowed to share a little more.
Yeah, fantastic.
Anyway, Mike, do you want to share a little bit about QuantStart? Tell us, what is QuantStart for no one who's ever checked out the site before, and then we'll wind this down.
Okay, so I tend to think of it as an education portal, if you like, for quant finance in general. I mean, I have sort of gradually steered the ship over the last 3 years to talk a lot more about algo trading, but I still am very interested in talking about quant finance careers. So the site is, I would say, it's a mix of quant career advice and kind of quant trading advice, if you like, and tutorials. Now, my sort of key views, if you like, of a QuantStart is one is that I like to talk about the details that most people will not discuss, not because they're proprietary or secret, just because a lot of people think they're dull or boring. And I personally find that those aspects of quant finance are absolutely crucial for becoming profitable. All the stuff we talked about today, data cleansing, actually interacting with a broker via Python. How do you do it? How do you install these tools? There's not much really discussed about that. There's always discussion about trading strategies and what's the next best strategy that's going to make you your millions. And I personally find that a lot of the difficult stuff is actually quite dull to talk about, but it's necessary. And people have commented that they like that approach, so I sort of stick with it. The other aspect of it is I tend to try and share as much code as possible, so that people can just copy and paste it and use it themselves. I don't really like people saying, "Oh, I've done this, I've done that." without providing an actual bit of code. Because I've been trained as a scientist to think of reproducibility. That's what we're trained to do in the sciences. You want to share your work, and you want to make sure other people can implement it as well. It also helps to find bugs. People can write in and say, look, sorry, this is buggy, you need to fix it. And that just makes it better for everyone. So I think sharing code is a great idea. Also, probably the most important thing that I'm really keen on is to emphasize sort of continuous learning all the time. I mean, once we leave school or leave uni, most people, for whatever reason, just don't tend to want to continue learning as such. They think they've done school, they've finished uni, they got their grades, that's all good. But I think a quant's edge is really in their ability to continue reading all the time. I mean, if I had the ability, I would probably spend about 50 to 60% of my day just reading. And I know Warren Buffett is very famous for saying he spends 70% of his day just reading stuff. And I think that is probably the biggest source of edge in quant finance, is just reading and reading and reading, because you learn mistakes of other people, but you also learn about all these niche ideas that other people just aren't willing to find out about. And it gives you an edge naturally, because people just aren't willing to go that far, There's so many resources out there, not just the typical kind of flashy, trading ideas, but lots of white papers on hardware, really obscure things that you think, oh, hang on a minute, if I exploit this little trick here, I'd be able to, And so I think reading is absolutely important, and QuantStart talks a lot about that. So that's the basis of the site.
For sure. Well, I mean, anyone listening to this, I want you to check out quantstart.com if you have, even just the slightest interest in quantitative or algorithmic trading, which I'm going to probably presume you do if you've stuck through right to the end of this. So yeah, quantstart.com. And Mike, do you want to give out your Twitter handle as well?
Yeah, so my Twitter handle is mhallsmore, so MHALLSMOORE. So I did have originally a QuantStart Twitter, but I tend to now do it all through my personal account now. So that's my Twitter handle. Good one.
Okay. All right, Michael. Well, I've been looking forward to this interview for such a long time, so I'm glad we could make it happen. Thanks so much for doing this, man. I really do appreciate it.
Yeah, thanks for having me on. It's been absolutely brilliant. Thanks for taking the time to ring at 8 a.m. UK time.
No trouble. Thank you.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast on iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Are your ad campaigns lighting up the dashboard, but not the pipeline? That's bull spend, and marketers are calling it out in Dashboard Confessions.
My boss asked for results, so I opened my dashboard for the only positive-sounding metric I had: impressions.
Cut the bull spend. See revenue, not just reach. LinkedIn delivers the highest return on ad spend of major ad networks. Advertise on LinkedIn. Spend $250 on your first campaign and get a $250 credit. Go to linkedin.com/campaign. Terms and conditions apply.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey folks, what's going on? I'm Aaron Fifield. I am your host, and like always, thank you very much for tuning in. I'm pleased you could be here for this week's episode. This is episode 91. We're getting very close to 100. It's kind of frightening. Anyway, guys, my guest this week is Craig Scott. I've had a bunch of people asking if I can try to bring Craig onto the podcast, so here he is. Craig is someone who has been trading and investing for pretty much most of his life. First started in school when he participated in a year-long stock picking competition where he did pretty well. Once completing a double major in finance and accounting, Craig spent many years as an auditor and an accountant, and later on, the entrepreneur within had him start and grow several businesses doing similar things along the way. As Craig describes his style of trading and investing today, it's a hybrid of fundamentals, momentum, sentiment, and instinct. He uses options for short-term positions, and for mid to longer-term positions, he uses stocks. And I should mention, Craig's very adamant about the fact that he does not use charts, which of course we get into during this episode. Now, we'll also mention there were a few small glitches in the sound quality during our chat. It's really nothing major though. Please push past it. There's a lot of really good stuff packed into this episode. I hope you enjoy it. Here we go. You're listening to episode 91 with Craig Scott.
Yeah, it's crazy.
Yeah, so let's get into this, Craig. So, I don't know a great deal about your background, in all honesty. I know that you did start investing around 14 or 15 years of age, but I'd love it if you could tell us a bit more about how you got started and what actually got you interested in markets.
Well, I started, I think freshman or sophomore year in high school. What actually got me started was my economics teacher in high school, Mrs. Blake. And she tasked us in the very beginning of the year she was entering us into a stock market contest that was statewide. And she was looking for volunteers from the class to kind of lead the project and, make some stock picks and, basically stay after school and research and things of that nature. And I really didn't even have any exposure to it. Other than, the fact of, putting some risky things to work appealed to me. So I volunteered to lead that. I picked like 3 or 4 folks that wanted to stay after, and we kind of just went from there, and we would stay after. And, back then there was no computer. So we would bring newspapers and, with the Wall Street Journal and all the listings of all the different stocks and news stories and try to accumulate data as efficiently as we could. And then, nothing was electronic. So you'd write down your stock picks for the week and you'd send them in via, snail mail. And then you'd see how it performed, and you'd get results once a month. And it was a year-long contest. And I think at the end we came in like 3rd or 4th in the state out of 800 schools. So it was great. It was a good experience. That's how I started. And taking that, right after that year, I actually started putting real money to use, my own money from jobs and work and money I've saved. I asked my mother if I could get involved, and obviously she wasn't really keen on the idea of me putting money that I've worked and saved for to use in the stock market. But she said I could start out small and work my way up. So that's what I did.
That's really interesting. So why do you think it was that your mum wasn't keen on the idea of this?
My mother was always more of the conservative type, stick your money in the bank, buy CDs, save for a rainy day, kind of mentality, which, living with, her mother who came through the Depression and stuff, I guess it was, for some, was a way of thinking that, you always save because disaster can strike, which is kind of funny that, the stock market crash is what, was part of the Depression. So I, when I brought up, investing in stocks, I'm sure she wasn't, overly joyed, but, I showed her some of the stuff I was working on in high school, and that, I kind of, had a thought process and how I wanted to go attack it and things I was thinking of. And she agreed to let me start small. She had a very small brokerage account that I think she, inherited, and she really didn't do anything with. And she's like, she let me, put some of my money in that. And then I started, and I haven't stopped since.
Oh, good move on her part. So you mentioned that you were mostly doing your research by reading articles in the Wall Street Journal and that sort of thing. What sort of things would get you interested in companies back then? Like, what were you actually looking for and researching specifically? Like, what gave you an incentive to actually buy into a company?
So that's funny because it's almost exactly the same thing as now. And it's what I tell my daughter, who's starting to invest and is doing very well in the markets. And I told her what I did. I said, stick with things you know and understand. You stick with things you see that are doing well, or something, a new product that you're really interested in, and follow up and see, who manufactures it, who's buying it, who's selling it, who are the main customers, so that's the kind of mentality I used. I would see something and think to myself, okay, everybody has one of these, who makes it? Or everybody's selling one of these, who's selling it? So, and that's the mentality I went in when I was, identifying targets of things I would look to buy early on. And that's really carried through till today. And it's something I've even, ingrained in my kids that, who want to invest, which is now, my daughter's in Starbucks every day. So she bought some Starbucks, and she's always buying Nike clothes. So she, Nike and Under Armour. So it's the things that you understand, and try to stay away from things if they're confusing that you try to avoid, because when you're confused, bad things can happen.
Okay. I really like this point, and I'm definitely we're going to pick up on this in a bit. I want to go into much greater detail on that. But before we get to all of that and more of the specifics about how you trade today, I'm keen to hear a bit more about your journey. So, once you did start trading or investing with real money, how did you go? Like, was that any different from how you were performing when you were participating in the college competition?
Well, I can tell you this: I was a lot more nervous because when I was a lot more on top of it. I was watching the business news all the time. And I was when I was doing the contest. But when you have skin in the game, your body temperature goes up a little. And I caught a break. I guess it was in the mid 80s, maybe 85. We had an RCA. All our TVs in our house seemed to be like RCA. So I bought a bunch of stock in RCA, a bunch, relative back then. And, then it got bought out by GE, and suddenly my account went up like 200%. And I was like, this is fantastic. And I just, I took that, and I kept my philosophy pretty true throughout. So, I took pieces of my capital and put it in different investments throughout high school, and then even through college. I did the same thing. So I was a double major in finance and accounting, because one thing I've learned, as I was learning, was that you really have to have a really good backbone with accounting to understand companies and markets. So I wanted to, accounting is boring because most people think of, people doing taxes and things of that nature, but I was more of the financial end of, understanding a company's financial statements, where the holes might be, where the strengths might be, and how that could identify a good or a bad investment. And that's what I pursued throughout college. And I graduated with a degree in finance and accounting. So that's pretty much how I through my undergraduate years, and I used the money I made to help proliferate spending in my college years, because it was expensive, and I didn't want to put my parents out too much.
Yeah, right. Okay. So what did you do post college? Did you just go full time trading and investing, or did you pick up a couple jobs in the industry? Like, where did you go from there?
No, so actually what I did was I really wanted to get some exposure to the inner workings of companies. So out of school, I worked at, now it's PricewaterhouseCoopers. Back then it was Coopers and Lybrand. I got a job at a Big Four accounting firm. where I obtained my CPA, and I worked as an auditor and then into the management consulting end of the firm, so I can kind of understand and see how management thought, understand the processes into decision making, how financial statements were constructed, where some of the red flags might be. And I got on some pretty significant clients, like I was on the J&J audit, and AT&T and things of that nature. And then as I moved on, I was doing some management consulting in the financial sector, Smith Barney Shearson, and I was downtown on Greenwich Street working through those, and really getting understanding on how it tied in between, the banks and the companies and financing and a company becoming public and how the markets were really structured and how they work. So, that was my first job out of school. And then I moved into the private sector, working in mergers and acquisitions and banking and some private companies like NBC and such, where, I was really involved in the discussions between firms and acquisitions. I worked on the MSNBC joint venture, so I got to sit in a room with Bill Gates and Jack Welch. I mean, I got some real good exposure at a young age to business leaders that really, were people who influenced, not only the markets, but their companies. And then, and all the time I was involved in the markets, except when I was at PwC, I was somewhat restricted because of, disclosure and things of that nature. I couldn't be, trading in companies that, obviously I was auditing and things of that nature, but it's been pretty steady throughout. And after that, we came the late 90s, and we'll get into this, but, I took some, major hits where I basically lost everything. When the dot-com bubble crashed, and I started an executive staffing firm, and that did well. We started with 2 folks, worked our way up to about 30, and then I got back into the markets again as I was doing that while I was running that firm, and I started up different companies and tried to be the entrepreneurial spirit. And that's pretty much how the flow through of my career up until this point.
Okay, so let's break that down a little more. So, you talked a lot about your accounting and auditing experience there. Was it easy for you to transfer that knowledge into good performance in the markets? You know what I mean? Like it's sort of one thing to understand what's going on, but to actually turn that into actionable information that you can trade off. Was that something that was easy for you to do?
Not immediately, no. It was something that was sort of cultivated as time went on. You would see how companies would either miss their earnings or have to make an amendment to their financial statements and the events that may have caused that. So it took a while for me to balance the causality into an investable action. So, that had to, come into my prism of view to make that connection. It did take a while, but eventually all the pieces started to fit. And then I could look to see where there might be, deer in the headlights kind of look from companies and give myself a warning or see something good that's coming down the pike and maybe get involved.
Okay. Now, you also talked about you took some really big hits. So I'd love it if you could break those down for us and give us a bit more insight into what actually happened there.
Oh, absolutely. I could take you through. I mean, everybody likes to talk about their glory stories, but it's the hits that actually allow you to become successful. So, I was running a fairly large executive staffing firm. We were doing probably 100 million in revenue, and I was taking capital and trading it, and I was somewhat distracted, and I really couldn't devote my full attention, to the markets, and the mistake number one is when there's a few, takeaways when you have big losses. Mistake number one is when you get involved without any sort of exit strategy. So when knowing when to sell, or, the FOMO, the fear of missing out, and that's something that, you learn through experience. But as that goes on and you're in the heat of the moment, then you buy more of a stock just because it goes down. And then eventually everything blows up, which is what happened in the dot-com era for me. I would get involved in, a lot of different companies like Telligent and Windstar and Exodus Communications. And I would just start getting involved, I was starting to get involved in, trading deep active options. And, options are great if you can manage it and with the leverage. But, if you don't have things under control, it's been cataclysmic pretty fast. So yeah, I was at a point where I had basically nothing left for investable capital, just because it's bad decisions that I wasn't be able to focus 100% on the markets and see the undertones of what was happening, and I think that was obviously a big lesson learned.
Yeah, no doubt. And over the years, have you had anyone almost like a mentor-like figure who has helped you with your trading, or has it mostly been sort of self-acquired knowledge?
Unfortunately, yeah, it's all been self, taught, deprecate. I don't know what word you want to use. There's been a lot of hard lessons I had to learn. I did not have a mentor along the way. I had a mentor, so to speak, but not in the markets. So I had a mentor in business, which thank God I did, because it allowed me to acquire enough capital to get back into the markets. But as far as trading and learning the ropes, no, it was all self-taught. And like I said, I think there's advantage and disadvantage that you do get some hard lessons along the way, which help you, but it's painful when you're going through it.
Yeah. So you're obviously independently trading today. Are you still involved with any of the companies that you started earlier on?
Well, we sold the employment agent, the executive staffing agency, to a national firm, because I wanted to focus more on, building a portfolio and trading. And, my goal was to start a family office hedge fund, and I did raise the capital to do that, and that was the plan. Unfortunately, I had some personal family issues come up, which prevented me from doing that. But I still right now trade, a fairly nice sized portfolio for myself. But yeah, right now I've divested myself of most of my other business opportunities. I do have some small, real estate ventures and things like that, but nothing that would actively take time away from me, watching the markets. Right.
Okay. Yeah, that makes sense. So let's dig into your actual trading method. Like, when someone asks you today, how do you trade? What's your approach? How would you describe it?
That's a great question. I would describe it as it's a hybrid. It's fundamentals with momentum, sentiment, and instinct. I can tell you that anybody who follows me on Twitter and is familiar with the way I invest and trade will know that I will never use a chart. I've never used a chart in my life. I've actually terminated people that worked for me that use charts, because I just think that they're not advantageous. So, I look at fundamental, momentum, sentiment, and just the basic instinct about what's going on in the markets to make a decision.
Okay. Now, obviously, I want to pick up on that point about charts and get you to expand a little more on that. And, I know from scrolling through your Twitter feed how vocal you are about using charts, or not using charts, I should say. Why are they not advantageous?
Well, let me get this straight. I mean, I think that if you use charts and you're successful, then that's what you should use. I would never tell anybody not to use something that is successful for them. Everybody to each his own. For me, though, and the way I see the investment community, I just think it's fool's gold and sort of like a crutch. When you could take a chart and fit basically any narrative that you want to that chart to be agreeable to your investment thesis, it's almost like fool's gold. You really can't buy into it. I mean, I can't buy into it. Anything that doesn't take fundamentals or events into account is something I just can't get behind. A chart is, and then, one of the other things with charts is when you see a lot of these folks on here, and to be honest with you, I'm in the strict minority. There, 99% of my Twitter feed for the people that trade and invest are people that use charts or technical analysis, and that's fine. I'm just trying to, show people that there is other ways to do it and be successful. When you're using a chart, most of the time you're waiting for a trigger point to allow you to get into a trade, or a trigger point that gives you an exit. And I have found that by the time those triggers hit for those guys, I've already either been in and out of the trade and done very well, or they have missed the best entry for the trade because they were waiting for a trigger. So charts aren't predictive. They tell you what's happened. But for me, I had somebody, tell me a chart that said, I looked at the chart that happened last week, and I was like, you look at the chart that happened last week, I want to try to figure out where the chart is going to be next week. So for me, it's just not something I find useful. And I think that it really takes away from traders being able to develop an instinct and a conviction in the market when they're so self-reliant on a chart.
Okay. So we're obviously going to go into this much more. Do you think this would be different if you hadn't come from an accounting background?
That's a good question. Do I think it would be different if I haven't come from an accounting background? I don't know. I just don't think that. Now, and I think a lot, some of them might have to do with personality or, the way our minds work. I just don't think that using charts to actively manage, especially in options. If you're going to trade options, charts you might as well put them in the shredder. Stock maybe one thing, but to trade options using a chart is almost it's impossible. But I don't know if I don't know if I'd say if having an accounting background has been something that made me look at charts as disadvantageous. I just think that it doesn't allow a trader to commit to something he may believe in it because the chart's not giving him confirmation of that, if that makes sense.
Yeah. And so we really understand where you're coming from here, what time frames are you trading? Like, what's your average hold time?
That's a great question. It varies. There are stocks and options I hold intraday. I'll buy in the morning, sell in the night. And there's long-term options that I will. Now, let me be clear. I have an options portfolio which I consider short-term. I have a stock portfolio which I consider longer-term. In the options portfolio, I rarely hold anything longer than 6 months. It could be as short as a 10-minute trade, rarely longer than 6 months, except in a few cases. And in the stock portfolio, it's really long-term, mid to long-term holds. So, I definitely have a split when it comes to investing. I look to the options portfolio to really deliver the beta to the overall returns.
Okay. So I guess my motive for asking that question was just to try and find out if you were trading intraday or if you were a longer term trader. Maybe fundamentals are more important for longer term trading, but you use, regardless, you don't use charts for any time frame you're trading.
No, I don't use any charts. I've never looked at a chart in my whole life. I mean, I've looked at them. I've never used them for any kind of analysis, or definitely never used them for a decision-making purpose.
Okay. And so the way you described charts and technical analysis is you can kind of fit whatever narrative you want to them. And I totally understand what you're saying there. But is the same not? Could the same not be said about fundamentals as well?
Well, I mean, think about it though. I mean, you have a chart in front of you, and they come up with these anagrams and these, cup and handle, head and shoulders, and different patterns that fit. But with fundamentals, you're dealing with changes in the business that are either good or bad, or changes in the specifics of a company that are either, good or bad. It's hard to take something we're restating our financial statements and turn that into a positive. Like you look at a company that just recently, like Hain Celestial, they came in after the market and said, we have to relook at our financial statements. There's really not a good way to look at that. The stock went down 25% after hours, and no matter what spin you want to put on that, it was a bad news. So I think when it comes to fundamentals, if there's something that's up for interpretation, like Apple's coming out with a new iPhone tomorrow, if you want to say you can interpret that as a catalyst for the company and say the stock's going up, or say that they aren't innovative anymore and the stock is dead money. Yes, that kind of fundamental you can. But when it comes to deltas in the business, the direct changes, whether it's specific to the company or an industry, whether there's, Chinese tariffs on steel or, oil with the Middle East. I mean, those things are more direct investable events.
Study
and play come together on a Windows 11 PC.
And for a limited time, college students get
the best of both worlds.
Get the Unreal College Deal. Everything you need to study and play with select Windows 11 PCs. Eligible students get a year of Microsoft 365 Premium and a year of Xbox Game Pass Ultimate with a custom color Xbox wireless controller. Learn more at windows.com/student offer. While supplies last. Ends June 30th. Terms at aka.ms/collegepc.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
What gives you actual conviction to execute a trade? Like, what's your decision-making process? Maybe if you could just sort of walk us through that, just give us an example maybe.
Yeah, I mean, so it's funny because a lot of the folks on Twitter are like, what do you look at on your screen? And you don't have charts, you don't have anything. What do you look at? And I have, my watch list on my left, which is probably 125 stocks. And I have an option matrix on my right, which shows me, options that are, trading, heavy, or, there's a lot of open interest and, volume. And then I look at level twos and volumes. Now, I don't use charts, but I will use volumes when it comes to specific stocks. And I think volume tells a big tale. So the one thing I look for, there's a few things initially that I look for in the morning. If there's a big initial move on a stock. So let's say a stock came out with a bad earnings report and it's down 20%. Immediately it goes on my radar and I have a decision point. Is this the bottom? Do I want to buy it here, or is there more left? And then I'll go through, I'll look at the volumes, I'll look at the options trading, I'll look at the encompassing, earnings report and do my own decision making, whether, the market's overreacting or is it something that is contained and isn't really company specific? and then I'll make a decision point based on that. So I'll look at things like sentiment. I love negative sentiment on a stock. It's definitely puts it, these are the things that put things on my radar: sentiment, momentum. If there's strong momentum either way, you've had so many stocks that have just been getting crushed, like Chipotle, recently has gotten crushed. Stocks like that. I could take you through a couple of trades I had and what brought me to make, some decisions points where, people told me I was crazy. But those are the things that I kind of try to point out when I'm looking first thing in the morning.
Okay, yeah, maybe if you could just walk us through a recent trade, just so we can sort of put it into context.
Sure. So one that I try to convey to folks that ask me is Freeport McMoRan. So this was a stock that got in the beginning of the year, January, February, end of the year, December, absolutely got obliterated. The stock was getting crushed. The debt load was enormous. It didn't look like they would, the debt service, they started actually being, there was a going concern issue here, whether the company would have to, be out of business. And when I looked at what they were doing in comparison to what, the street was clamoring, the fire in the movie theater, they were divesting assets, and the price of copper was actually increasing. So, the most of their money's made in copper and gold, and the price of copper was actually stabilizing and improving. So with the divestitures bringing the debt down, and the price of the assets that they actually sell moderating, I just didn't see how this thing was getting to zero. And, the stock was cratering. So I went in and I bought 125,000 shares at just under $4. I think it was $398, $399. And when I did it, and I tweet out all my trades. I'm a big believer in full disclosure. I'm not for the tweeting out a trade or speaking to people after you've made it, after it's been a great success and saying, oh, by the way, I bought XYZ, it's up 1,000,000%. So I did it as it was happening. And I got to tell you, I got slaughtered for it. And, at the time, people were, in the metal space, the oil space the commodity space was getting destroyed. But you saw, to me, the fundamentals of what was happening with the business and the company did not substantiate a company that was going to zero. So I stepped in, I bought, and things leveled out, and I got out of the trade somewhere around 12.50. Sometime, I don't remember the exact dates. I think it was March, April, May, sometime in that time frame, after a huge rally, and that's the kind of things that I look for when I get into a trade. Another one, was Wynn Resorts. It got annihilated. This is a stock that used to be $200 and something stock, and it was down in the mid 50s. And I was looking at the things, that were coming up. You had the opening of a new resort that was coming. It looked like, the earnings in the Macau area were starting to trough. And I said, it looks like we're seeing trough earnings in the fourth quarter, first quarter. I don't see a lot of downside here. But everybody thought, with the whole mess in China and, the regulatory crackdown on fraud and limiting their tables and things like that was going to be a big issue. So I stepped in and made a very big position and win it at mid 50s. And then it ran up to 100. It's a position I still hold, one of my largest at this point, but through an option play. So that's the kind of thing I look for when I'm going to step in in size into a position to make a trade.
Right. And when you buy into, like, just for these couple examples here, when you buy into these, when you take a position for these two examples, are you expecting to take some heat on those, especially because, as you said, the price is already moving down, but you think that it's going to rally in the near future? When you buy into that, are you expecting to take some heat on that and then it's likely to go down even further? Or are you anticipating that where you're getting in is going to be the actual bottom?
No. and I think that's, and we could discuss this. I think that's one of the biggest mistakes that, newer traders or even some intermediate traders make, is thinking you're going to buy the absolute bottom and, sell at the absolute top. I expect, and one of the big thing is you have to set your market band for what you're willing to accept on a downside and what you will sell at the upside before you enter the trade. It's not something you could set up once you enter the trade, because then you're emotionally involved in it, and you tend not to see things as clearly. When I enter a trade of that nature, I always have my parameters set up before I enter it, because I think it's important to have some control of your enter and exit strategies before you get into it, because then things can spin out of control, and you could end up taking a real beating.
Okay. Yeah, no, that's a really good point you bring up. Now, what are some of the news events or fundamental changes that get you most interested in a company? Like, are there a couple things that really draw in your attention?
Yes. Well, first things are things I deem transitory events. And what I mean by that is, I can give you a perfect example. The Ebola scare. When the Ebola scare came out, airlines got clobbered, some down 20 to 30%. I went in and I bought American Airlines hand over fist as much as I could, because when you see events like that I consider temporary events that will pass through and won't have a long-term fundamental impact on the business, but the market, the algorithms, the HFTs see it, and all they're doing is hitting the sell button. That's the first thing I do. I go in and I buy as fast as I can, as much as I can. It's events like that that really give me the impetus to get involved in something. I love events that I see like that when I know it won't be a lasting effect on the stock.
Now, just going back to what you said at the very beginning, going for companies that you understand, going for companies that you maybe like on a personal level, how much do you really care about the companies that you're trading? Like, are you going to avoid a trading opportunity just because you don't know the ins and outs of that company, or you've never used their product? Are you going to avoid a company like that, even though you might see something standing out in their books? Like, can you just tell us a little bit more about how you choose what companies you're going to trade?
Well, yeah, I mean, it really depends what we're talking. If we're talking about buying the stock for a long-term investment, I tend not to get involved in companies that I don't really understand. Like for instance, I'll never directly invest in a Chinese company, whether it's Alibaba or Baidu. I won't directly invest in it because I don't understand the way the government works over there. And at any time, they could just clamp down, shut down a business. They don't have the same accounting principles, even though they're audited by American firms. If it's something I don't want, if it's something you're going to wake up in the morning and they're going to be like counting scandal and it's not really going to surprise you, then I don't want to be involved in it. So I will never directly invest in, long-term in a stock like Alibaba or Baidu or, any of those companies, that have a direct China link. So now, will that mean I won't trade in and out of them if there's an event? No, I would. But it would be a short-term trade, and it would be based strictly on, some of the things I see, whether it's an event, severe downward momentum, but it would be a quick trade and something I wouldn't hold long-term. So when it comes to, companies that I like, I mean, just because I like a company, it doesn't mean I'm always going to invest in it. But if I understand it and the business they're doing, then it's something that I would invest in maybe long-term if I saw the growth prospects. But, as far as options go, it's fair game. Any company that pops into my radar that might set something off, I'll trade around the position. there's no limits there. But yes, there's definitely, when it comes to a mid to long term hold, I would never invest in a company I didn't understand the dynamics of either the government, the business they do, or the markets they're in.
Right. Okay. So I guess a good question to ask you would be, once you have an outlook, how do you actually time that trade to actually get into the market? Like, how do you actually get exposure? How do you time that? Are you all in and all out, or do you layer into a trade? Speak to us a little bit about your actual timing.
Well, yeah. So the timing for me is, once I decide to enter a trade, the timing, the level of intensity that I enter the trade is based on my own conviction that I have for it. So, for instance, we could take one this week. Apple pulled back a little bit, and I saw that, going into the event, Apple usually runs up and then sells off. And I took a fairly nice sized option position right off the bat. I entered 100% of the position. The stock, and I had my price target set up mentally where I wanted to get out. And as the week went on and the stock went up, I layered out of that position. So I sold half, then I sold another quarter in the morning today, and then I sold the final piece of it this afternoon, and I rolled into a more leveraged, smaller position for Apple. It depends what I'm waiting for as well. If I'm waiting for a specific event, that's pretty much an all or nothing binary event, I'll probably go 100% into the position. If it's something I'm waiting to see play out, then I'll layer in slowly, but I'll always have my exit points. You always have to have your strategy before you enter these trades, no matter, whether you're layering in, going at 100%, and your exit points as well, because like I said, once you're in the trade, the markets can get a bit hairy, and then everything kind of goes haywire. So based on whether there's an event coming and my level of conviction is how heavy I layer into the trade on the outset.
Okay, and just while we're still talking about entries here, what do you do when price action doesn't support your views or your outlook?
And that's a great question. I just covered this in one of my periscopes with Win, where I entered the trade post earnings and at like 90, 91, 92, and it ran all the way up back to 100. And I added in some more, and then the stock is pulled back all the way to the low 90s. And I said, this is my most difficult decision in my personal trading realm, is when the price action doesn't match the conviction that I have for the trade, and then you have to then you're at a decision point, and you really need to decide whether you were just wrong, and hubris will kill you. I say the 10 trading rules are: don't be arrogant, 1 through 10, because that will kill you. So you're just wrong and it's time to exit. Or can you set up another strategy around the new price action if it's a trade you still want to be into? So the beauty with options is it's not just a buy or sell decision. There are other things you can implement in the options market that allow you to stay in a trade, but will protect you to the downside while also allowing you to participate in the upside, which is good. So, that is my most difficult challenge, is when the price action doesn't meet my conviction. I have to actually, that's my biggest decision point when a trade comes.
Okay. And so, you've talked about both here, stocks and options. How do you decide when to trade which, whether you're going to trade stocks or whether you're going to trade options on any given position? What's that come down
to? Two decisions. It's 2 points: length of time and risk of capital. So if I want to get involved in a company and I'm really not sure what the timeline is going to be for that company for what I see happening, then I get involved in the stock. Because I'm not sure. With options, you have a decay. It's a time value of money. So they decay over time. So you're going to, even, if the stock stays flat, you're going to lose money. So time is a very critical factor. If it's something I'm not sure about, I'll just buy the stock until I feel more comfortable with the timeline of what I'm expecting. There's certain events on the calendar, like earnings, a new iPhone event, things like that you can plan around. But if you just like a company and you like the way it's been acting, you like the things they're doing. For instance, NVIDIA. I got involved in NVIDIA at 44, and I really wasn't sure, what the trajectory of the company was going to be. I just know that I liked the things they were doing, the sectors they were getting involved in. So rather than buy the options, I just bought a big block of stock, and I sat with it, and it ran up to 60, low 60s, and I got out. Which hindsight, if I would have been in the options, I would have made 5-10 times more. But I really wasn't sure of the trajectory, and that comes back to the risk of capital. How much capital am I willing to risk in this trade? Options give you very limited risk. As far as what you're willing to put up, that's all you can. You buy X amount of an option, that's your maximum risk. But with a stock, you don't know where it could go. If you buy $10,000 of an option and it goes to zero, you lose 10,000. If you buy 10,000 shares of a stock and it drops 20 points, you could lose 20 times that. So, what I'm willing to risk and the timeline I have for the company are the two factors I use to decide options versus equity.
Okay, yeah. And while we're talking about options here, are there some things that are often not discussed about options, but you feel are important to know? Like, is there anything you'd like to tell listeners about options which you think are really important to know, which are probably less discussed?
Yeah, I mean, options are, very when people really start learning about options, they think it's a get rich quick kind of way to make a lot of money fast. And if you get it right, yes. But, when you're dealing with options, you have to get a lot of things right that you have to get with stocks, but you have to do it in a limited time. You have to get direction. You have to get, velocity. And you have to price it right. So anybody who gets involved in options, I say start very small. Don't think, you read about, you see on CNBC, you see a lot of the option guys talking about, how you can really use leverage to make a lot more money. But what they don't tell you is, 80% of out of the money options expire worthless. So, it's a dangerous game if you're not careful and you don't understand what you're doing. There's a lot of factors involved that you have to be more right than if you bought a stock. You actually have to be more right on things at buying an option than you do a stock. And it can really eat through your capital very quickly if you don't think it through, because there's no recovery time, so to speak. If you buy options before an earnings announcement and they miss, your options are zero and they ain't coming back from that. Whereas if you buy a stock and they miss, you're going to take a big hit. But you can now hold the stock ad infinitum, for 2 years and it might come back. So, it's the risk reward balance that, folks need to get a handle on before they get involved. It can really destroy a portfolio.
Yeah, okay. And one thing I know you're really big on is actually hedging your positions. Would you be able to tell us a little bit more about how you go about hedging positions and when you hedge, why you decide to hedge, that sort of thing?
Sure. So hedging, now you got to understand that unless you're in cash, hedging is considered to me a position. It's actually considered a trading position. So and you really need to understand that when you do it. So that being said, I rarely hedge my stock portfolio. Like I said, that's a very long term in duration, and it's something that a lot of the companies in there are old school tech and dividend payers, so they're not really things that I would look to hedge. The options portfolio is a completely different story, and I think it's something that needs to be discussed. I've always said that for every $16,000 in long calls or long leveraged options, you should have $1,000 hedged against it, whether it's in, direct market puts or covered rights or things of that nature to pull some capital off the table. When you get to a point in the market like this where you're near all-time highs and you got a lot of events coming that can be very sketchy when the markets come, like the election, you have the Fed decisions coming through. There's no need to not have protection on there in case you get a big swoop down, which is what I do. I bought some SPX puts against my whole options portfolio. So if we get a big dip, at least you have some protection. Now, a hedge is not supposed to offset 100% of your losses, but it's supposed to mitigate some of the risk that you're taking. And when I do that is when I feel there's a lull and lack of a catalyst in a market. So it opens up a vacuum for where things could get sucked down. It doesn't seem that way. It seems that all we have are buy the dips, but it's definitely, I always try to keep some sort of hedge on my options book.
Right, and that ratio you talked about there of 1 to 16, is there any kind of science behind that, or is that just something that you feel comfortable with?
The science, it's something I've used for like 25 years. So I've tried to find a balance where, you don't want to put on a hedge too big that it actually, my whole theory is that if the market drops and your hedge actually puts your portfolio in the green, then you're overhedged. And if it doesn't materially skew any losses, then you're underhedged. So it's just a balance that I have found over time, given the different swings in the market that I'm comfortable with, that has worked as far as risk of capital versus the hedge. What seems to balance out, and not really overtake the strategy that you have. If your strategy is long, then you don't want a hedge that's going to be overbearing on that strategy. And that's just, numbers that I've, used through the years that have seemed to give a good give and take balance to that.
Okay. And for options traders who are hedging, does this become an advantage once your account or once your position sizes are over, X amount of value? Like if you're trading a small account, let's say $10,000, is there any benefit of hedging your positions, or does it become more beneficial when you're trading, let's say $100,000 and upwards?
I would say that, if you're dealing with an account that's fairly, on a smaller scale, I would say that your position should be smaller and that the hedging benefit is diminished. Yes. If you're going to enter a $2,000 trade, I would say the benefits to the hedging that position are diminished. But there are other ways to do it. You can enter a call spread. You can, sell upside calls or, sell puts. There's other ways to hedge without directly going against your portfolio. And yes, in a smaller size portfolio, I would make my positions a lot smaller and probably not hedge them out of the gate. Now, if those positions run higher and you're getting, 20, 30, 40% return on that, you're either going to take down that position or I would hedge that strike. Absolutely.
Okay.
But I would do that I would only do that once, I've had some gains in the position.
Very good. Okay. Now, I guess the last part of it is the exits. So, this is something you said earlier, is you need to know your exit point before you even get into a trade, which is an excellent point. How do you determine your exit targets?
So when you're getting into a trade, you have to think about a couple things. One, why are you getting into the trade? What do you expect from the movement, and where are you buying in? So when I say that is, when I'm forming a trade in an options trade, and we'll go through, I'll take you through the Apple trade. The stock was in the 105-ish area, I believe, and I wanted to get involved. So I looked at something that was slightly out of the money with a 106 calls, and I said, All right, now what do I expect to happen before the event? And what price point would I be comfortable with getting out and taking my gain? So I looked at some of the some of the options that were played, and there was some heavy movement in the 110 calls. So I said if I'm buying these calls at, I'm trying to remember where I bought them. Let's say, for an argument's sake, I bought them at $1. If these options get to $2, I'm out. You set that prior to going into the trade. If I double my options, I'm out. Now that's just, a round number and just so easy to use, but it might not, I might say if I get to $1.40, I'm out, a 40% return. So the parameters are mostly based on the option price, not so much the price of the stock. Obviously the stock's going to have to move a little bit more to get the options to move, higher. It's not always a one-to-one rate. It's not a one-to-one ratio. But you have to be comfortable with what, and that's the big, one of the other things with new traders is, they fear of buying too soon or selling too early. But if you set your markers up early before the trade, then, you just don't look back. You execute and move forward. Executing what you set up for yourself is very, very critical.
And are you always, is there ever a point where you may just take partial profits at your target and leave some on if you feel as though there's a chance that the price may move more in your favor? Are you ever going to leave part of a position on?
Yes. I mean, I call that the free roll. So basically, I'll take off the majority of a position, say 80%, and I'll hold 20%. And basically I'm, playing with house money at that point and see if it can run a little more. But you're playing with, you're at a much smaller size and a much smaller risk, but you still leave yourself some upside. On the flip side of that, let's say you buy a company at 100 and it runs to 109. You could sell out of the money calls against that position and take off a lot of the money and still give yourself 3, 4, 5 points of upside to participate. So yeah, there are times if I still feel it hit my trigger point, but I will always take money off the table when it hits those points. I'm never going to say and let it just blow through there and say, all right, we're just going to let it go. When you have to be strict with that, because too many times, especially in options, the market gets fluid and the market gets fast, and you could quickly go from a nice gain to a severe loss. So yeah, there are times I will let it run, but it will be a much more finite amount of money and a much smaller risk.
Yeah, sure, okay.
Absolutely.
Now, just a couple, I guess you could call them general questions that I'd like to ask you.
Sure.
What do you think it is specifically that's made you a successful trader? Like, what does it boil down to? Is it your persistence? Is it the time you've dedicated to this? Is it your strategy? Like, is there anything you think that's really contributed to your success as a trader?
Yeah, I mean, I think the biggest things that contributed to my success are, getting up off the mat, and getting through a bad trade or a losing trade or taking a loss, that is very important. And getting through that mentally is key. Being able to figure out what went wrong and to put your hat back in the ring is key to my success. And the conviction. I think, there's so much news out there and so many people with so many differing opinions that you have to have conviction in what you're buying and what you're doing. And don't let a pundit or some guy on TV or some Twitter, quote unquote expert tell you that that's a bad trade, or you're not, you did it too soon, or there's better alternatives. Having conviction in what you're doing and being able to see it through is very important because, as I've always said, playing with scared money, you've already lost. If you step into a casino and you're afraid to death to lose at the blackjack table, you've already lost before you've sat down because you're not going to play. You have to have And I think that is the two things that allowed me to be successful and continue to this day.
Mm-hmm. So taking hits and being able to keep moving forward and conviction in your actions. I like that. What are the biggest mistakes you see developing traders make? I know you're very active on Twitter and you engage with a lot of your followers. What are some of the biggest mistakes that developing traders make?
A lot of things, fear, fear of losing, fear of, ridicule, fear of getting in a trade at the wrong level, that they might have bought it too soon or sold it too early or late, and not believing in what they're trying to accomplish. They seek advice from so many people, which is fine, but at the end of the day, you have to make your own decisions. And when you finally do decide to make that decision, I'm hoping that there's a basis for it, and you have a list of reasons of why you're doing it, whether it's a chart or you feel good about what a company's doing. Being able to follow through is something that I find that a lot of the folks are having trouble with. And, right sizing the position is another issue that I see a lot of traders. You can have big wins with, less capital invested, but you can only have big losses if you take big positions. So, being able to right size the amount of capital they're willing to risk on a trade, given what they're trying to accomplish, is something I think that they can definitely work on to be better. And unfortunately, it might just come through making their own mistakes and learning. But I try to tell all the folks on Twitter, believe in what you do, believe in yourself, follow through. Don't let myself or anybody else tell you that, your trade's no good. If you think it's something that's worthwhile, then see it through. But I think that fear, conviction, and position sizing are three of the things I find that, are a bit of weakness on the trading end. Yeah.
That's a really great answer to take us out, Craig. Where is the best place listeners can go to find out more about you?
I'm on Twitter, Craig Scott 31. That's probably the best place. I mean, I'm very, I try to be as active on Twitter, whether the follower is big or small. I try to answer every question. I tell them there's no stupid questions. Just come at me. I'll try to give you the best information I can and direct you, where to go. And, they have my, if they DM me, I give them my email, that, I'll give them my phone number. If they want to, bounce some ideas off me, I'm always open to do that. And, I'm trying to, I try to help them as much as possible. I try to give back as much as possible.
That's awesome. And it's very cool that you're willing to help out like that. So that's very cool of you. And you're also on Periscope as well, right?
Yeah, I do a lot. I try to do a weekly Periscope on Thursdays. I'm calling it Trader Thursdays, where, we'll take the events of the week or things that might be coming up and discuss them, and I'll give my viewpoints. And then I try to take questions from as many, lately we've been getting some very good viewership on the Periscope. So I take as many questions as possible. I try to answer them all. If not, then they shoot me a tweet or a DM. But yeah, I try to do a Periscope every Thursday morning before the market opens. It varies in time, some 8:15, between 8:30, but I'll give notice about when I'm going to do it. And I'll also put the topics that are going to be up for discussion. And, if there's any questions, I try to field them and get to as much as possible. But they've been the Periscopes have been very good. I've gotten some good feedback. So it seems to be working out well with that.
Yeah, no, they're excellent. I watched a couple before we jumped on this call. How can someone follow you on Periscope? Do they need your handle, or do they go to a link, or what's the deal?
No, yeah, I mean, I think my Periscope handle is the same as my Twitter handle, Craig Scott 31. So if they just go to Periscope, and just type in Craig Scott 31, they'll see me and they can follow me. Or, they can follow me on Twitter and they'll see, when my Periscopes go live, that they'll say, the Twitter will say, Craig's doing a Periscope, and they can definitely hop on board. It would be, great. And, whatever they needed to help with, I'd be, glad to try to help them out.
Awesome. No, that's really cool. Well, Craig, I got to say, I really appreciate you coming on the podcast, man. It's been a lot of fun. Thank you very much for doing this.
Oh, it's been great. This has been great. I enjoyed myself very much. And, if you ever, need anything, be sure to reach out, and I'll be glad to go back to you.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What if one decision could drive more purchases, higher revenue, and lasting loyalty? It can. Rewards lift conversion rates by up to 30% and grow spending by over 20%. That's a fundamental change in how your business performs. BHN delivers gift cards and digital incentives that motivate people at every stage of the customer journey, turning everyday interactions into measurable results. The numbers consistently outperform discounting, and the proof shows up in your bottom line. Visit BHN.com to learn more.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
LinkedIn is pretty amazing at helping you grow your small business. We cannot stop your new clients from emailing you at 3 a.m. We can help you sell, market, and hire in one place. We cannot help you be in 3 places at once. And while we can't help you organize your calendar, LinkedIn can help you land more clients so you have a calendar to organize. Grow your small business on LinkedIn. Learn more at linkedin.com/smallbusiness.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
All right. Hey, team. What's up? How you doing? Just before I even introduce you to my guest this week, I want to say real quick, thanks to everyone who made it out to the first ever Chat with Traders get-together on the weekend here in Brisbane. It was good fun and really awesome to meet a bunch of you in person. I actually hope to do something similar in Sydney and Melbourne sometime soon too. Anyway, I just wanted to mention that briefly, but for this episode, I spoke with Dario Mofardin. For some background on Dario, he went from a finance degree straight into a market analyst and then trader position at a private global macro hedge fund. He then went into investment banking for 13 years, working with mergers and acquisitions from various locations around the globe. And since 2008, Dario has been trading independently, but has recently begun trading external funds also. Some of the things we chat about during this episode include how to build a body of evidence, seeing the whole board as a global macro trader, why Dario went from short-term trading to higher timeframes, plus trade management and trader checklists too. Full show notes for this episode can be found at chatwithtraders.com/92. Right, well, that's enough from me. Please welcome Dario Mofardin. Well, Dario, thank you very much for coming on the podcast. I've been looking forward to this for quite some time. Last time we spoke, it was snowing down at your place, so I presume that's all cleared up by now?
Yeah, it has. Unfortunately, it looks like the ski season is pretty much over.
Ah, right. Do you do much skiing?
When I can, absolutely. Absolutely.
Okay.
That's why I moved up here.
Yeah, I saw that. I was just scrolling through your Twitter feed before we jumped on the call, and I saw you posted a pic quite recently up skiing somewhere. So, of course.
That was up at Thredbo. That was the pre-Yellen market chopping. So.
Okay. Nice. Well, anyway, we've got plenty to discuss, so let's just jump right into it. I'd really like to start with how you came into trading. Like, share with us a little bit about your introduction to this business. Where did everything kick off for you?
Okay. I guess my real introduction to trading was straight out of university. I did a business finance degree, and my first real job, I suspect, was with a private investment house called Portland House Corporation. They're a family-run, family office, effectively a hedge fund based in Melbourne. So the owner, David Haynes, and the Haynes family run that business. So I was recruited out of university as a market analyst / trader for them. So that was my first taste of trading. The way they go about their business is they effectively a global macro hedge fund. So that was my introduction to the people they invested in, like the George Soroses of this world, Paul Tudor Jones. They also gave me, I guess that was my first exposure to understanding global macro overlay and then understanding technical analysis to trade those global macro views. They were followers of Robert Prechter, who's kind of the godfather of Elliott Wave. And that was my first introduction to kind of the Elliott Wave theory, how to apply it, the philosophy behind it, and the idea of herding and market behavior. So that really resonated with me. I'm quite visual, so charts to me and pattern recognition make sense. And to have that price overlay over a macro view, I think was a great introduction. So I worked for Portland House for about 2 years, did my MBA in Melbourne as well. And after that, I actually left trading to become an investment banker. So I worked in mergers and acquisitions for about, I guess that was from about 95 till 2008. So 13 years I worked in mergers and acquisitions. And the reason I did that was really to get a broader perspective of markets, global finance. It really gave me a good insight into how the capital markets actually worked, the nuts and bolts of raising equity, raising debt, M&A transactions, and it enabled me to see the world. So I worked in, Sydney, New York, Singapore. So it gave me an opportunity to really understand how the decision makers went about running their businesses. So I advised a bunch of kind of corporates and governments as well. So that gave me an idea and an understanding of how they make decisions in in the global markets. So that was a great learning for me. I worked mostly at Morgan Stanley and also at Merrill Lynch and Lehman Brothers. So that gave me a great understanding of how the markets and how the world worked. So after initially trading for a couple of years, did that for about 13 years, and then decided to start my own trading business full time. So that was in 2008.
Right, okay. So let's pull that apart a little more. I mean, just going right back to the very beginning there, when you did your finance degree, I mean, why did you choose to do a finance degree? Was getting involved in markets always something that you wanted to do from a younger age, or was it just kind of a last-minute decision?
No, it's something. I've always had a passion for the markets, and it actually started just as I finished high school. A friend of mine whose father was a trader, and so I think as soon as I was old enough to open a broking account at the age of 18, I basically started trading. And we were trading, penny stocks, we were trading futures, not really knowing what we were doing, but I guess the fascination for me was really understanding how the global markets worked. So that was at the ripe old age of 18. So that focused me on what I wanted to do, what I really wanted to do, and that was do a finance degree to upscale my learning and really understand how the markets worked. So to me, it was always an intellectual exercise, I guess, at first, just trying to solve what I think is the three-dimensional chessboard, which is global financial markets. So that was my, first introduction, trading for myself, not really know what I was doing, making all the mistakes that a new trader does. But it gave me a real taste for and a passion for the markets, which I've had ever since. And it was interesting, one of my finance lecturers was an ex-bond trader. So that was, we would talk every day just about markets and his experiences and his learnings. And he was the one who actually got me introduced to Portland House in terms of once I graduated to actually apply and to learn even more.
Right. Okay. So what sort of success did you see in that first, year or two when you were trading penny stocks and a whole bunch of futures as well? How did you do? Did you do all right, or was it a bit of a fail?
No, I did actually really well. And I'm not sure if it was luck or whatever it was, but I actually, for the first couple of years, did very well. I joined Portland House, and I actually had a very good track record. They initially hired me as a market analyst, and within 6 months promoted me to a trader to trade the SPY here in Australia and also FX. So I actually built quite a strong track record, and they quickly identified they had good risk management. I could read the markets really well, and actually built up quite a good track record there.
Okay, and just so I understand that right, your track record that you had built up, that was in those first 6 months you're working with the firm, or in your personal trading before you started with them?
Both. So I did quite well trading for myself, and then with the firm did very well in building up. I had an allocation given to me back at the time when I first started, and my returns are very strong.
Okay, so what was your thought process before you joined this firm? Like when you were trading the penny stocks and futures, I'm just trying to get an idea of how you first started out approaching markets. Like what was your thought process for deciding which penny stocks or which futures you were going to trade?
It was all chart-based, and it was all pattern recognition-based. So I didn't have a formal platform to learn from. I didn't have the structure I've developed since then, but it was really chart-based analysis in terms of support resistance, following the trend, very, very simple. But the advantage was at the time we're in a bull market. So, I participated in a lot of junior IPOs, and it seemed very, very easy money to make. And it was because we're in a bull market, and I never went short. I was always long, and so I was on the right side of the market. I'm not sure how that system would survive over time, but it just happened to be fortuitous. We were in a very strong bull market at the time.
Okay, yeah. So how did your finance degree set you up for when you started working at the private fund? To what extent was that useful or unuseful in any way?
It was useful in terms of the finance courses, understanding financial products, understanding the flow of capital, understanding global macroeconomics. So all of those learnings assist you in terms of understanding how the world works. Now, from my perspective, at the moment, I'm a global macro discretionary trader. So I start with a thesis of where I think the global macro environment is. What are the key drivers? At the moment, it's the Fed and so forth. But doing the degree helps you build a background in understanding what are futures, what are the FX markets, how interest rates in different countries impact currencies, and the relationship between, currencies or the bond markets and the equity markets. So getting a basic understanding and a formal education into how different products and different flow of capital worked, I think was very advantageous. So it gave me a strong foundation of actually understanding how markets worked.
Okay. And then, so you just started this private fund You had your finance degree. Was there any sort of training provided by the fund you'd started at? Did they teach you the ropes, I guess, more on the trading front in any way?
Yeah, and that was more learn by doing and learn by observing. So I got to work with Stephen Haynes, who was the founder's son, who was a bond trader for many years. And so just seeing how he operated and seeing how, as being part of the investment management committee, understanding how decisions were made and understanding, trade risk reward, risk management, and really being disciplined around that aspect. That's what I really learned there. And it wasn't a formal education as such. It was more education through observing and seeing how they went about doing their business.
Yeah. Okay. Up until this point, it sounds as though your trading path had been quite smooth sailing, if you want to call it that. Was there anything that was particularly challenging for you? Was there any obstacles you had to overcome up until this point?
Not really. I think I was quite fortunate in the markets I was trading, and I seemed to have a reasonably natural intuition about pattern recognition and observing the markets, and a good understanding of kind of how things worked. The real education for me came when I started trading for myself, and that was the realization of hubris, not realizing that doesn't always go your way, and when you're actually trading your own money, the psychological aspects around that, and trading for a business, I think that was where I started to be more aware of the challenges. And I was quite fortunate in my first year of trading for myself. I had a stellar year, and that set me up very well. And the pride comes before the fall, because the next year I pretty much gave most of it back, because you think you know a lot more than you do. You trade too aggressively and too much size. So that was the real start of my education, I think. My real trading education about position sizing, risk management, your own psychology, and really understanding the nuts and bolts of trading.
So you went out trading on your own, as in set up like a proper business to trade for yourself. I think that was around 2008. I think you actually mentioned that earlier.
Yes.
Up until that point, like obviously between leaving the fund and starting to trade for yourself as your own trading business, you were an investment banker. I mean, what sparked the decision to leave the fund and go work as an investment banker? Where'd that come from?
I think the reality was I was quite young when I was at the fund, so I was in my early 20s, and I felt, while successful, I felt like I was just going to the casino every day. And I don't generally gamble. So to me, it just, I guess the best way to put it was that, I needed some more, I guess, grounding in what I was doing, because it felt like I was basically at the casino punting every day. And while successful, there was not that satisfaction as in terms of, understanding why you were doing a good job, understanding why you're actually good at this. So what I wanted to do, and I did an MBA because I wanted to get a deeper grounding in the fundamentals of capital markets and the fundamentals of decision making. So that was the main reason I went to investment banking, and to get a real formal education and formal real life experience in how the markets worked, how the capital markets are created, how they operate, and how the decision makers work. Because I think that, and working with clients such as, Gillette, Schlumberger, KKR, these guys, it really gives you insight as to how decisions are made from the corporate level, and that obviously flows into how the capital markets operate.
Okay, and now having done 13 years as an investment banker and having worked with, these clients you mentioned, did that make you realize and answer the questions that you were asking, like, or answer the questions that you were asking, as in, like, you know, you didn't really understand why you were good as a trader, why you were successful at it. Did that answer those questions?
It went to some degree, yes. And to some degree, it was about just gaining your own confidence and getting a formal education as to seeing why you saw what you saw. So, yeah, it did. But the real education, as I said before, really starts when you actually trade, and you trade full-time for yourself or for someone else. And really, that's where the rubber hits the road, I think. And that's where the real education comes into it. So was it required? Probably not. But it certainly helped doing things like just building your own experience base, but also help build, you know, the advantage of being in that industry is it helps you build a capital base where you can go out on your own, have your risk capital, and be able to trade.
So tell us about what you're doing today. You know, you started your own trading business in 2008. What exactly does that look like? What does that involve? Are you trading outside money? Give us a bit of a rundown on what you're doing today.
Well, for the first 7 years, I was just trading my own money and, you know, global macro discretionary trading. About 2 months ago, I set up an incubator fund. So I am now trading external money, external capital. It's a small fund, but it's really about, it's for professional, sophisticated investors and institutional investors. So I now trade external money. The fund itself is a global macro discretionary fund. I trade, you know, futures, commodities, foreign exchange, bonds, and it's really about leveraging my edge, which I think over time, it's really about the ability to synthesize global macro themes combined with market analysis and a price overlay to really create great risk-reward setups. And to do that, knowing that and build an experience over time, knowing that markets are probabilistic, so you need strong risk management. So that's what I'm doing today.
Absolutely. We're going to dig into that much more very soon. I'm curious though, what led to the decision to take on investors' money?
The real decision was around it's leverage, and wanting to build leverage. So while I was very comfortable trading my own money, I wanted to actually experience trading outside capital. And the main reason is because I think I have quite a talent at doing this. So to be able to leverage that in size, it will enable me to build up capital base, which will enable me ultimately to build my own hedge fund. So that's the reason behind it. And the reason you set up an incubator fund is really to build the track record, build it over time. It's auditable, it's clear for everyone to see the results, and it makes you accountable. And I like the idea of it being accountable and being transparent.
Totally. No, that's a really good answer. And, you know, I'm always interested in the reasons why people want to sort of scale up their trading business. So I really like that you're doing that. Hopefully I'll be in a position to do that one day also. So, you know, you've described this fund as being a global macro discretionary fund. I mean, if you could you just dumb it right down and explain exactly what that means? I guess just sort of summarize the type of trader you are today. Like what is that? What's that look like as a trading methodology?
Okay. I guess the best way to put it, global macros. So you start with a top-down investment thesis. Now, whether that is a Fed-driven or interest rate-driven or currency-driven thesis, or whatever your basis for understanding how the capital markets work, whether it's demographics, basically a big picture of where we are in the world, and understanding where the risks are, and therefore where the opportunities are. So I start with a top-down macro approach, you know, global capital flows, where the markets are heading, what they've been doing, and then I overlay that on what I call building a body of evidence. So you create a big picture thesis, and then you build a body of evidence with charts, with analysis. And I use primarily Elliott wave theory, Fibonacci clusters, multiple time frames, and combine that with intermarket analysis. What I often tweet and tell people who I speak to regarding trading, it's all about, for me, it's about seeing the whole board. And by that I mean understanding, getting a whole picture in your head as to where the markets are in terms of interest rates, currencies, equity markets, and commodities. And building that awareness of where the markets are, I think, enables you to trade where the flows are heading rather than where they've been. And in terms of how I trade, it's really about, and I think it was Stan Druckenmiller basically said, the way to build long-term returns is through, firstly, preservation of capital and home runs. Now, historically, I was much more of a short-term trader, but over the last kind of 12 to 18 months, I have morphed myself into a more position trader and swing trader, where you leverage into positions where all the stars align. So the whole idea is waiting for the fat pitch, not taking every trade, making sure that you are patient and you sit in the batter's box and you wait for the fat pitch. And when you see that and all the stars align and the macro is supportive and the charts are supportive, then you lean heavily into a trade.
Study
and play. Come together on a Windows 11 PC.
And for a limited time, college students get
the best of both worlds.
Get the Unreal College Deal. Everything you need to study and play with select Windows 11 PCs. Eligible students get a year of Microsoft 365 Premium and a year of Xbox Game Pass Ultimate with a custom color Xbox wireless controller. Learn more at windows.com/student offer. While supplies last. Ends June 30th. Terms at aka.ms/collegepc.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
Okay, so would you mind explaining a little more as to your reasons why you were, for most of your career, being a short-term trader, but in the past couple of years, you've, as you described it, morphed into becoming more of a longer-term trader, where you're now swinging trades and taking position trades. Why did you leave the short-term trading behind?
I was reasonably successful at short-term trading, but what I found it actually distracted from the bigger picture money-making opportunities. So you would become so absorbed in the short term, and you're taking short-term swings, and you're following all the rules that everyone tells you. So, you don't risk more than 1% of your capital in every trade. You take profits as early as you can, and you basically grind your way through trading. And I think it was Jack Lytle, who you've interviewed before, who said, that it's the concept of the grinders, where you're trying to just grind out money every day. And what I found was, while that was reasonably successful, the downside is it took your focus away from the real money-making opportunities. And that is where you see, and my analysis and the way I think about markets is, you see major turning points and the ability to leverage and to really lean into those turning points, because you go from grinding away and you kind of make a % here or a couple % there, and you lose a % here, and you're kind of just incrementally growing your account, versus seeing an opportunity where and accepting that the reality is, a handful of trades make 90% of your income for the year. So you end up with a trading system which I found I was more comfortable at, which was leaning into strong conviction trades. And then what ends up happening is you make far more, but the returns are lumpier. So, 90% of your profits come from 10% of your trades, which is, a very different approach to trading. So that actually, what I felt was that people often talk about trade your personality. That was the realization where that was my personality. That suited how I looked at the markets. It suited how I traded, and it suited my objectives, my trading objectives.
Okay, and part of the reason for this realization, do you think that you were initially always looking at the bigger picture, but you were trading very short-term trades?
Yes. Yes. That's so it ends up being not wasted as such, because you're still trading the markets as such. But what you're doing is you're trading the first 5% of a move, and you're missing the bigger picture. Because I've never really been a trend follow trader. I've always been more of a contrarian, counter-cyclical or counter-trend trader, because that also suits my personality. When the herd is running one way, I am more than often trading on the other side of that. So that's where unlike most people who trade trend traders and so forth, I am often on the other side. So I like it when people are leaning into one side of a trade, and I like the opportunity set when I get the right setup to go against that.
Do you mind just explaining that a little more? I mean, this is something we often hear, and I think especially for newer traders, that's probably a little bit confusing and sounds quite strange, because obviously when the herd's running one way and price is moving, let's say it's moving up, you're looking for a short opportunity. Is that what you're getting at there?
Yeah, and it's about when the trend is extended. Now, you don't do that in the middle of a trend, and that's where Elliott Wave helps me in terms of, and the work I do with commitment of traders, the work I do with intermarket analysis is look for trend exhaustion. So the idea is to create a structure and a price structure where you identify exhaustion points and key market reversals when the traders are looking the wrong way. So it's not about shorting for the sake of being short. It's not about going long in a declining market just because you want to be counter-cyclical. It's more about identifying where the opportunities are, how the traders are positioned, and what do the charts tell you.
Mm-hmm. Okay, so you're more sort of looking at points where there's a high probability, or you're anticipating the trend is exhausted and there's a turning point that may be about to come in.
Correct.
Okay. Now, just going back to your response from a couple minutes ago, you described the longer term approach as giving you lumpier returns. Can you just explain why that's the case, like why that happens?
The reason it happens is because waiting for the fat pitch, the trades don't come along very often. It's only a handful of trades a year for me, for example. And in the meantime, I do a fair bit of shorter term trading just to keep in the flow of the market and keep the P&L clicking over. The reason it's lumpy is because when I see an opportunity that I really want to lean into, you add to the opportunity, you actually pyramid into the trade, which ends up increasing your exposure. So as markets become more volatile, as the position gets bigger, you end up getting lumpier trades, lumpier P&L. So you continue to manage your risk to an X% of your capital. But what you'll find is as you moving into a trade and as it develops, you're actually adding to it, pyramiding, and that creates more volatility in your P&L. Because the corollary to that is you do smaller trades, you take profits, you take very small losses, and your P&L is far more stable because you're not taking as much risk.
Okay. So just so we're really clear about how you're trading, what is your typical hold time for, any given trade that you might take, these days?
So position sizing, position trades are usually weeks to months, and shorter term trades or swing trades are usually days to weeks. So it's very, very rare nowadays that I do an intraday trade.
Okay. All right, well, let's narrow in on Elliott Wave. I mean, this is something that we haven't really discussed on the podcast in the past, and, I know it makes up a big part of your trading. Talk to us about, what does Elliott Wave show you? Like, what's the purpose of using this particular form of analysis?
It creates for me a framework for how I think and what resonates with me of how the market actually moves. And the market moves in waves. So the concept of Elliott Wave is really about motive waves and corrective waves. So basically the trend, which way is the trend and where are the corrections or the counter trend moves. So Elliott Wave helps you identify the bigger picture trend. So maybe the best example is to go through how I think about it. You start with monthly charts, then I go to weekly charts, daily charts, just to try get an understanding of what the bigger picture trend is. Now, Elliott Wave, and I guess everyone's interpretation of reading a chart, you speak to 5 Elliott Waves and you probably get 5 different answers, but that's where you have to rely on your own analysis and your own work and confirming technicals, I guess. So the advantage of Elliott Wave to me is understanding when the market's in a corrective pattern or when it's in a motive pattern, when it's actually trending. So that identifying how the waves are structured and how the market is behaving helps you understand of what position that individual market is in. Is it trending? Is it just consolidating? And where are the opportunities? So what Elliott Wave helps you do is there are some basic rules around it. It provides very clear kind of points of ruin where the trade's wrong. It provides upside targets using Fibonacci relationships and so forth, which I use a lot of, Fibonacci extensions, retracements, and identifying target clusters, but really about identifying where the trade is wrong, where are the upside targets, and how the market should be behaving to get there. And, is the market chopping around? Is it actually trending? Is it basing? These are all kind of important aspects to how I execute trades. And Elliott Wave helps me identify, I guess, the trend, the bigger picture trend.
Okay, so the actual waves of Elliott Wave, what does that refer to? Like, what is a wave? Like, how would you, I know this might be a little bit tricky to describe without some visual aid, but
yes.
What is a wave? What's that actually referring to?
A wave is the directional price movement. So if the market is moving in a direction, say it's trending upwards, and it doesn't overlap, you have a clear price movement in a direction where there are gaps between support and resistance, there are constant breaks. That will give you an indication. And it's very hard to explain without visual aids. And then you've got a corrective pattern, which is a pause in a trend, which is where prices will be overlapping, there are no clear structures. It's basically more choppy, I guess is the best description I can come up with.
Okay, and just the little bit I know about Elliott Wave, which is very little, I believe the number of waves in a certain direction has some sort of significance. Could you shed a little light on that?
So the primary basis is 5 waves up and 3 waves down to establish a trend. So if the market's moving in a direction in 5 waves, which It'd be easier to show you if I had some visual aids, and it consolidates in 3 waves. And so it's incremental growth. So the next move up will be in another 5 waves, and the next decline will be another 3 waves. That gives you an idea of the trend, where the market is heading. So waves form on varying degrees because they're fractals. They're fractal in nature. So, you can see the same development on a weekly chart as you can see on a 10-minute chart. So you can identify at varying degrees of trend or varying time frames what the trend is at a particular time. Is it moving in 5 waves or is it moving in 3? And that gives you an idea of the bigger picture trend when the 5th wave is the ending wave. So if you're at a larger degree, say you're looking at a weekly chart and you can see it's in the 5th wave, then you can narrow down to a daily and a 4-hourly chart to see if the direction is turning, momentum's changing. So Elliott wave on its own is difficult to trade, but when you couple it with what I call kind of building a body of evidence, which is using Fibonacci targets, Fibonacci retracements, combined with intermarket analysis, trend channels, and other forms of momentum indicators. So the 3rd wave of a 5-wave rally should be the strongest wave. So that's when your MACD and your RSI and your momentum indicators will be at their peak. So what you're looking for is, say, for a 5th wave, you're looking for divergence in momentum. You're looking for the market to stop trending as strongly as it was in the past.
Okay, and for you to actually trade Elliott wave, for you to actually trade the signals that Elliott wave provides, these have to align with your global macro views. Is that correct? So you're not just using Elliott wave in a sort of a systematic kind of approach.
Correct. I use it in terms of what my global macro view is, but I use Elliott wave and I use a bunch of other technical indicators as really it's really for timing and timing the trade. That's what the difference is.
Okay. And where does this actually come from? Like, who was Elliott?
R.N. Elliott. He developed it, I'm trying to think how many years ago it was. I think it was the 30s and 40s. He just based his theory on his observations and market observations. So he would plot daily charts of the price action of various commodities and so forth. So R.N. Elliott is the godfather of Elliott wave. It gets named after him, and he published a bunch of articles around it about his observations and his theories around the Elliott wave process. And then Robert Prechter was the one to really take it to the next level and to bring it to the mass market, and published the book, The Elliott Wave Principle by Frost and Prechter, and that's been published since the 80s. So he developed R.N. Elliott's work and added to it over time. And I think that's kind of what I refer to as the Bible, is the book, The Elliott Wave Principle. So that gives you all the foundations of the structure and the observations, the relationships, the rules and certain conditions around the different wave structures.
Okay, so that's a book that can actually be purchased still today?
Yes. Yep.
Excellent. And what was the title of it again?
Elliott Wave Principle by Frost and Prechter.
Right. Okay, and just before we move off this, from what you've seen, is Elliott wave a more effective form of analysis in particular markets or on certain time frames than others?
From my perspective, it works on all time frames. It is more reliable, I think, on bigger picture time frames where you have less noise in the markets. So you can trade, and you can trade a 1-minute chart successfully using Elliott wave. Like you can trade dollar yen, a 1-minute chart, and you can trade that and make money. What I find is you get more variability in the outcomes. So my experience has been the longer time frames give you more reliable results because you have additional I guess, you have additional evidence. So you get a better idea of confirming signals. You get more information. So you get the longer time frames are benefited by. You get to use intermarket analysis, and you get less noise in the data. So to me, it works better longer term than it does shorter term.
Yeah, okay. Now, intermarket analysis, this is something you've brought up a few times now. Can you walk us through how you actually go about that?
Yeah, John Murphy is probably the guy who kind of created the best resource of intermarket analysis. And it's really about identifying how interest rates, currencies, equities, and commodities all move together, and where the correlations are, where the confirmations are, until they're not correlated. So from my perspective, you can use it in both ways. You look for it confirming the price structure. So you're looking for, say, for example, I'm looking to short US bonds, right? When I want to do that, I want to make sure the US dollar is strong, because that'll be a confirming indicator. If the US dollar is weak, it gives me far less reliable signal. So it's about having confirming indicators for the commodities you're trading or for the product you're trading. So the idea that the expectation that gold will keep going higher while the US dollar is getting stronger is a conflicting trade. And you want to minimize your conflicting trades. You want to be in the position that is supported by the most evidence. So in an ideal world where you have strong US dollar, rising bond yields, and declining gold, as an example. So you can use it in that way. Another way to use it is when you don't. I often use intermarket analysis to see where markets aren't confirming the moves. So say, or some may regard, like Dow theory, for example, if S&P and the NASDAQ make a new high, but the Dow is lagging. So that lack of confirmation sometimes provides you an opportunity and insight to the relative strength of the market. So sometimes you look for when the markets aren't actually confirming each other. And that provides opportunity as well.
And so if someone wants to find out more about intermarket analysis, are there any resources that you'd recommend?
John Murphy's work, as I said, what's his, trying to think of his main book, what was it called?
I can dig it up and I'll put a link to it in the show notes.
Yeah, I can send it to you after this. But it's basically John Murphy is basically the godfather of intermarket analysis.
Okay, cool. Now, just moving on to your global macro views, what are the key macro factors that influence your market views?
At the moment, it's the Fed. It's the US Fed, and followed by, not necessarily its order, the Chinese central banks, the Japanese central bank, the ECB, and so forth. So the market over the last 5-6 years has been driven by liquidity, which has been driven by Fed decisions. And we have a world of zero interest rates or negative interest rates, and that is the absolute key driver in all market action. So you need to understand the Fed decisions. You need to understand how the relative Feds, and of most importance is the US being the biggest economy, the reserve currency, and understanding Fed behavior and why they're doing what they're doing. So that to me is kind of the primary driver. And there's a whole macro thesis around that, being in a world of too much debt and not enough economic growth. But the key driver right now is the Fed. And that's why the markets tend to gyrate wildly around every Fed official and every Fed president coming out and having their 2 cents worth.
Well, let's talk a little bit more specifically about your actual strategy, like getting into trades, how you're managing your risk, that type of thing. So one of the things I read on your website when I was doing a little bit of prep for this, for our interview here, is you mentioned that you stagger entry orders. Could you expand a little bit on that?
Sure. Now, in terms of how I go about trading, it's really starting with obviously doing your market analysis, and you've got your macro view, so you do the market analysis, what the charts are telling you, where the opportunities are. And it's really about synthesizing those observations, which I think is a big difference. Rather than looking at a chart and trading that one chart, it's doing your work across a broad range of indicators and a broad range of markets, synthesizing that into a picture of where you think the markets and how the markets are positioned, and therefore where the opportunities are. Are people long dollars, short dollars? Are they long bonds, short bonds, equities, and so forth? And understanding what the market dynamics are. In terms of entering a trade, it's really about, so I look for, the way I do my analysis is looking for buy and sell zones. So where I think a market is turning or looking for a turn. So in terms of executing on that trade, is at key decision points or key fib targets, you enter the trade with more likely to be kind of a minimum entry point for me. And once I start getting confirmation of a turn and a move, I'll add to that position. So the whole concept of staggered entry is something taught to me by Richard Wiseman, who wrote the book Trade Like a Casino. And his idea, it's all about really about risk minimization and not missing the trade. Yeah. So the concept being a staggered entry approach gives you, if the market turns before your level or it turns after your level, is just making sure you are in the trade that you want to be in, and so you don't miss the trade. Yeah. So it's minimizing the chance of missing the opportunity.
Okay. I got to say that the title of that book has always fascinated me and got me really keen to read it. Trade Like a Casino. It's it's a great title. Is it a good book?
It's a very good book. I know Richard personally, and he's an excellent trader. We trade very differently, but that doesn't decrease the value of the book. It's, his ideas around Trade Like a Casino are really about having the edge and trading your edge, and basically being the casino and not the punter at the casino, whose odds are always against them. So that's the basic philosophy of it.
Yeah, I might have to check it out.
Definitely should.
And while we're talking about the entries and getting into the market, how do you decide what trades are going to be swing trades and what are going to be your macro sort of position trades?
It's really about where the markets are at that point in time. And what's the risk reward? Where do I see the bigger picture trend? A good example is the US dollar right now, in terms of identifying, I wanted to be long at the 94 level. I published that in my blog. So you start staggering entries, knowing that my expectation is that ultimately we get over 102. So that's the premise of the trade. So you have your staggered entry at the expected turning points and at your support zones. The idea is to get long, and you add to it as the market confirms your move. So the idea of whether it's a bigger picture position trade or a swing trade is your expectation of the length of the trend, or my expectation. So I'm looking for a trade from 94 to 102. Does it get much higher than that? I don't know, but that's all I need for my risk reward. Yeah. Okay. So and to me, that's a fifth wave move. So it's an ending move. So it's not a long-term position. For me, it's a swing trade. So it's where you are in the bigger picture trend that defines whether it's a long-term position trade or a swing trade. So in that instance, in my mind, it's a swing trade, trading off the daily charts or the 4-hourly charts.
Got it. Okay, yeah, that definitely makes sense. And what are your rules or your conditions for adding to positions? Like, when do you decide when to do it and when not to do it?
It's when I start seeing, on a smaller degree, I start seeing impulsive rallies. It's an Elliott wave term. So I see a small degree 5-wave rally on, say, an hourly chart or a 4-hourly chart. So if I start to see confirming price action, the market starts to move in the direction I'm looking for in 5 waves, and it's correcting in 3 waves, then I know that the bigger picture trend has changed and I can start to add to the position.
Okay, and then I guess the last part of the puzzle, how do you determine your exit points?
The exit is basically where, at the start of the trade, I kind of know where my entry, my risk, and where my exit point, because that's the only way you can figure out what your risk reward is. So my exits are predetermined. So I will exit probably 75% of the trade at my targets, and if the momentum's still high and it's still working my direction, I will leave a small runner on. But I'll take the majority of my profits at my initial targets. And I establish those targets based on Elliott wave rules and Fibonacci extensions and so forth, a lot of which I outline on my site and on my weekly updates, which I publish.
Yeah. What is your website?
It's marscapitalpartners.com.
Okay. Yeah, I meant to mention a little bit earlier when we were talking about, it'd be helpful if we had a visual aid. I know you've got plenty of charts and examples on your website, so I meant to mention it back then, marscapitalpartners.com. Was there something you wanted to add there?
No, I was just saying that's basically a weekly market update that I do before the trading starts every week, and it gives you an idea of my thought process. So what I do is basically blog that every week. It's my thought process as to where I think the markets are, where they're heading, and I cover US and global equities. I cover the major FX markets and commodity markets. So on that, you can get a good read of kind of how I go about my thought process of actually executing trades and the patterns I'm looking for, where I think we are in the varying degrees of trend. I've been publishing that for about 4 years now, I think. So yeah, every week I usually post an update, and that gives you an idea. And the idea is not to just look at the charts and read the actual words, because that's really my thought process. And the reason I started that was really for a discipline reason for myself. Putting it out there, putting it out in the public press, opens you up to critique, and I think that is a good thing. And it's a good discipline to have for me, because that's writing the update is how I think, and it's the best way to articulate trades for myself, actually having it down on paper.
Yeah, and actually when I interviewed Peter Brandt, he said a very similar thing for himself. So I think that's really interesting. I don't want to miss something you said just before, and that's when price hits your target, like your profit target, you generally take about 75% of the trade off. How do you manage that final 25%, and when do you finally exit the remaining position?
The way I go about it is, once again, using the technical analysis in terms of the Elliott wave completing a pattern, looking for a change of trend on a shorter term time frame. So if the price gets to my target and starts to reverse, or we have a reversal bar, or it starts to decline in 5 waves on a small degree, that's when I know the trend has changed once again. So you either reverse your position or you just get out. So I look for kind of key reversals. So whether it's a daily key reversal bar chart or a candle. So I use a variety of indicators to see when I think the trend is ending. So I don't use formal trailing stops as such, but I wait for the trend to change. When I see the change in trend, that's when I get out of the rest of my position.
Got it. Okay. Very good. Now, one last question. Also, when I was snooping around your website, I saw you mentioned trading checklist a few times, as in that you use a trading checklist. What are some of the items on this list, and especially some of the items that you think might be beneficial for anyone listening to this podcast to try and maybe add to their own checklist or take into consideration before placing a trade?
There are a couple of things. There's one which is the checklist. There's another in terms of the trading process. And to me, probably helpful if I just describe briefly my personal checklist. So I start off the day and self-analysis, right? So the first thing I do is meditation for about 15, 20 minutes. And it's really about, are you in the right frame of mind to trade? Yeah. Do you feel good? Have you been well rested? Are you exercising? How do you feel mentally? Yeah. So the first thing I do every day is self-analysis. And other people do it in different ways, but it's basically prepping yourself mentally for the day. Second step I do is then go through my charts and do the market analysis and really kind of analyze what happened overnight. Being in Australia, I get to see what happens in the US overnight, what all the various markets are doing, and then the step after that is synthesizing those observations, right? So, are the bonds moving with the FX markets? What are the equities doing? Are they doing their own thing? Are the commodity markets confirming or not? So really synthesizing what you see. And then the next step is really expressing those observations into trading ideas. So where do you see the risk? Where do I see the risk reward opportunities for what the markets are doing? Are we setting up? And then the next step's really kind of executing and managing the trades, which is a lot about stalking and waiting for the right entry and identifying the risk parameters, the targets, and so forth. And I guess on the back of that is really action, executing the trades, and then finally kind of documenting and journaling the day, basically a daily debriefing where I put all my trades on the spreadsheet, update them, journal them, basically get a feel for how I did on the day. Did I follow my rules? Did I, take the trades I wanted to take and so forth? So that's kind of the process I go through on a daily basis. In terms of the trader's checklist, it's really about, say I see an opportunity. So the checklist is 1, what's the macro thesis around it? 2, what are the Elliott wave counts? Does the wave count and do the prices support my thesis? Are there specific trade triggers? So do we have a reversal bar? Do we have a clear, 5-wave move on a short-term pattern? Then the next part of the checklist is Fibonacci retracements and projections, where I create a kind of target cluster and where support and resistance should be, using trend channels, trend lines, RSI, MACD, which are on all my charts, just to see whether they're confirming the price patterns. And then I guess lastly is correlated markets. Are the markets correlated, or are they starting to diverge? That's basically my checklist through the day for each trade.
And how are you keeping track of all this? Like, what actual tools are you using for journaling and your research and observations?
I journal, just open, write it down. I use my blog often for journaling in terms of identifying key market moves. I also physically print out my little trader's checklist on every trade I do, and I print out the charts that I'm trading off just so that there's verifiable evidence of what I've done, the decisions I've made, and why. I also use basically a trading spreadsheet, which has every trade, entries, exits, risk, reasons for the trade, reasons for entry, reasons for exit, and so forth. So between the journal, between my blog, the checklist, and the spreadsheet, you get a pretty good record of your behavior over time. And that helps you over time to go back and review how you've been trading, review the decisions you made, and how you executed.
Excellent. Good stuff, man. Really, really good. So where can listeners go to find out more about you?
Basically on marscapitalpartners.com have basically my weekly blog. It has a bit about me and my background. I've got a page there on my trading plan, which effectively shows kind of how I go about executing trades. And that's basically the best place to go.
Okay. And what about Twitter?
Twitter @trader_Mars.
Dario, thank you very much for doing this, man. It's been a lot of fun and an absolute blast to have you on. I appreciate it.
Thanks, Aaron. I appreciate being on, and I appreciate the service you've provided for everyone. It's great to be able to hear other traders and how they go about their work and their perspectives. So thank you very much.
You're most welcome. Thank you.
Cheers. Thanks, Aaron.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
You mind if we make one more stop before heading back? I need to run a Target.
100%. Let's RTT. You thinking of stuff for the dorm?
Yeah, my mom gave me some good tips on must-have essentials. We for sure need underbed storage, handheld iron for wrinkles, maybe even a mini Keurig for Mondays. Am I right?
All right, bet. Because I was already thinking about keeping my clothes looking fresh at college, so you better be sharing that.
Of course, man. Whatever I get on this run is yours too.
Twin!
But for real, let's go before they close.
Find everything you need for college at Target.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
LinkedIn is great at connecting you with the world's largest professional network. But it can't connect you with motivation on a Monday morning. LinkedIn can help you get insights from your professional community, but it can't give you any insight into why Dave's still talking on mute. And while it can't stop your boss from bringing tuna for lunch, LinkedIn can help bring your career to the next level. LinkedIn is the network that works for you. Visit LinkedIn.com to learn more.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Okay, what's good, team? Welcome to yet another episode of Chat with Traders. What you're about to hear is a conversation I had with a short-term futures trader. His name is Ben. Last name we won't mention, only for privacy reasons, but he goes by @BLB_capital on Twitter. Before being consumed by the market, Ben previously ran a construction company until an injury put him out of action for a period of time, which is when a friend got him interested in trading. Developing his craft over recent years, the bulk of Ben's trading now revolves around order flow, and he's most active in crude oil, gold, and ES. Over the next 50 minutes or so, we discuss what Ben learned and emulated from a large bond trader who he was trained by, insight to his core trading strategies, how he utilizes automation, why traders should be aware of right to left syndrome, and much more as well. Now, Ben, being concerned with the amount of nonsense which is online, told me he had only agreed to do an interview if I mentioned that I've personally seen statements from his broker, so there you have it. And after this episode, if you have any trading questions for Ben, or if you would like him to expand on anything mentioned during this episode, just go to chatwithtraders.com/93 and write in the comments area at the bottom of the page. Ben will do his best to help you out with a response. All right, guys, I'm your host, Aaron Fifield. Thank you very much for listening. Here is my interview with Ben. Ben, man, welcome to the podcast. It's really good to have you on.
Thank you. Appreciate it. It's been a long time coming. I'm honored.
Yeah, we've been talking about it for a while, so it's good to finally be doing this. But so, I know you've listened to a few episodes of the podcast by now. You're probably well aware that the first question I usually hit guests with is, how did you get into trading? So, tell us a little bit about how you got into trading and what was life like prior to trading? What were you doing at the time?
Sure. My background is basically I've always had my own kind of companies. Right out of high school, I started a cleaning company. Commercial business, cleaning, office buildings and stuff like that. Then I got into construction, and I moved along with that. I started my own company. And then basically 2012, I had a pretty serious injury where I couldn't work anymore. And I had to find something else to do until I got better. So basically a friend of mine was trading stocks at the time. He said, come check this out. I had some money saved. So I dabbled in that for a little bit. And that's basically where I jumped into it from there.
Okay, cool. So, I mean, what was it that your friend told you about trading that kind of piqued your interest?
Well, he just kind of was like, he came and went as he pleased. I always seen him doing things. He was always out on the boat when I was working. You know, he just had all the freedom in the world. And it just, you know, what's better than that? Okay,
so I take it he was obviously doing all right then.
Yeah, he does all right. I mean, he wasn't rich per se, but I mean, he did all right. You know, he probably made, you know, between 200 and 300,000 a year.
Okay. I'd consider that doing all right. And so how long had he been trading for at this time? Like you said, he obviously had a lot of freedom and that sort of thing. Like, I think that's what a lot of people kind of picture trading as before they get into it. I mean, how long had he been trading for, and did you have any kind of perceptions or beliefs about trading before you got started that soon got adjusted?
Well, I mean, he was trading right out of school because that's what he majored in, economics, and he was working for Smith Barney, and then he kind of did his own thing at home. So he did a lot of options and stocks. As far as like perceptions, you know, it's just like everyone else. I'm no different. I didn't know anything about trading when I started, so it was just like, oh, I'm going to make all this money, you know, and I thought I would just jump right on the path that he did, or, you know, like everybody else does. I didn't see the old dark side of the thing until I was, you know, well into it. So.
Okay. So, I mean, you know, obviously your friend kind of piqued your interest in trading. What was like the next step from there? How'd you get into it? Where did you start learning from? Tell us a little more about that.
Well, I started doing just regular long and short plays with the stocks, and I did okay. I made some money, I lost some money, and my account just kind of sat there, and, you know, I started spending away at my savings because I wasn't really working. So I started doing some research on futures, and, you know, because you need a little less money to be involved. Because with the stocks, I mean, you need some serious money to make serious money, and, you know, especially when you first start out. So I started doing research on futures, and, you know, I joined a couple trade rooms and some education sites like we all do. I mean, we've all been there. I can't say that I haven't went down that path. And basically I just jumped into it. I started trading. I started losing money left and right when I first started. And then I kind of caught on to it and disciplined myself really hard. And I spent probably hundreds of hours a week just going over the charts and focusing on things that I thought were the right things to look at. You know, what moves the market.
Okay. So did you have any intentions at this stage to go back to work, or were you now just focusing your efforts 100% on trading following that injury? Or was it that injury that prevented you from actually going back to your construction gig?
Well, I kind of was on like a waiting list where it was like you can go back when you're cleared from the doctor. So that didn't happen for about 6 months. And by the time it did, I was already almost making about as much as I was making at my construction job. So I was like, you know, outweighing the risks. And I said, I want to do this. This is nice. I come and go as I want. I can hang out with my kids. I can pick them up from school. And I'm just around a lot more because I worked 10, 12 hours a day doing construction.
Mm-hmm. Yeah, and I guess, I mean, you always had that there, so you could go back to it if you needed to, you know?
Yeah, I mean, it's good to have a skill because, you know, like I said, if I need something done around the house, I do it myself. No matter how much money in the world you have, it's still nice to, you know, build your own stuff and kind of call it your own.
Yeah. So I just want to go back to something you said a little earlier about how you need more money to trade stocks than you do to trade futures. Would you mind just sort of expanding on why you say that?
Well, I mean, from my perspective of it is, if you wanted to buy 1,000 shares of, Amazon or Apple or one of those big stocks, you need tons and tons of money. You need a couple 100,000, and it's the guy that I was learning from and kind of clinching onto was trading, probably $1 million account. And I had about 20,000 in my savings, and I just couldn't do anything near what he was doing. I mean, I could make $100, $200 a day, and just wasn't cutting it.
Okay. And so with futures, you need less capital because of what, the leverage that's available to you?
Well, it's just the leverage that's available in the contract size, and you can, like with crude oil, you can swing one contract for $1,000. I mean, I don't recommend it, but a $20,000 account, you could make a decent living with that if you know what you're doing.
Yeah, exactly. Keyword there being if you know what you're doing.
Right.
Yeah, okay. No, that's interesting. So, I mean, what were some of the biggest challenges that you had to push through when starting out? I mean, no one comes into this and it's smooth sailing all the way. What were some of the challenges that you had to overcome?
Well, I basically had to learn the basics because I didn't have any kind of education. I have no kind of background on fundamentals, news, anything like that. I'm a very visual person, so like the charts kind of appealed to me because I saw things that I felt that helped me, patterns, rotation, stuff like that I look at now. Just the fear of losing, I guess, you have to overcome is the biggest part, I think. The fact that you're going to lose a good percentage of the day, is pretty scary to most people. And it scared me at first, too, and then I realized, that's just part of the job. You just have to give it up. It's like tuition.
Yeah, absolutely. I mean, how did you get used to the idea that, when you come into trading, you are going to be losing a hell of a lot of the time?
I think the only way to get used to it is by doing it and knowing that you can still win more than you lose. See, when you come in and you just wipe out your account, like a lot of people do, it scares the shit out of them. So they tend to make the same mistakes over and over. I got kind of lucky, whereas I lost a bunch of money, and then I made it back, and then I kind of jumped on the right path from there, and I didn't look back from there.
Yeah, okay. So I want to spend a little bit of time and talk about the education that you went through. You kind of half jokingly said, we've all been there, we've all gone through it. Tell us a little bit about the education that you went with and, how you felt about that afterwards. I know sort of you've got a different perception of it, having come out the other side now. What can you share for listeners about the subject of trade and education?
Well, when I first started, I saw everything you Google, you look up, it's 90% win rates, guaranteed money, make this much. It's just advertisement. And most of us are just dumb to it when we first start. That's just the way it is. Unless you knew beforehand or somebody tells you, it looks like a big, ready to go thing. So it's like, all right, let me buy this guy's education. Let me buy this guy's indicator because it just looks great. But the fact is 99% of it is just garbage. Because if they're trading and making the kind of money they can make that they say they're making, they're not going to be selling you anything. They're not even going to be wasting time talking to you. So the first thing I did was I signed up for this place. I won't mention the name, but it's like a school of trade kind of thing. And I learned the basics from the guy. I mean, he wasn't stupid, but he was just a hustler. And he falsified his entries and spreadsheets, and I mean, it was just a big scam from the get-go.
So how did you find out that he was not being completely honest with the spreadsheets and these different things you just mentioned? Like, how did you come to realize that?
Well, just after you trade for a while, you kind of know how the market moves and how it works, how platforms work, and people that work there kind of ratted him out. It just kind of fell. But it just keeps rolling. No matter what I say, what anyone else says, people still buy it. It just blows my mind.
I mean, this is the thing though, like when you come into trading and you do know nothing, you have to learn something before you can even sort of, it's smart to learn something. Regardless of what it is, it's probably going to help in some way. Not to saying you should just run out and buy the first thing you see.
No, but I mean, there's starter books. CME has great amount of information on their site. You just don't want to jump into anyone that's going to put you into a immediate bias right off the bat and kind of train your brain to trade the wrong way right off the bat, because it's hard to go back from that.
Yeah. So, I mean, do you have any other advice for how, anyone who's listening to this podcast right now might be able to filter out some of the good education from the bad education?
You just got to do your research. I mean, you can't trust anyone, to be honest with you. It's very... I can't say that there's no good people out there willing to help. I mean, there's tons of people on Twitter giving away free information. And I do think their time is valuable, but there's a very thin line between charging for it and, giving it away for free. So I mean, like, you just have to do your research, and you can't just believe everything you see and think that it's a bunch of rainbows and you're just going to score at the end of it. It's just not going to happen.
Yeah, no, you're totally right. And I mean, something you said a little bit earlier is that, if someone is trading and they're genuinely making money, they're not going to be selling any information. Like, I'm a little bit torn on how I feel about that. Like, do you really believe that's the case for everyone?
I do personally, because I look at it like, unless you write a book and you have some kind of, backing behind it, and you sell the book, you've earned that right. You put in your time, you've made your money, you put out a book. But to sit there and charge people for these trade rooms and, these levels that mean nothing, it's just a very bad, it's a gray area. I don't like it. And I have a hard time with it, but I got past all that after, I started trading.
Yeah. I mean, I think we could spend quite a bit of time on this, and it could sort of go both ways. But, I kind of think there are pros and cons for each. And, you've obviously got to be very selective on who you run with. But let's keep moving. So, I know...
Well, I mean, I'll lay it out like this. If the guy is legit, he could show you he's legit. And that's it. It's either you make money or you don't. There's no Microsoft Excel spreadsheets. You have a statement, a broker statement, an audit, and that's it. If you can't show that for some reason, then you're hiding something.
Mm-hmm. Sure.
And that's it. I mean, that's basically it. If you ask somebody for that and they can't provide that, then you have to question it.
Yeah. So, like we've talked about, you sort of moved past this, and from there, I believe you kind of linked up with a guy who was a big lot futures trader. How did you come to meet this guy? I know he had quite an impact on your own trading.
Well, I built a house for this guy, and his brother was a big bond trader in the city. And I told him what I was doing, and we became friends. We had family parties, and he said, "Do you want me to set up a meeting? You can go in and meet my brother and spend the day and see what he does." And I was like, jumped all over it. Absolutely. So I went in, and the desk next to him was this guy, and he introduced me, and he's a big lot ES trader. And I ended up going into the city for about 8 weeks, every day, morning till night. And he laid out everything that I needed to know, basically to get on the right path of trading. Basically I told him, he wanted to see what I did know. And he said, go in the toilet, flush it all down the toilet, because it's all bullshit. You know nothing. And this is where we're going to start. And this is where you're going to end up.
Okay, so where did you start?
It basically comes down to, order flow. It's all markets. That's how the market moves, is orders coming in, orders going out.
Right. Okay. Well, we'll definitely dig into that a lot more very soon. I mean, why did he agree to let you sit with him for 8 weeks? I mean, a lot of traders are very personal by nature. I mean, why did he agree to let you sit in and watch him trade? And why was he prepared to put in the energy to help you? Was it just because you were connected through family, friends, or was there something more? Did he see something in you?
I mean, that was one of the reasons, and he kind of tested me for about 3-4 days, and then he kind of decided, I like this kid. We're about the same age, so he can't really call me a kid, but he just enjoyed my company, and he thought I had a lot to offer, and he still calls me and wants to know if I want to come in and work for him. But I mean, he saw that I was very motivated and that I was definitely going to learn this no matter what it took.
Okay, and I remember when we were speaking before this, I think you mentioned to me that he didn't even use charts. What was he trading off? What was his sort of style of trading?
Those guys, they trade basically just off a dome. They have charts in the background, but I've barely seen them look at them. It's all order flow going in, order flow going out, refreshing bids, refreshing order offers, and it's very short term. It's scalp city. I mean, thousands of trades a day, just in and out constantly. Contracts in and out.
And what do you think it was about this trader in particular that the reason for why he was so successful at what he did? I mean, was there anything about him that really kind of stood out to you?
Well, the main thing that stood out for me is I would sit there and watch him, and other people in the office would be yelling and screaming and breaking shit and cursing, and this guy was just calm, cool, collective the whole time. Never smiled, never got mad, and I thought there was something to that, because you kind of have to keep a steel face when you're trading. You can't get all excited when you win, and you can't get all bent out of shape when you lose.
So was that something that you tried to adapt for yourself, obviously seeing that was kind of one of the standout traits of this guy?
Well, it's hard to adapt to someone else's psychology, but I had somewhat of that personality to begin with, where I don't let things get too emotionally attached to me, so it kind of helped. But I think that's what made him a really good trader, because he would lose 25,000 and he wouldn't even, you wouldn't even know it. It was just like another, part of his shift.
Just another day at the job.
That's it.
So tell us a little bit about your trading today. Let's dig into your strategy. If you could just give us an overview on how you trade, how you come to the markets today.
So what I do today is basically I use a couple different charts that plot all the order flow, basically passive and aggressive market orders filled and resting orders. And I use 2 different accounts to kind of hedge against each other. So I get in a position, let's say long, based on a pullback with the rise of resting orders, and I'll counter sell each individual rotation on the way up based on passive orders reloading on the way up. So it's a little complicated to explain, but I'm always in a position. So my core long position is going to hold until my core short position reloads, and then I start buying back again.
Okay. Would you mind just sort of simplifying that for us, just so we can really sort of get our head around what's going on there? So you're always in a position, your trades are hedged against each other. Just break that down a little more if you can.
Right. So for example, I buy crude oil at 50. Let's say for 10 contracts, and I get 5 ticks out of it. I'll take 8 off, and I'll have 2 contracts left running. And let's say 50-10, I see some fades in the offer on a rotation, which is my rotational levels I use. I'll short it with 8 contracts. And if I get the scalp on 5 ticks of that, I'll take 6 off. And what will happen is it'll either fail out and I'll lose my 2 contracts, or that short will turn into my next core position and I'll be short the 2 contracts. So it's kind of like inside and out, kind of back and forth. Because I don't believe in waiting for the market to come to you. I just believe in jumping in and taking advantage of every swing rotation.
So when you talk about rotations and rotational levels, what does that exactly refer to?
Just pullbacks, swing high, swing low.
Okay, and how do you measure what's a swing high and what's a swing low? Is it just a visual thing, or do you have kind of a set of rules, an indicator or something like that?
Well, I just use a retracement tool, and it's basically like the first group off of a swing low. The first grouping of a pullback would be the first rotation, and then I pull from that rotation up. And then each individual rotation based on 25% rotations will get me to my next level. So if you had to lay it out on, like, say, 50 to 51, it would be 50 and a quarter, 50 and a half, 50, 75.
Okay.
Study and play. Come together on a Windows 11 PC. And for a limited time, college students get the best of both worlds. Get the Unreal College Deal. Everything you need to study and play with select Windows 11 PCs. Eligible students get a year of Microsoft 365 Premium and a year of Xbox Game Pass Ultimate with a custom color Xbox wireless controller. Learn more at windows.com/student offer. While supplies last. Ends June 30th. Terms at aka.ms/collegepc.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
So what's your idea for always being in a trade? Like, why do you prefer to trade that way?
I just don't like to miss anything. I believe there's so much opportunity, and I like to just get the day done with. And, the market moves. The other day somebody told me, how'd you make any money? Crude only moved 50 ticks. And I said, well, you need to relook at that, because crude went up and down probably 75 times. And in that 75 times, it did, 10, 15, 20 tick rotation. So it actually moved over 1,000 ticks if you think about it.
Yeah. So how many trades would you do in any given day, just on average, rough numbers?
Based on trades, without mentioning the contract size, would probably be 25 to 50.
And how did you arrive at this strategy? Like, how did you come to discover this?
Well, this is something from what I learned from my ES guy, and I couldn't really get what he was doing right off the bat. So I kind of, I believe everyone has to kind of make trading their own. So I couldn't really just copy his black and white. I had to take what I learned from him and kind of make it something that worked for me. And rotations is something I've been looking at since day one when I started, because it's just something I noticed. So I use that. And then I use his entry methods on getting in and out.
Okay, so how do you define your exit methods? Like what incentivizes you to get out?
Well, if I'm core long, which is like I have a runner that's long, and the offer fades, and I'm scalping my short position, and my scalp goes below the second rotation, which is like 2 standard deviations from where I'm short, that gets me out of my long position. So now I'm core short. So the only thing that could happen is it goes against me and I squash the trade, and then I go core long again. So it's always like washing one for the other.
Right. Would you mind just repeating that part about standard deviations? I mean, I think that's quite interesting, and I'm interested to hear how people actually use that in their trading.
Yeah. So the rotation, if you have a little block rotation, say 50 to 50-10 is a 10-tick rotation. So if we short off a 50-10 and we rotate back into 40-90, that's two standard rotations down from that 10. So it's 10 ticks and then another 10 ticks. So you're down. You know, I'm assuming that the first rotation is 10 ticks. This is what I'm basing this on. So your second deviation goes into 40-90. So once we pass that 40-90, my original entry on my core long position is stopped out, and now I'm in a core short position. So what I'm going to do is start buying the rotations on the way down, 40-80, 40-70, 40-60. This is just an example, not, you know.
Yeah. So if I understand this correctly, your rotations are something that you can visualize on a chart based off the actual price bars. I understand you also use, and you've kind of mentioned it already, market profile or volume profile quite a lot as well. How do you kind of pair those together?
Well, the profile I use kind of, if you look at my Twitter stuff, I post a lot of profile builds, which is, it's almost like the same as a rotation because the market kind of consolidates, and this is where you get the actual move from, is the market consolidates and then it either goes one way or the other, you know. The trick to this is to identify where people are trapped, and you want to buy the pullback in the opposite direction.
Okay, so as you described there, you want to identify when people are trapped. How do you actually identify that? Like, how do you see that? I mean, this is something that's come up a couple of times on the podcast, and I don't think I've actually asked specifically kind of like how you would identify when people are wrong. I guess it's kind of easy to see if there's a very well-known chart pattern that fails and kind of reverses. That's quite easy to see. But, you know, on an intraday sort of basis, very short term, looking at things such as market profile, how do you identify when?
Well, so basically, like, if you have consolidation and you get all these, retailers, people at home, me, you, whoever, they think it's going to bust out to the top side. So what'll happen is you'll get a strong buy order come in on low volume, and then you'll get either a follow through with the offer, or you'll get a pullback of the offer, and they'll refresh the bids. And that second push up, if they don't buy back into the offer, those longs 90% of the time are trapped, and you could sell it all day long. Now, it doesn't mean it's going to continue short, but it's a short for me because it's a short-term short. And this is all based on the charts I've built and the order flow stuff. You know, you'll see the buyers right at the top. You know, they'll buy right at the top, and if there's nothing offered, there's nobody to sell it to them. And as soon as they stop out, you get the refresh of the bids, and the market collapses back onto itself, and shorts pile in, and that creates a little free fall back down until they rebuy it or keep selling it.
So you kind of hinted at it there that you use some tools. Can you tell us a little bit about the tools that you've developed and how they actually help you with your trading?
I mainly use Sierra Chart, which I think is a great charting package for anybody. It has everything included. There's no third-party vendor stuff to deal with. And I just built a little thing for myself. It just shows me market orders, which are, orders that are filled, and then resting orders, which are orders waiting to be filled. And then the basic order flow, which is the, number bars. That shows you exactly who bought and who sold and how much. And then you see the actual imbalance, that price. It's like almost like a horizontal delta.
Do these tools automate your process or your trading in any way? Do you use automation for any part of what you do?
Yes, I have another 2 accounts that I use for automation, and it's basically based on the same process. It's just very fast in and out, and it's a constant in and out trade. So it's very similar to how I trade, but it's a lot faster. So it's constantly in and out. I mean, it's at best it's probably 30% correct, but it's almost a 3-to-1 risk to reward.
So pretty much everything we've discussed this far is referring to your, I guess you could call it your discretionary trading, and then you have 2 automated strategies that you trade in separate accounts. Is that correct?
Right.
Okay. So those automated strategies, how did you go about sort of implementing them?
A lot of hours, a lot of man hours, because it's very hard to get what you think you want the market to do on the chart. I mean, unless it's completely black and white, it's almost impossible, because there's always some little thing you're going to change up during your discretionary trading that the computer's just not going to do because it's not programmed in there. So basically, I just set a set of rules, and when it does this, it buys. When it does this, it sells. And that's it. I can't, I don't know how much detail you want on it, but...
So you mentioned that these automated strategies are traded in completely separate accounts. I mean, that might be, the reasons for that might be quite reasonable and obvious to you. But what's your idea behind having those totally separate from your day-to-day discretionary trading?
Well, because if you have one account, you're a little limited. So if you have an automated strategy and you just have one account and it goes long, but then you get a short signal, you're jammed up. You can't go short. You can't do anything until you're out of that long position. So this kind of trades both ways. It goes long and short the same way as my discretionary trading, kind of against each other. And it takes that little bit of profit in between. Sometimes they cancel each other out, but most of the times, you have that 3-to-1 risk reward. So the long is up 3-to-1, and then it will find a short. The short, say it holds the long for like 10 minutes and it fails on 10 shorts in a row, I'm still kind of hedged in a little way.
Just like myself, having a little bit of programming knowledge and sort of heading down this path, from what you've described, sounds quite difficult to actually program, coming from me anyway. Did you have the help of a programmer putting this together?
Yeah, I had a good friend of mine. He's a programmer, and he helped me with this. He's not a trader, so it made it a little difficult because, if you don't tell him how to spell your name correct, he'll put it wrong on the chart. It was a little long, difficult path, but he got the hang of it, and I wasn't an easy customer either because I was very picky in what I wanted, and he kept telling me he couldn't do it, and I kept telling him he could, and and finally we got it to work, and I started learning. I actually paid someone to start teaching me some of the Excel spreadsheet stuff that Sierra does, and so I've been learning that myself, and I've been making a bunch of stuff for myself as well.
That's very cool. So what were some of the things that you were trying to do, but he was saying couldn't be done? Because I think that's a really good point that you bring up, because it's very easy to see something. For example, it's very easy to see on a chart where there's horizontal support or resistance, but to actually program that is a whole nother story. It can be quite difficult and somewhat open to interpretation. So what were some of the things that you guys kind of had challenges where you were saying, I need to do this, but he was saying that can't be done? Or
well, it's not so much it couldn't be done. I guess to say like he didn't know how to do it because it's all new. Like he was used to making, MACDs and stochastics for people and glorified Bollinger Bands and stuff like that. But, when you come in and you want bid and ask and live feed stuff based on, refreshing bids and offers, it's a little overwhelming to someone that's never heard of that. So I kind of had to walk it through them and relearn it myself as I was kind of showing it to them. But, you always want to say, like, I want it to do this when this happens and this when this happens. But it's almost like showing yourself in hindsight because there's always a little tick to it on how it's built. Because you have time in the issue, you have speed in the issue, when it's going to get filled, on what part of the bar, if it even gets filled, limit order, market orders. There's a lot involved.
Yeah, there's definitely a lot of variables. How did you test these automated strategies? Like you said that these are kind of an extension of your discretionary trading already. These are just a bit faster and obviously automated. Did you go through the whole kind of testing, optimizing sort of phase, or did you almost skip past that because you'd been trading this way for however long?
Well, I knew that it would work if I got it to program right. It was just a matter of doing it. And the problem with this is because it's live data and you can't really optimize historical bid and ask data correctly, precisely. Anything I did had to be run in real time to test. So I tested it for probably 6 months. We made a bunch of changes, and finally we just got it to get going.
Right. And does this now run through Sierra Charts? I mean, I'm not familiar with that package, but is that something you can do through Sierra Charts?
Yeah, Sierra is just amazing on what you can do with it as far as anything automated, spreadsheets. It's one of the best I've used, and I've used pretty much all of them.
Okay. So talk to us about how you adjust your trading, how you make improvements to it. Like, do you have any type of review process?
I don't get into that. I don't go over my trades at the end of the day that much. I'll go back and look at things on the chart as far as order flow, and like certain anomalies that I see that interest me. I'm not one to go back and write everything down and check everything. I do constantly like to learn, so even if I have an edge and I'm doing good, I feel like I'm not at the end of my rope. Like, I still need to learn things, obviously. But as far as a routine, no, I just like to close my screens and go enjoy my day.
So is that something you did do earlier before you became, consistent like you are nowadays?
Well, the problem with what I was finding when you sit there and you go back and you look at things, and I call this the right to left syndrome, is a lot of newer traders, and myself included, when you first start trading, you tend to go back in the chart and you visualize all these things that look great. Whether it's patterns, bounces off of this level, bounces off of that level. But your mind kind of plays tricks on you, and you don't really see the stuff that doesn't work. So like head and shoulder stuff. You can go back every day and find a nice head and shoulders, but your brain just doesn't show you the ones that don't work. I don't know what it is, but I've seen everybody go through it. And I get people today that'll DM me and they'll be like, well, look at this does this, and this does this. And then the next week they'll be looking at something else and something else. And they're kind of just trying to trade in the future based off what's in the past, which does work, but the market pretty much does the same thing every day. It's just never going to do it in that same time and location.
Yeah, no, 100%. That's a really good answer. I mean, it's often quite easy to trick yourself into thinking that, I wouldn't have taken that trade anyway, and just kind of move on to the pattern that did work. So, on this point, what are some of the biggest mistakes that you see new traders make? And I know you're quite active on Twitter and obviously very engaged with a lot of other traders. What are some of the big mistakes that stand out to you made by newer traders?
Well, I mean, let me just say, I'm a little bit of an asshole on Twitter, I would say. Not with my best interest with everybody's interest at my heart. I do try to help out, and I do care about everyone's success. I just feel like when I see something that people are doing, I try to help out, and then they keep doing it, and I'm just like, all right, well, whatever. Then the biggest thing is, I think, looking at massive charts when you're trading for minimal profits. If you're looking for 10 ticks, 20 ticks, and you're sitting there wondering what's going on these monthly charts, daily charts, even 60-minute charts, you're concerned about all this news that's going on, you're killing yourself. It's just not going to work for you.
So what charts are you looking at? I know you trade a very short time frame. What are the charts that you're mostly looking at?
I look at micro charts. I mean, I trade off a 10-second chart. Sounds fast, but I mean, if you count out 10 seconds, it's really not that fast. I look at tick charts, 500 to 1,000 tick charts. I do look at bigger charts as far as volume profile ledges and stuff like that. But I keep myself in a range. So like with the rotations, crude is my main trading platform. So crude has got like a 25 tick rotation is like its favorite on all the research I've done on it intraday. So that's what I look for. If crude is between 50 and 25, that's all I'm looking at. Until it gets out of that range, I don't care. You know, why am I going to look at 52, 45, all these crazy numbers if it's not anywhere near there? You know, it's just, you just don't have like, you know, there was a guy the other day, he sent me a message and he said, you know, I think crude's going to 50, but I got stopped out on 20 ticks. It was at 45. That's 5 points, 500 ticks that it has to go, and you got stopped out on 20 ticks. Why are you even talking about it? And I'm not trying to be an asshole. I'm just trying to help.
So your point being that his stop was too tight for the profit target he was trying to achieve. Is that right?
He's looking way beyond his means. He's way out of his element. You know, if he's going to trade for 500 ticks, he's got to have at least a 500 tick stop. Because how does he know where it's going to pull back to? And, you know.
Yeah. Trading a market like crude, you mentioned just before that you don't really look too much at the news or fundamentals or anything like that. Even with crude, is that still something you don't even take into consideration? You're just purely focused on the price?
Yeah, never. I don't really trade crude inventories. I wait, 15 minutes before and after. Anything with news is just, people want to be involved and they want to guess and they want to kind of figure it out. But maybe it's just the way I look at it. But I'm not educated enough to know what it's going to do based on any kind of news, and it doesn't seem like most people are either. I just think it's a waste of time. There's other more important things you could be looking at.
Sure. Okay. And then outside of crude, what are the other markets that you're focusing on?
I trade the ES pretty heavily during the day, and then I trade gold at night.
Okay. Excellent. And so I guess I probably should have asked this much sooner, but like when you are trading, how many hours are you actually trading for? Are you just trading through like high volume sessions, or because markets, most futures markets like crude, for example, trades 23 hours a day? Like what sessions are you focusing on mostly?
Crude I'll trade mostly from like 8 to 11 in the morning, and I like to be out of the office by 12 o'clock. So 4 hours a day I think is more than enough time to clean up or finish up with what you need to do. I don't believe in sitting in a chair all day. It's just your mind gets tired after a while. And for me, it's about 3-4 hours.
Mm-hmm. And then you trade gold in the evenings for another few hours?
I kind of put on an OCO, 1-to-1 risk reward based on some range expansions that I look for going into the overnight session, like around 4 to 6 o'clock. I'll base that on what's going to do on the Asian Open, and then I'll put on a trade and leave it. And whatever I wake up to, that's what I got.
Okay, cool. Well, Ben, let's start to wind this down. Is there anything you'd like to add or share with everyone who's listening to this podcast right now, or do you think we've pretty much covered everything for the time being?
I mean, I'm not a veteran trader. I can't say I'm seasoned enough, but I do very well, and I do like to help out people. And I think, the main thing people need to work on when they first start is to learn how the market works from the inside out, and then you could add on your specialty stuff afterwards, your fibs, your profile, your moving averages, your VWAPs, all that stuff. Because if you don't know who's participating at these levels, you're gambling. You're just you're guessing. That's it. To sit there and say I'm going to buy the 61.8 because it's a 61.8 is a crapshoot. And you just, if you learn market profile and order flow and, resting order flow, you'll be surprised on how much better your entries will get.
Right. So when you say learn the market from the inside out, just to be clear, what you're actually referring to there, are you talking about order flow?
Correct. I mean, I know the term is used pretty lightly, but it's basically how everything moves. So if someone's going to buy the 61.8, you're going to see they're going to pull it down, and they're probably going to rip it a little bit below the 61.8, get everyone on board, pull it up 10 ticks, get everyone long, rip it back down, stop everyone out, and then it's going to go back up where everybody wanted. So it's like a retail reload of the inventory, because they kind of need like these stops to get pulled. And this is all stuff you could see on the order flow. But it's a pretty big learning curve, but it's to me, it's very important. I don't see how I'd be able to trade without it right now.
Okay, so order flow, obviously, you're a very short-term trader. For someone who might be a swing trader, or someone who, let's just say they hold a position for a couple days, how important is order flow to them? Does it have any value?
Yeah, because you could look at order flow on bigger time frames and see where the absorptions were at certain levels, the imbalances on high volume nodes, low volume nodes, and you can adjust your entries based on these things. But you have to, I think, when you swing trade, and I don't swing trade, so I'm just analyzing here, that you have to, your risk management is probably going to be your most important part. Because if you're swing trading, you're looking for a big move. So you can't get in at 50 and get stopped out at 50.25, hoping for 55. So you have to be able to manage that. And that's going to be, that's something you're going to have to learn based on price action, I think. Nothing's going to tell you the market's going to hold and go straight up to you where you want it to go. That's why I have a problem with long-term trading. I find that you're either a swing trader. Most of the guys I've met that make real money, and I'm talking, big money, either swing trade, hedge fund stuff, or they're very short-term scalpers. There's very little money I've seen made in the middle. It's kind of where retail sits at and gets beat up, and I kind of think that's where retail is used for, is kind of to fill orders, because they need to get these orders from somewhere, so they're just taking them from everybody that doesn't know how to trade.
So for anyone who might be interested in learning a bit more about order flow, are there any resources that, just on the top of your head, that you could recommend?
I mean, from what I've seen, it's very limited. I have some stuff on my blog, but I don't have that much. I'm going to probably do a little bit more. Market Delta has some beginner stuff, but it's more about promoting their site and stuff like that. FutureX, I think, is another site on YouTube I've seen that has some order flows. I think it's a prop firm or something. They show a lot of order flow. There's a bunch of good guys on Twitter: Stop Hunter, Thomas Bell, Chi Girl. All those guys are into order flow and do pretty well with it.
Cool. Okay. No, that's good. That's good. Really helpful. All right, Ben. Well, let's call this a wrap, man. It's been really cool to speak with you, and thank you very much for doing this.
Absolutely. I appreciate it.
Where can listeners go to find out more about you? I know you're on Twitter, so maybe your Twitter handle and your blog, which you mentioned.
I have a website that's basically just a resting website that I put together. It's just blbcap.com, and it has some trading information on how I trade the breakouts, balance information on balance markets, and how I set up my order flow charts. I'll probably be adding more stuff after the kids go back to school when I have a little bit more time. And I'll try to keep pretty busy on Twitter and help out. And I like helping out. I don't mind it at all. So that's pretty much all I can do. I don't want to take on anything else.
Absolutely. No, that's cool. That's cool. So what is your Twitter handle?
It's BLB Capital.
Okay. BLB Cap. And, as you mentioned, you don't mind helping people out. Would you be open to answering some questions if listeners have any? Maybe if they just write in the comments on the Chat with Traders website below this episode?
Oh, absolutely. Absolutely. I talk to people every day. They Skype me. They DM me on Twitter. I have no problem helping anyone out as much as I can. I actually enjoy it. So
sweet. So anyone listening, if you have a question that you'd like to ask Ben, go to chatwithtraders.com/the episode number of this episode. I don't know what number it'll be just yet, but it'll be chatwithtraders.com/episode number. Scroll to the bottom of the page and you can write your questions in the comments area at the bottom. I'll obviously keep a close eye on that and let Ben know of anything that comes through. Ben, again, thank you very much for doing this, man. I hugely appreciate it.
Aaron, thank you. Appreciate it.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
You mind if we make one more stop before heading back? I need to run a Target.
100%. Let's RTT. You thinking of stuff for the dorm?
Yeah. My mom gave me some good tips on must-have essentials. We for sure need underbed storage, handheld iron for wrinkles, maybe even a mini Keurig for Mondays. Am I right?
All right, bet. Because I was already thinking about keeping my clothes looking fresh at college, so you better be sharing that.
Of course, man. Whatever I get on this run is yours too.
Twin.
But for real, let's go before they close.
Find everything you need for college at Target.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
LinkedIn is pretty amazing at helping you grow your small business. We cannot stop your new clients from emailing you at 3 a.m. We can help you sell, market, and hire in one place. We cannot help you be in 3 places at once. And while we can't help you organize your calendar, LinkedIn can help you land more clients so you have a calendar to organize. Grow your small business on LinkedIn. Learn more at linkedin.com/smallbusiness.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Yo, what's up? Welcome back. My guest on this episode is a former stand-up comedian turned questionable stockbroker turned day trader. Folks, I'd like you to meet Kenny Glick. During the 90s, Kenny went from the stages of comedy clubs into a hyper-aggressive brokerage firm, which he describes as being identical to scenes from the movie Boiler Room. And he has some wild stories to share, which you'll hear about very soon. Once Kenny realized his morals were getting in the way of his ability to peddle junk companies, he went on to pursue a career in trading stocks and options. And that's also what we go into great detail about during this episode, is how he trades today. Additionally, you'll pick up some simple chunks of wisdom which you can apply to your own trading as well, if you choose to. Now, Kenny talks about some recent trades and mentions a few tickers. So I just want to mention this was recorded on the 27th of September 2015. after the close, just in case you want to go back and look at the charts. And I should also take this opportunity to remind you, nothing discussed on this podcast should be treated as a trade recommendation. You are responsible for your own decisions. So without any further delay, here is the conversation I had with Kenny Glick.
What's shaking, bro?
Not much. Nothing too exciting. I've just been actually doing updating some spreadsheets, getting all my tax return stuff ready. So just riveting stuff, you know.
Fun times, yeah.
Far from it, actually. How you been? What's going on?
Good. Today was a nice day. It was a nice. I do these once a week. I try to get my guys together and we do a little schmooze fest for a couple hours, talk about some swing trades and some option ideas and that thing. It's a little bit easier to talk about some concepts when the market's not open and I'm kind of bent on trying to find something to do, you know?
Okay, cool. Very good. Well, man, it's awesome to be speaking with you. I'm thrilled to have you here. Let's get right into this. So I want to talk to you about life pre-trading and all that stuff. So what's the go? I mean, I believe you were a stand-up comedian. Tell us a bit about that.
Oh, man, going way back. All right. Well, I was always a pretty amusing guy. So my friends were telling me back in this has got to be like almost like graduating high school, going into college. I had a comedy club not too far from my house called Pips. I lived in Sheepshead Bay. It's kind of where Andrew Dice Clay got his start. So I started rolling in there, and I talked to the owner. I was like, can you give me a shot to get up on stage one day? And, he let me get up there, and then, I did my thing. And, he pulled me aside. He's like, listen, your material was kind of, a little bit childish, because I was only like, 19 at the time. And, but he's like, you got it. He's like, you're up there. You're having a good time. You're being yourself. That's exactly what you got to do. And as long as you could, work on some material and, just keep being yourself with that energy. Because I run around on stage having a good time. And, I do a lot of silly voices and a lot of just, weird faces. And, it was pretty cool. I got to open up for Andrew Dice Clay about a year later. And it was pretty much the thrill of my life. I got to be the opening guy for when Dice came up on stage. And it was pretty awesome. And then, I was asked to, go to California with them when they were headed out there. It was the owner of the club. He was selling the club, and Andrew and a couple of his guys, this guy Wheels Parisi, were moving out to L.A. And I kind of chickened out. I'll admit it. I wasn't ready to leave the family at 19, move across country with a dream. I didn't have any money in the bank, and I kind of chickened out, but I didn't give up on the stand up. I kind of worked for Saturday Night Live for a while. I got an internship there, which was amazing. I got to meet all the people that were heroes to me. Phil Hartman. I was there when Adam Sandler first got there. My claim to fame was that Adam Sandler was pegging me with M&Ms one day, and I turned around, I caught one in my mouth, and he's like, "How'd you do that?" And I was like, "Keep throwing them at me." And I just he kept hitting me, and I was catching them in my mouth. And next thing you know, I was hanging with Adam Sandler, even though I worked on there was kind of like these fake product commercials right after the intro. We were called the film unit. So we were like the bastard people. We were like the unloved people of Saturday Night Live. But it was a lot of fun. I got to hang out there, and I worked on Friday nights where they do the run-throughs. So I got to see the show before the show even aired, and I got to hang out with, the cast. Kevin Nealon was there, and what's his name? The heavy guy that died. He just got there. Chris Farley. And it was just like a fraternity, and he was just nuts, just going crazy every night, where they had to tell him to calm down and it's time to work. And what I did was after they got done filming what they had to film, I would take the film, run it down, a couple blocks away to was a place called Broadway Video. I'd wait for them to do some editing, then I'd bring it back to the director, and he'd say if it was good or not, and that was my job. It was pretty cool. And sadly, one day, apparently I answered the phone with a funny voice. I guess I did, but I had Saturday Night Live. Can I help you? And the guy on the other line said, "Who the hell is this?" I was like, "It's Kenny." And he said, "Why'd you answer the phone with that stupid voice on?" And I was like, "What voice?" And he's like, "Don't be an asshole."
you know what voice you just put on. And apparently behind the scenes of Saturday Night Live is no fun. And this guy, you know, next thing you know, his assistant was telling me, you better be out of the building before Jim gets here because he's pissed. And I don't even know what I did. And I was working, you know, I'd work there Thursdays and Fridays right out of school. And I got fired from a job where they really weren't paying me. I was kind of a slave. I was like, who fires a slave? But all right. But, you know, I had some fun there. And then I went to work for the Jon Stewart show before it was the Daily Show. I got to, you know, hang with Jon Stewart, which was, you know, he's a hero of mine. So it was pretty cool, you know, for a young guy to be involved in all that.
Yeah, that's a very cool story, man. And can we find any videos of your stand-up acts online anywhere? Do they exist?
Oh God, no.
No.
I had a few up there, you know, talking about, you know, my humor back then was, you know, just about getting drunk and fart jokes and, you know, not having and trying to get laid and all that stuff. Now I'm going back on stage. Actually, just went on stage about a week ago. Did more of the family structure and, you know, just ripping into my kids. And, you know, it's always shocking when, you know, a father starts ripping their kids on stage and people are having a ball. And it was a good 6 minutes, 7 minutes. Everybody was laughing. And, you know, I came off the stage and somebody said, you know what? You're like a weird Louis C.K. And I was like, sure, I'll take that. I'll take that all the way to the bank. I'll be the weird Louis C.K. any day. So that's my new thing now. I guess I'm the weird Louis C.K. And, you know, I'm more of a storyteller, and you know, like I said, I do some silly voices, and I'm very animated up on stage. So I have a ball up there, and you know, now, you know, 15 years later from, you know, when I was up there, now I have no fear whatsoever. And you know, you think being a trader is hard? Imagine getting up on stage all by yourself with the light blasting in your face, and everybody's waiting for you to be funny. Within 30 seconds, these people either like you or they hate you. There's no middle ground. And it's a rough business. It's a rough business.
Yeah, I don't doubt that at all. I mean, I imagine the crowds can be very savage. Just making a presumption here, I presume most comics don't find themselves becoming traders. What appealed to you about this, and how'd you get into it?
Well, I always liked the market. You know, I had a math teacher in the 5th grade, and he did a stock market project where we had to do some research and track our stocks, and it was more fundamental analysis. Obviously, we didn't know anything about charting, and you know, back in the day, especially me in the 5th grade. But ever since that time, I was interested in the market. But the silly part about this was I was doing stand-up comedy one night, and some guy rolled up to me after the show wearing a suit, and nobody was ever wearing suits at a comedy club. So I'm thinking this guy might be somebody. Maybe he's an agent. Turned out to be a stockbroker. He's like, you know, you're a funny guy. Why don't you use your sense of humor to try to sell stocks and make some money? Because you're probably not going to make any money being a stand-up. And I was like, well, that's kind of a backhanded compliment, but yeah, sure, man. I'll come out. Where is it? It's out in Long Island. And the name of the firm was like something Wall Street or something that sounded like some, you know, real firm. And next thing you know, I'm out there in Long Island, and I wasn't there for more than maybe a half an hour. The guy handed me a script. He's like, here's a list of 300 phone numbers. Call these people and ask me if they like the stock market. Give them a little bit of idea of what we're selling. And if they're interested, yell for me, and I'll come run and get the phone and try to make them some money. And I'll pay you if they close the deal. And it was just a you know, the movie Boiler Room, Wolf of Wall Street. It was right there, but this place was so shady, and I was very unhappy within a week because it wasn't for me. You know, I could see right away I didn't fit in. But you know, somebody came up to me and he said, you know, you look like you're kind of lost here. We're going to open up our own firm on Wall Street. You'll take your Series 7. We're going to be doing IPOs. And the first thing I said was, what's an IPO? And he's laughing. And I'm like, yeah, buddy, I have no idea about this business, man. If you're willing to teach me, I'm willing to learn. What's a Series 7? And next thing you know, it's probably the first time since college I went 30 days without smoking weed. Because I was like, I gotta clean up. I gotta take a test and get a job. This is serious stuff. And then I took my Series 7. I got a 93 on the Series 7. And I come in all proud, and I'm thinking everyone's going to throw me like a parade. First thing the guy says to me, the manager says, man, you're probably not going to make it in this business. And I was like, what? I just busted my ass to get a 93 on this test, and this guy's already telling me I'm going to fail. Because it really turns out that it was the knucklehead, high-pressured salesmen that were making all the money in this business. Someone who knew stuff and was, I guess, educated. And if you couldn't sell, you were nobody in this guy's eyes. And I was, I was shown the light that I really was just a nobody at this place. And, I did what I had to do, but it was just, it wasn't for me.
Right. So just backing up a little bit, you said that there was the stockbroker who was in the comedy club. What was he doing there? Was he actually like poaching comics to come on board at the firm?
He just happened to be there. He was with a friend, and they just rolled up to me at the end of the show. And, I guess, they propositioned me. They told me they'd give me, I think it was $400 a week, which doesn't sound like a lot of money. But, when you're a young guy, I was like, yeah, sure, I'll come out to Long Island. You're going to pay me cash? All right, I'll see what this is all about. And, that place I was only for, it was maybe a week. And if you remember this, I don't know, you're from Australia, but back in the day in Brooklyn, people thought it would be cool to put neon lights, like these kind of like halogen neon lights underneath their car and to like make the bottom of their car glow. That's what we were selling. That was the company. And my God, what a junk company. I mean, most of these companies that, I jumped from that firm to the next firm to the next firm. It turns out that most of these companies weren't even real. And that's really when I started realizing that this is the most shady business I've ever come across ever. Because we were pitching a company, let's call it Consolidated Incorporated, whatever it was. And it was supposed to be some huge corporation out in Colorado. And the next thing you know, I'm hearing them answering the phones in a back room of the firm as Consolidated Technologies. So I was like, wait a second, isn't this company supposed to be out in Colorado somewhere? Shut up, get out of the room, close the door behind you. You didn't hear anything. And I was like, okay. And, another really glaring moment of my, brokerage career came when they would do all these dog and pony shows. They'd come in, and I remember there was a retractable syringe company for dentists. The Novocaine was on the top of the needle. The needle would, retract into this thing, so you wouldn't have to call the waste disposal unit, and you could deposit the syringe anywhere you wanted in a regular garbage. Genius concept, awesome concept, $5 IPO. It was going to go to $50 according to these guys. We had the scientists there, dentists there. We had this whole great show. So the day we start pitching the IPO, I get called into the office because I'm still a new guy. And so after all this stuff, they're telling me how awesome this stock's going to be. Kenny, don't put any of your friends or your family into the stock. What? You just told me it's going from 5 to 50. I'm about to buy 10,000 shares with my dad. Don't put your friends and family into the stock. So here's one guy, they're throwing a parade and, streamers and dog and pony show telling us this is the greatest stock in the world, but don't put your friends or your family into the stock. And I was like, all right, this is getting a little bit out of control now. So, there was a couple more shady things that happened, and I finally said, you know what, this isn't for me. But at that point, I had learned enough concepts where I thought maybe I could do this for myself. And coincidentally, 1992, 1993, the day trading didn't really take root until SOS. So I just was learning a little bit about charts. And then coincidentally about, I guess it was a year later, 1997, 1998, really, a friend of mine was opening up his own firm. He explained to me what this SOS trading was all about. And there I went, took my bar mitzvah money, plopped it into an account, and off I went.
Right, okay. So just before we get into more about your actual trading, I'm still really interested by this this broker story. So how did you actually convince someone to buy stock? Like what tactics would you use, and how successful were you at actually closing people on the phone?
Aaron, how are you? Kenny Glick from Patterson Travis. Listen, I'm not calling you with any specific ideas right now. I got your name from a high roller investor list that we purchased. I just wanted to know if I had an idea over the next couple of weeks, would you be interested in hearing about it?
Sure.
Okay, great. Well, listen, like I said, I wasn't calling you with any ideas right now. What we're going to do over the next couple of weeks, our traders and the owners of our company are researching some breakthrough scientific research company that might be an incredible opportunity for you. So what I want to do is in a couple of weeks, I'm going to call you back. I'm going to give you a kind of a heads up of what that company is all about. And if it's something that you're interested in, then we're probably going to try to secure a block of stock. Now, you probably know about the market. You know there's a bid and there's an offer. What we try to do is we try to get the stock in between the bid and the offer so we can offer you a discount on that stock. So when you buy it, you're actually ahead of the game. So when I do call you and I give you this information, you're probably going to have to make a snap decision. Is that something that you might be able to do? You know, if I give you a call, you'll be able to make a decision within a couple of minutes because I'm going to be really busy that day, Aaron.
That's hilarious. Like, how many times did you do this each day?
I would try to make 300 phone calls a day. Oh, that was what was, my manager would make me do. And out of those 300, you'd get about 15 or 20 people that were legitimately interested in hearing back from you. And then would come the buttering up situation. And I'd call, Aaron, it's Kenny again. How are you? I told you I'd call you. Listen, I don't want to bother you, and I'm kind of busy right now, but let me tell you a little bit about this company. And I would talk about the retractable syringe. And then came the third call closed. Aaron, it's Kenny. Listen, we got that block I was talking about. The stock's trading right now at 550. I secured a block at 485. I could put you in there, but I can only get you 1,000 shares at that price. Is that something you might be able to do? 1,000 shares at 485? Tell me right now, because I can only get about 10,000 right now at 485. I could get you 1,000. That's about it. You're good? All right. You're in for 1,000 shares. Let me transfer you over to my secretary. She'll get your information. Welcome aboard, Aaron. Hopefully this is the beginning of a beautiful relationship. Thanks a lot.
And how many of your clients actually made money?
2.
Out of what, hundreds of thousands?
I probably had a book of about 80 to 100 people, which was pretty good. I only did it for maybe 18 months, and some trades were let me tell you, the reason that the clients that made money was once I started trading my own account and buying my own stocks, I started pitching the stocks that I liked. And this was one of those glaring moments that I was talking about. So, I just got back from Vegas. I was just turning 21 or 22 at the time. And I noticed every slot machine was made by one company, IGT, International Game Technology. I bought 1,000 shares. I got my dad into a couple of 1,000 shares. And it was like a $22 stock. Thing was rocking and rolling, 25, 27, 30. So I'm calling my clients, some of the IPOs hadn't tanked yet. Some of their stocks weren't at zero at this point, so we still had a decent relationship. And I talked to them about IGT. And, I had one guy, he's like, you know what? I'm totally with you. They're opening up a casino, a couple of blocks from, not a couple of miles down the road, the Indian reservation. And whatever you're saying, I'm into it. $22, I'll buy 5,000 shares. I almost vomited because here I am, opening accounts for, 4,000, 8,000. This guy wants to buy 5,000 shares of a $20 stock. So I'm freaking out a little bit. I don't even know what to do. So I'm like, okay, that's great. So I roll into the office and I'm sweating, but I'm extremely happy because I'm going to, open this guy for $100,000 trade. And, the guy puts his arm around me and he said, listen, Kenny, we hear you pitching this IGT. We really want you to pitch the house stocks, but that's a fantastic trade. On that $100,000 order, we're going to give you about $250 commission, which we're going to take half of. And after SEC fees and NASDAQ fees and some other fees, you're going to walk away with $80. If you take that $100,000 and put it into Consolidated Technologies from Colorado or the retractable syringe company, we're going to give you a $25,000 commission check. Who are you looking out for, Ken? And I just took my Series 7 not too long ago. So he says, who are you looking out for? The client? And he laughs and tells me to get the fuck out of his office. And right there, I was like, wow, this is absolutely insane. But there I was calling my guy back saying, you know what, maybe you should buy maybe 3,000 shares of IGT. You might want to sprinkle in some of this retractable syringe company I was telling you about last week. And, you know, I had to make a little bit of money. And that's probably the lowest point of my career when I made that phone call to get this guy into a stock that I knew at this point wasn't the best. But, hey, and that was the only guy I did it to. But you know what? The guy made, you know, good amount of money on IGT. And that really made up for the dog crap stocks that this firm was pushing. So...
Right. And that retractable syringe, that's an example, or that's actually brought up in the Boiler Room movie, isn't it? I mean, it's been a couple of years since I watched it, but I don't know if you've seen it.
Yeah, I've seen Boiler Room. I don't remember them doing the retractable syringe. We also did the Stratosphere, which I couldn't believe that we were doing an IPO of a Las Vegas hotel. And I was like, all right, this actually sounds legit. And even that one kind of tanked. It was incredible. But I don't remember in the Boiler Room what they were selling. I know they were selling, what was it, Teradyne Systems in Wolf of Wall Street or something, with applications of government and when he's going off, and those guys like, how'd you do that? But you know what's the best part of all those movies is the Ben Affleck speech. Because I rolled into these firms wearing my bar mitzvah suit. I was still a little kid. I was still wearing a suit that was a decade old with a tie that I bought on my way there for $1 on the street. And this guy's looking at me. He's like, all right, the first thing you need to do is leave and go buy yourself a new suit or you can't come back. And I had that speech that Ben Affleck did, it was almost verbatim. How much money we're going to make, all these suits we're going to have. You want to, you know, go out and buy a car because you're going to be rich. I heard that whole thing. It was unbelievable, that movie. And the whole thing with, you know, getting recommendations and then yelling to the broker and the other guy coming over and closing. That movie was dead on.
Did any of the guys who you were working with at the time, did any of them make serious money doing this?
Some of the guys, yeah. This one of my friends, I guess I could call him, one of the guy who would be a little bit honest with me, this guy Ben, he was you know, bringing in $25,000, $30,000 a month easy. You know, he had $100,000 month one, driving a, you know, and this is a kid that I kind of knew from Brooklyn that was a knucklehead, and I'm being nice about it. This kid was not a smart kid, and you know, I was in the high Excel, you know, program, taking advanced math. This kid was like, you know, cutting out of school and, you know, just getting in trouble. Next thing you know, he's driving a Ferrari, making 25, 30, 40, 50, $100,000 a month. And like the original guy who laughed at me when I got the over a 90 on my Series 7, it was all about selling. It didn't matter what you knew. It was about tearing these guys or ripping these guys' heads off or tearing them up, breaking them down, and then asking for the sale and not saying a word. You know, it was just, you know, whoever spoke first after you asked for the sale loses. So you would just sit there in silence till the guy made a decision. And the best was, everybody knows about the rebuttal book. Oh, God, Aaron. There was a kid in this, I don't want to drop some names, but he sat there, he had a binder. So no matter what you said to me, he would flip to that page. So, oh, Kenny, you know, I'm really, you know, I like the idea, but I asked my wife. Next thing you know, he grabs the wife tab on the spiral notebook. He opens the wife rebuttal page. Aaron, let me ask you a question right now. Your wife's out in Macy's. She's buying a blouse. Is she calling you right now to find out if it's okay for her to buy that blouse and how much that blouse costs and what color you think that she should buy? I don't think so. Chances are you're the one making the money in the family. Am I right, Aaron? So this is just a decision that you can make right off the bat, can't you? And there was a rebuttal for everything. And this guy, again, not the smartest guy in the world, but he could sell anything. And it was something to watch. I used to just sit and watch in awe. And, you know, he would have the guy on speaker, just like the movie, laughing his ass off while he was waiting for the guy to reply. And he already, you know, he already knew what he was going to say back to the guy no matter what. And he would just not get off the phone without getting some money out of everybody. It was incredible, actually. And I just couldn't do it. I couldn't be that high pressure, rip somebody's head off. I was the friendly comedian guy trying to, get people to laugh and schmooze and trust me. But then once I lost trust of these firms, you could hear it in my voice. And obviously these people could hear it in my voice. And I didn't have any faith in what I was selling. And, once I started learning about charts, and that was the end all be all, because I raised my hand at a meeting one day and I was like,
well, if it breaks 750, this thing doesn't really have any support till 5. Maybe we should start selling it here at 785 because it looks like it's about to break.
Kenny, we don't give a shit what you think you know. And if you ever mention a chart here, you're fired. And that was it, It was, and that's being nice about it. It was almost to the point where shut up or we're going to beat you up. It was nuts. And that was when I left. And, that was the end of my brokerage career.
That's full on, man. What a crazy story. So let's talk a little bit more about your actual trading. So tell us maybe what were your first few years like as a trader? Were they good, bad, average? How'd you go?
Luckily, I came into a market that was just about to explode. This was, 1998 when the internet was starting to catch on. You had Netscape, then you had a company called iOmega. And, from what I knew about the market, stocks never went up 10%, 20% in a day, 50% in a day, unless it was some sort of cancer breakthrough or, kind of a takeover. And then we started seeing these internet stocks, DoubleClick and Real Networks and these internet providers just going up every day. So it was kind of a hard adjustment for me to appreciate the fact that, hey, this might be something new. Stocks can rip like this, and this is incredible. So I just started, nibbling away at, some of these high flyers. We didn't really call them high flyers at the time, but they became high flyers. And, iOmega was just a disk drive company. Then there was, a couple of companies that made pieces and parts for computers. There was something called the SCSI drive, a company called Adaptec, and they were flying high. And, it was a crazy time. I luckily had a knack for it. So I started doing all right at the beginning. But once I learned about options, that's what got me in trouble, because I took whatever I made and started gambling with options. And I call it gambling because I was just buying them willy-nilly, not looking at the charts, going away from everything that I learned about when to buy a stock. And I was just buying takeover rumors. I was just, buying anything. And I wasn't thinking about it because I thought, if I can make money trading, then I could support my gambling habit on these options. But eventually the gambling habit on the options outweighed what I was doing trading. And I found myself in a pretty bad situation where I had to go then, just wander the earth, I guess you could say. I would go to Wall Street and I didn't want to go into the office. I didn't want to do anything. I didn't want to talk to anybody. But I'd go to Wall Street and basically wander around until my friend said, "What are you doing?" And I was like, I try to grow a beard. I'm not the best. It was just the nastiest beard ever. But I'm walking around in jean shorts, Timberlands, and a Grateful Dead T-shirt, for a couple of months until I got my head right. And then I just went back and I was like, all right, these are the concepts that my guy showed me that work. I'm going to just stick to this, and that's all I'm going to do. And then suddenly it became 1999, where you really didn't have to know how to trade. There was one thing to remember. If the stock breaks the previous day's high, buy it. And that was all you needed. There was nothing else. It was pure momentum, and it was fantastic because I was making 5-10 grand a day by 11:30. And then just, again, being a pothead probably didn't help because here I'm making all this money. So it's 11:30. Now I could go to the park and, play hacky sack and hang out with my friends, or go play paddleball and smoke a joint. And I generally never went back to the office. And then I would see every stock that I sold out of at 11:30 up another 5 or 10 or sometimes 20 points, where the more disciplined guys, when I was making 1,000 or 5,000 a day, they were making 20 and 30 a day. So I might have wasted that opportunity, but at the time when you're in it and you've never made that kind of money before, I mean, it was adding up very, very quickly, and I was pretty happy about it.
I don't doubt it. I mean, $5,000-$10,000 a day. Who can complain about that?
Right.
Study
and play. Come together on a Windows 11 PC.
And for a limited time, college students get
the best of both worlds.
Get the Unreal College Deal. Everything you need to study and play with select Windows 11 PCs. Eligible students get a year of Microsoft 365 Premium and a year of Xbox Game Pass Ultimate with a custom color Xbox wireless controller. Learn more at windows.com/student offer. While supplies last. Ends June 30th. Terms at aka.ms/collegepc.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
Was there anyone at this point in time who was really sort of helping you with your trading? Someone who was, I don't know about a mentor, but someone who was like guiding you in the right direction? Like, I don't know, was it one of the guys at the firm who kind of taught you the ropes? Was there anyone who sort of played that role?
Yes, there was actually 3 guys. Well, I guess 2 guys were constantly trading, and they had no problem letting me sit behind them and ask questions while they were trading, which is kind of annoying. One guy, you know, there was, well, let's call them Joe and Mike. Then you had Bill. Joe and Mike had no problem letting me sit behind them. But Mike, he was the guy that was making, you know, 30, 40 grand a day trading, had a lot of positions on. He didn't want me sitting behind him. He didn't want me asking questions. But, you know, Mike and whatever his name, Bob, I don't want to drop their names because in case they ever do listen, they don't want me to tell the story. But they were just awesome. And all they did was tell me everything in if-then statements. If this happens, then this should happen. This is where it could go, and this is where you put your stop, and this is what you think. This is where we think the stock could go because of this. And I just learned everything on if-then statements, and it wasn't till, you know, a couple of months later till I finally started really starting to look at the charts. Because like I said, back then it was, if you saw a stock breaking the previous day's high, you had a 90% chance of success just buying that stock at that price and watching it take off. But there was a guy, and I'll say his name because I still use his concepts to this day, a guy named Isaac, and he just would drill these, you know, little concepts in my head. It wasn't about charts. It was about sentiment. It wasn't, you know, it was about seasonality and sentiment. And one of my favorite things that he said was, you don't have to rush into a trade. You could be late and right. And it's better to be late and right than early and wrong. Just wait for the trade. You'll be able to make the meet in the middle. I was like, okay, that's great. So it took the speculation out. I just waited for something to present itself on the day. I rarely took overnights because that was the, you know, the typical day trader. You weren't taking overnights. That was the whole concept. You come in the next day, fresh, ready to go, and just try to make the meet in the middle. You know, if the market gapped up, you know, above some of those prices that you were ready to buy the stock, you would just pile in anyway. And it was just, it was incredible. But, you know, never had to speculate too much. And, you know, and then it was Isaac that really made my fortune by explaining to me the concept of, what's it called when all the dogs start moving? it's kind of the end of the bull market, the dash for trash, I guess they call it, right? He told me, and he was actually a penny stock trader. They had a consortium of traders, and he said to me, Kenny, I've never seen some of the stocks that are moving move. Not only did they not move, some of these stocks are up 300%, 400%, 1,000%, 10,000%. Some of these stocks were 5-cent stocks that would go into $5, $10, $15. This market is going to crash within the next month and a half. And that was in February of 2000. So I was like, you know what? You were my mentor. I agree, because I started reading up on some of these companies like CMRC. It was a company called Crossroads, just to name a few. Some of these companies had 8 employees trading at a market cap almost as much as GE, and they had no income. It was basically, I guess, revenue, and that was it. And these stocks were $30 stocks that were trading in the 800s, sometimes 1,000. So I started shorting them, and I was taking a beating for about a month. And then they all came home, and it was fantastic. I mean, I was a scalper by nature, you know, but back then scalping was for a point or two. These stocks were falling in 10, 20, 30-point increments. I didn't even have a chance to cover. So once you're up that much money, I was like, you know what? Maybe this stock's just going to roll over and die. I rode one of those stocks from about, you know, I guess around 400 down to about $4. And it was, I don't even know, you know, a lot of those companies don't even exist anymore. Everybody remembers CMGI. You probably remember, you know, SDLI. It was just nonsense that was going on back then. And, you know, eventually, obviously, you know, they all came home. And my problem was I made a lot of money on the crash. But then when, you know, these 20 stocks that I destroyed got down 85, 90%, I bought them all. And guess what? About 80 to 90% of them went to zero. So I lost a big chunk of money thinking I knew a little bit more than I did, because I believed that a stock that goes from $800 down to, you know, 12 or 15, it's got to be a buy here. And they all went to basically zero except for Akamai. That was the only one that I owned that ever staged a comeback, AKAM. And it was a pretty sick time.
Right. So just skipping forward a few years, how'd you go during the 2008 crash? I believe that was an interesting period in your career also.
Yeah, it was a lot of fun. It was really, you know, I had a couple of friends working at Bear Stearns, and, you know, this was right when things started getting a little antsy. The word subprime was coming around. And there was rumblings that Bear Stearns might be in trouble. I remember Kramer came out and defended them. And here I am. I got a couple of guys telling me that they're not doing any business. They're not doing any more loans. Their trading is like done. People are just sitting around staring at each other. And this guy's asking me if I know anywhere I can get him a job. I'm like, you work at Bear Stearns. I'm an idiot day trader. I was like, really? You're looking for a job? He's like, yeah, me and my 3 friends also. You know anybody? And I was like, seriously? And it had to be maybe, you know, a couple of months later when the shit hit the fan. And sadly, you know, I started shorting Bear Stearns when I heard these guys were looking for a job. And I think it was about a week after I shorted it that there was a rumor that Warren Buffett was going to come along and buy the whole company. Stock spiked about 15, 20 points. I figured I was going to lose the whole nut that I put into some puts. And I was so happy to see Bear Stearns rolling over, and I turned this big loss into a gain again that I got out. And obviously, you know, this stock eventually went to zero, which I could probably be living off that money for the rest of my life if I would have stayed with that position I had on. But I didn't do as well on that crash than I did in 2000 because I wasn't as convinced that the end of the world was coming as I was in 2000. In 2000, it was easier for me because I saw how the stocks went up, and I figured, all right, these are going to give back at least 50, 60% of this parabolic move that they had. 2008, you know, I didn't want to believe that capitalism was on the ropes and that the entire banking system was about to collapse. it didn't want to set into my brain. So at one point, I was happy just nibbling on some Lehman Brothers short and Bear Stearns short and, some other stocks, but, nothing like 2000. But the best part about it is when the real shit hit the fan, I was in complete cash. Sadly, it could have been the most monstrous trade I've ever had in my life, staying short the stuff that I had. But I was very content being out of the market, being in cash, and just waiting for, some stability to come along. Because I figured, some of these stocks are going to be fantastic buys, even if I have to wait 5 or 6 years. And obviously, 8 years later, look where we are.
Yeah, so tell us about how you traded post GFC. I mean, we were talking a little bit before this, and you said that you kind of struggled a little bit as the crash was recovering.
Well, because I came from the school of shorting, and most of the money I've ever made was shorting. So after 2009, and I was convinced, I was like, all right, the government's bailing everybody out. We're probably going to have a monster rally. But then after 2009, 2010, 2011, as we kept going higher and higher and higher, I thought that I saw a little topping formation on the S&Ps and the QQQ in particular. And, I decided to go about 50 times huger than I had ever been, in the last 5 or 6 years. And it was going well for about 20 minutes. Skipping around the office, I called the highs of the market. We're going to roll over and give back a big chunk of this. I'm going to be rich and I'm going to retire. And somebody said, Ken, you might want to get back to your desk. JP Morgan, I think it was JP Morgan or Morgan Stanley. Yeah, they just upgraded every stock. And they came out with some lists. They put all these new predictions on the S&Ps and on the Qs. They upgraded like 30 sectors. And I just sat there like a deer in the headlights, just I couldn't believe that I left this money on the table. And then when it started to become a loss, my mouth was dry, my hands were sweating. I didn't know what to do. And I just sat and watched it for an hour, hoping that, maybe we'll roll over. I could take some of this off. And then at one point I was it just went parabolic right, after 3 o'clock, and it just kept going. And I took half of it off, and I was like, please God, maybe they'll give some of this back tomorrow. And they capped the market up tomorrow, and we started ripping again. And it was a nightmare. And if you watch any of my videos on YouTube, that's when I really became this psycho bull, because I said, you know what? What was I thinking? The government has saved us from the Great Depression #2. They seem to have taken over the stock market. And why would I want to fight the government, fight the Fed? I'm just going to go long. And that's when I got, I bought some Qs. I think it was March of 2012. And the family's still in the Qs. And, it was a great buy. Obviously, I wish I would have bought a little bit more of everything. But, it was a pretty good move. But, man, did I take a beat down in, I believe it was March of 2011 or March of 2012. I try to block it out of my memory, as much as I can, because it was a horrifying day. It was, no doubt.
Yeah. Okay, so let's talk more about how you're actually trading today. Let's get into that. So, I mean, how would you describe what you do, like kind of your trading methodology that you're implementing these days?
Well, I've gone back to what was doing well in 1999 and 2000. Obviously, it's not as easy. We were trading in eighths of a point and quarters of a point, so the same momentum that you were making 12-cent and 25-cent increments, and I was trading a lot larger size. But I've gone back to what was making me money. That simple concept of a stock breaking the previous day's high, it's similar to that. What I try to do now is it's hard because there's not many stocks that are getting beat down. But I've been pretty good at finding stocks that are coming out of a malaise or coming out of a depression or just coming out of just sitting around and consolidating. And once I see them reversing and breaking some previous, not just a day, but going back, a month, sometimes 2 months, sometimes a year or so, that some of these stocks have been sitting around and doing nothing, that once they break out of that channel or that range that they're sitting in, the move, especially because we're in the greatest bull market of all time right now, in my opinion, once the shorts get nervous, the stock goes and has a monster move. And I just go from stock to stock and I try to find these. And even if I only find one of these a week, it's enough to make a living off. And if you want to trade for a living, you can find these ideas on a more subtle basis. It all starts with reversals. And I know you have a friend of mine on the show not too long ago, Zach. I was calling him the VWAP Emperor, because about 3 or 4 years ago, he told me, he's like, that candlestick breakout pattern that you're looking at, once it breaks over the VWAP, the stock really starts to get going. And I said, what's VWAP? Because again, I'm pretty familiar with a lot of different concepts, moving averages and, stochastics and Bollinger Bands and all this crap that I was trying to learn. And he's like, why don't you plot the VWAP up to, on your charts just to give you a guide? And I was very hesitant because I was set in my ways. Things were going well. And once I plotted the VWAP on my chart, using, the 1 minute and sometimes even a yearly VWAP, it's remarkable that this thing's been coming into play so often. But once these stocks reverse and they break the VWAP, the trades have been working about 90% of the time. Now, I'm not saying I find these every day, but if I find 3 a week, that's really all I need. And lately, it's been phenomenal. I've been finding, almost 1 a day. Found another one a couple of days ago. I don't know if you want to get into symbols, but most of the charts, and I could give you a couple of symbols. It all started with Taser. If you look at like a 10-year chart in the Taser, and you plot that next to an AMD chart, or if you look at this stock called ENDP, or you look at GoPro, or you look at what was the one that we just got into, First Solar, FSLR, and today we got into CLDX. They're basically all the same type of stock. And if you look at this chart on CONN, these are the stocks that I've been making money on lately. And I don't have to be a very active trader, because all I'm doing is I'm finding these positions, I'm plotting out where I think they can go, and then I'm looking at 9-month and yearly VWAPs, and my God, they're all going to these 9-month, yearly VWAPs when they start to break out. So I'm using the VWAP as a guide to where I might be looking to take some profit. And if it does break over these yearly VWAPs, you're getting another 10, 15, 20% on some of these stocks. This Con stock, this is a electronics resale place that's, I've only seen them in Vegas when I was out there. Stock was an $85 stock, sitting at $6 about 3 weeks ago. They had an earnings report. Stock was gapped down into the reversal, broke over the VWAP that day. And the reason I day trade is to find swing trades, because I've been doing much better on my swing trade ideas than the day trades. Because when you're day trading, you're sitting there and you're watching every penny go back and forth. Oh God, should I get in? Should I get out? Should I get in? Should I get out? Once these stocks break this, what I call the exhaustion situation formation, they're gone. First Solar, who I never thought in a million years I'd ever look at that stock again. I hate that stock. First Solar, one of the worst stocks ever. But the other day, met the criteria, broke over the VWAP, stock reversed. Next thing you know, you're getting a 4-point move. And if you're looking at, I know some of you guys are thinking 4 points is not a lot, but if you went out, and bought the calls for 40 cents and you're selling them for $2 3 days later, it's pretty good. And that's what I've been doing lately. And I'm trying to teach people this exhaustion pattern that I found, because what's great about it is that not only do you have the shorts who are freaking out because the stock suddenly started going back up, but then you have the encouraged longs who have been dollar cost averaging in these beat down awful stocks that start to buy more, and they get encouraged. And next thing you know, every once in a while, you get an AMD coming from 250 and 325 where the breakout was, that ripped to $8, and suddenly this could be a legitimate turnaround story. And then you got this Con, whether or not it's a turnaround story, I'm out of the stock. This thing went from 750, and again, I'm not telling you I catch the bottoms. It's the turn. Once it breaks over the bottom consolidation range, that you look for it to get to the next range. And this is a stock that just went from, $7.25 up to $11. And, this part you don't read about in books, but I love this stock short the other day because after the stock went from $6 to 11, some genius analyst, who I have no respect for analysts on Wall Street whatsoever, because I know how shady the business is. This genius thinks to put an upgrade on the stock after it moves 100%. So I was like, you know what, guys? That's your top. So look for this stock to give back a good percentage, or maybe all of this pop that this analyst, in his awesomeness, has decided to upgrade this stock. And in my theory, and this is, again, some people are going to get bent out of shape when I say this, but I know it happens. Analysts are paid shills. Let's assume you got a big amount of con short and you're getting beat up now because you didn't cover. You call your analyst friend, hey, do me a favor. Upgrade this stock tomorrow so I could short into your upgrade so I can make some of this money back, after it retraces. And that's what happens. I don't care what anybody thinks they know. Nobody knows anything. These analysts, and, again, just like GoPro, here's a stock that analysts were upgrading at $90, saying it was going to $150. It's the camera on a stick social media company now. It's not just a camera. So at 90 and 80 and 70 and 60 and 50 and 40 and 30 and 20, they don't think to downgrade it. But this genius downgrades it when it hits 1050. Boom. Yeah, sure, it went down 2 more points after he said it, but there you go. When some genius analyst downgrades or upgrades a stock after a monster move, it's almost like the Barron's theory. When Barron says, is it safe to get into the market? That's the top of the market. Should you be getting out of the market? That's the bottom of the market. It's incredible how it works, but I've been watching this for 20 years. It does work like that. It's incredible.
Yeah. Okay. And these trades you're describing here, are you trading the actual stocks or are you trading options?
Well, see, I will trade the stock at first. And, for instance, on First Solar, it all starts with a day trade. You catch the reversal, breaks over, my reversal price, we're in the stock. Now, the reason a lot of these traders and day traders and, basically anybody in general lose money is that they take a day trade that's not going their way, and suddenly it's a swing trade because they didn't want to take the loss. Next thing you know, they got an $80 loss they don't want to take. Next thing you know, it's a $250 loss. Well, if you didn't take an $80 loss, I'm certainly not going to sell it here. 3 months later, you're getting 10 Ks sent to your house. You're sitting on a conference call with a company that you don't even know what the hell they do is reporting earnings. Oh, man, I hope they say something good. This better be good, huh? You're sitting on a conference call. You're calling investor relations and making friends with the lady who works at headquarters, and that's the wrong way of doing it. Day trading for me is to find not only the day trade that works for the day, but to find these decent ideas to turn your day trade into a swing trade in a positive way. So First Solar started out, I think, I think it was 34.65. So it starts out at 34.65. I'm trying to pull up something. Around 34.65, we were in the stock. And we had a target of, 36.60. But am I going to hold 1,000 shares or 2,000 shares of First Solar? Absolutely not. I buy 1,000 shares, stock spurts 40 cents. Guess what I'm doing? I'm selling 800 shares of it, taking the money off the table, and I'm holding 200 shares as a swing trade to see if this thing actually gets to 36 and change. And then we're in a swing trade. Fantastic. Now, if it could break 36.60, we got a target of 37.50. But at that time, I want to be in 1,000 shares. So now that the swing trade's going my way, I'm thinking, hey, why don't we buy some 37.50 calls 10 days out here for 50 cents? Because if this thing really does pop and goes to 39 and change, we'll be able to make, about $1.50 on these 50-cent options. So that's the evolution of what I try to do. I turn the day trade, the winning day trade, into the swing trade, and then I'll start going looking for options because chances are I still want to be in the stock, but I don't want to commit too much cash, and obviously that's what options are for. You could have the same couple of thousand shares of First Solar without having to lay out $70,000. And then obviously if things don't go well, who the hell knows, overnight, 2,000 shares of First Solar, they come out with some bullshit news, or their solar panels are causing cancer. The stock opens up at $8. You got $1,500 worth of options. You're not worried. Yeah, you're down 1,500, but you got 2,000 shares of the stock, and the stock's trading at $20. Next thing you know, that could be the end of your career, depending on who you are.
Yeah, okay. So I'd be keen to hear a bit more about how you decide on a profit target. So, like, how far ahead of time do you have an opinion on where a stock might actually go?
Really comes down to, once I find this exhaustion situation formation, I start looking at the low prints from where the stock had broken down. So, I don't know if you're looking at charts. I'm sure some guys, if you want to follow along in this First Solar, when we bought the stock, all we were first looking for was to break this 34.65 area, which was, the high prints of the two previous candles where it came from. So then I look at the high print from where it broke down from, the low prints from where it broke down from, which is around 36.75. So that was my immediate target for the short-term goal. And then I'm thinking, hey, if this thing could break that 36.75, then I start looking at the high prints from a previous move up, which got me to about 39.32. So I'm thinking, hey, if this thing could break through here, we're looking for the next range. And now look where the stock is. You're at $39. I like whole numbers. I took some off the table today, and I'm down to the last lot. And now if this thing breaks today's high around 39.12, I'm looking for it to get to that next top range, which is about 39.72, and then I've got $40.40. So I plot the chart, and I give myself exact targets. Again, no one's going to hit them to the penny, but I have exactly what I want and where I'm thinking about selling about, as soon as I'm in the trade. I'll start drawing my lines and say, if this happens, then this should happen, going back to the concepts I learned in 97. If this breaks, then it should go here. If this breaks, it should go here. And this is where our stops are to protect our profit. And, that's, pretty much how I do it. And once you find something that works, really all you're supposed to be doing is that same thing over and over again. I mean, that's how I found, these biotech stocks. If you want to take a look at another one, now I'm not going to say I picked the bottom on this one, but Clovis, and it was kind of luck also. But we're talking about a stock that was $116. I don't know if you know about Clovis, CLVS. Here you got a stock that the drug doesn't work, FDA this, FDA that, they're running out of money. Stock's down to $11.50. Did I buy it at $11.50? Absolutely not. But if you see, the bottom range was between $11.50 and around $17.50. So I didn't buy at $11.50, $12.50. I waited to see. I was like, why would this stock break $17.50 if it was virtually going out of business? So at $17.50, and again, here I don't buy the stock because, again, it's a biotech stock that I thought, and as I read on the interweb, they're going out of business. They got nothing going on. So I bought some $17.50 calls that day. And then when it broke out, I was like, wow, if this thing could break $21, we're looking for this thing to possibly even go back to $30. So, we sold out of the quick hit on the options, and we what we thought were lotto tickets at the time, buying some $25 calls, were phenomenal. And of course, I cannot believe the stock went back into the 40s because we were out of the stock around 29 and change. But hey, you're not going to complain when you make 3 or 4%, 300 or 400% on your options. And again, why did I buy Clovis? Exhaustion situation formation. The sellers just seem to have dried up. AMD, ENDP, and what we just bought today, I'll give you a freebie. Another piece of garbage biotech stock. CLDX. Doesn't look like much on the chart, but it stopped going down, which is the first sign of something good. And you had this little bottom range. It couldn't get back above about 380. So what do? You break 380, you got to buy the stock. And our short-term goal was just 410. We got the 410 today. So now that it broke 410, I look to the candles from where the stock broke down from originally, which is around 440, and that's our next goal. Breaks 440, then I'm looking for this thing to go to around 470. Now is where it gets fun because you have a gap to be filled. So if this thing could get back over around $5 without any news whatsoever, this thing could be a $6.20 stock very, very quickly. And if you're buying something at $3.85 and dumping it at $6.20, you're doing something right. And that's the last one I just bought. This one I bought the stock because obviously it's pretty cheap. And again, I only start out with a couple of thousand just to get a feel for it. If it pulls back and goes right back down to $3.85, no harm, no foul. But had a nice close today and looks pretty good. And that's really, again, it's the same thing over and over again. That's why I tell all my students, this is not exciting. It actually should be boring. The more excited you are, you're probably doing something wrong. You shouldn't be running around trying to find every symbol. I got guys coming into my chat room. Hey, did you trade this? Hey, did you trade that? I don't even see these stocks. These $3 stocks that are up 500% for the day. I'm like, nah, it's probably just going to give back 80% tomorrow. It's not my thing. When these little garbage stocks go parabolic, out of nowhere, it's usually going to come right back in. Which brings me to another one, was this EXCL. And if you guys are following along, and again, I appreciate you having me on and shooting the shit like this. Hopefully you guys are following along. Here's a stock, EXCL. Now, Aaron, this would get me in such trouble back in the day. And this is where discipline comes in. I look at a stock that was $4 in February. It's trading at $15.50 now and pretty much has gone parabolic. So my bear inside me saying, oh, this thing's going to come cratering back down to 11 at least. I got to keep shorting it. But there's no reason to short these stocks right now until I see, what I like to call the blow off top. Obviously I'm not the only one that calls it the blow off top. But now what I look for on a stock that's gone parabolic like this, the only time I'm going to short the stock is when it gaps up, rolls over, and goes red. You understand what I'm saying? That's the only time. And again, you guys out there that are trying to pick tops, let the top pick itself. Another Isaac-ism. Let the top form and then short the stock. You're never going to pick the top, and you're going to go broke trying. So one of these days, I'm sure EXCL is going to give back a little bit. But you know what? Wasn't today, wasn't yesterday. I thought 15 might have been the spot. Broke 15 yesterday. Looks like it keeps on going. For all we know is that this thing has a drug that's about to be unleashed onto the world that's going to save the planet. This thing could be $1,000 stock. I don't know. I just know if it gaps up tomorrow and let's say it's at 1580, rolls over, breaks to 1 minute VWAP, trend starts to reverse, and this thing goes negative, then you short it. Sure, I'm going to sacrifice 50 cents in there, but if it's time to short the stock, it's not just going to pull back 4 cents and sit there. It'll give back another 50 cents, possibly $1, and the profit taking will ensue, and then you can make some money. Once again, you'd rather be late and right than early and wrong. It really comes down to the same concept every time.
So just going back to something you said earlier in your answer there, you talked about these range formations that come in when the sellers dry up.
Right.
How are you actually defining a range? Like, how would you identify that on a chart?
All right, let's take a look at the con chart, if you can, guys, if you're following along at home.
Just so you know, Kenny, a lot of people probably don't have a chart in front of them. A lot of people listen while they're like driving on the way to the gym, that sort of thing. So maybe if you could just sort of broadly speak about that example would probably be most helpful.
All right. Well, you could basically see on, I'll just say it in general terms then. If you see a stock that hits 650, that's been down from $80, and every time it goes to 650, it holds 650. And then a week goes by. It pops to 685, rolls back to 650. Hey, it held 650 again. And it goes back to 682, rolls back over, goes to 650. Hey, guess what? It held 650 again. This stock did that about, a dozen times. And every time it got to around, this one was about $7.15. Every time it got to $7.15, it rolled back to $6.50. So finally, And the beautiful part about it, it was that it was an earnings reversal, something that I talk about quite often to my guys. When are people going to make decisions? It's when the earnings come out. So apparently, whether this is true or not, apparently the numbers were good enough where the people that were debating whether or not to cover their shorts finally made their mind up. And once that stock broke 715, then you're looking for, like I was saying before, where did the stock break down from when it last fell into a new range? So on this one, it was about $8. So I was like, hey, I'll buy something at 715 with an $8 target. Next thing you know, I got to $8 that day. And then we were like, wait, if it could get past 8, and then we look for the next breakdown price. And I had 885. And I was like, can this stock really go from 715 to 885? You're sure? It sure can. And then from 885, I was like, wow, this thing's still got some momentum. Possibly gets to 950, because 950 was where another level where it kind of broke down from in the past. So I'm looking at a chart going back to, May, and it sat around from June till September 7th. So you got, 3 or 4 months of it just doing nothing. So then you got the shorts covering, you got the bulls encouraged, and obviously the stock went all the way up to 1250, and then the genius analyst came along and, upgraded it. But the more a stock continues to hit a certain area, and usually it's a 52-week low or even a 2-year low. In this case, I think it was a 3 or 4-year low or an all-time low, as a matter of fact, on Con. If it keeps hitting that same price and can't break down, now, again, you don't want to buy it then. You just want to wait till it breaks out of that range that it's formed. And once it does, the shorts get nervous and you get the short squeeze. And then obviously the algos come in and everybody starts going nuts with, levels and black boxes and gray boxes, and all your high frequency trading gets involved. And next thing you know, you have a stock that goes from $6 to 12. And, if you look at AMD, same kind of story. And, it's all about these bottom ranges. And once they form the range, all you're looking for that stock to do is break out of that bottom range and just get to the next level up, which could be just, 3%, 5%. And every once in a while, you get a monster. So going back to the whole concept, I'm not picking the bottoms. The bottom is forming for me. I'm just waiting for it to break out into the next level and, making the meet in the middle.
Got it. Okay. Good stuff, man. Well, I really want to get to, we're pushing on, what is it? Almost 70 minutes now. I really want to get to some tips and pointers, some suggestions you might have for traders who are still developing, still trying to find their feet and find their way in this game. So, one of the things I'd like to ask you is, what's one thing if unprofitable traders just understood, they'd be better off?
Wow. Well, I tell this to everybody. If you ever find yourself saying, let's see what happens, get the hell out of the trade, because you're hoping. And that's what gets people in trouble. Let's see what happens. It's the same thing, the day trade becoming a swing trade, becoming an investment. Don't let it happen. How many times have you heard? You probably heard it. Everybody's heard it. I'm stuck in this stock. Are you? Really? You don't have internet access or telephone? What do you mean you're stuck in the stock? Just press the button. Rip the Band-Aid off. Do it. It's just one trade. Don't let it ruin your life. It's just one trade. People don't seem to understand that. You're going to lose money. Even if I had 90% winners, that 10% losers can outweigh the 90% without proper risk management and money management. Don't let the losers outweigh your winners. And usually you're saying to yourself, let's see what happens. And it really sounds too easy to be true, but everybody says, let's see what happens. And if you find yourself saying, let's see what happens in a losing position, chances are it's going to get worse. Chances are it's going to get worse. But the other concept along those same lines, if you're in a losing trade, say to yourself, would you be, assuming you own it, would you buy more here? If you don't immediately say yes, dump it. Because if you're not confident enough to buy more while it's falling, then you shouldn't be in the stock. Get out. It's just one trade. If you're going to be successful, you're going to have so many losers. You just have to manage them. And that was my problem, because I used to let's see what happens all the time, because I had a lot of money and I was like, oh, let's see what happens. What's the worst that'll happen? Enron. Oh, what's the worst that'll happen? Oh, WorldCom. I've been in all of that. I was like, what? Oh, Enron. Oh, yeah, it's down to $8. Where it's not going to go to zero, is it? And next thing you know, what do I know? I didn't know anything about Enron. I just saw a chart of a stock that went from 80 to 8. And I just said, let's see what happens. When it was down at 5, let's see what happens. Next thing you know, it's at 0. And, it was just an awful, awful thing. I'm telling you, it's that easy. When you mutter to yourself, let's see what happens, just hit the key or click your mouse and get the hell out. I'm telling you. And you'll feel better. You get rid of the stock, you ban it. You know how many stocks I banned from my life? So I just like, you know what? Every time I go near that stock, I lose money. You know what? Guess what? I'm not going to trade it anymore. And I'll tell you one more thing. The funniest thing is I hear about this all day, even today. Kenny, I seem to do really well in the morning, and then I wind up churning my account and then giving back most of my day in the afternoon. What do you think I should do? Why don't you stand yourself in the mirror and say that again? What do you think the answer is? Well, Kenny, I make money during the morning every day, and I lose in the afternoon. What do you think I should do? Here's a concept. Don't trade the afternoon. Let that one sink in. It could be that easy. And it's amazing. The guy was like, really? That's all you have to offer me? I'm like, yeah, what do you need? You just told me you make money in the morning and lose in the afternoon every day. You don't have to hang out just because you feel like you want to be a trader. It's about money. Make the money. You do this for a living, or you're attempting to do it for a living. Why would you stay at the poker table when you've won the money? I won the money. Leave. No one's giving you drinks or back rubs when you're sitting in your house in your underwear. Or maybe they are, but why are you sitting at the casino table when you won the money? Leave. It's all right. You can leave.
Loud and clear. Solid advice, man. What are some illusions people have about traders which aren't entirely true?
We wear suits. Still, some people think that traders wear suits. I don't know when they stopped wearing suits, or when you hear the word trader, everybody thinks we're yelling and screaming on the floor. I'd say within probably 5 more years, you won't have any of that going on. But I think the illusion that you need to be constantly trading is what gets people in trouble. That illusion of, I'm a trader. I need to trade. No, you don't. Not trading is trading. Knowing when not to trade. If you're sitting there still at the computer after having 3 or 4 decent trades, if you're sitting at your computer between 12:30 and 1:30, you're just a maniac. You're a glutton. You got some issues. Take at least your hour off. Between 9:30 and 11:30, don't talk to anybody. That's your moment. From 11:30 to sometimes even 2:30, 3 o'clock, you shouldn't be doing anything. You should watch the Rangers being formed, but you shouldn't be executing any trades during that time. You're just asking for trouble. And the concept is that, well, I'm off the desk. I might as well put some trades on. That's why you get guys that lose money in the afternoons. They're blinded by this idea that they're a trader and they must trade. Flat, my friends, is a position.
I've got to say, Kenny, thank you so much for coming on, man. We should probably call this a wrap. Where is the best place listeners can go to find out more about you?
Well, the easy way is to email me. It's kennyglick@AOL.com. And please don't mock me for having the AOL account. It's something near and dear to my heart. I will keep AOL forever because I remember the days where all we had was dial-up. My website's hitthebid.com. It's kind of just a portal to get into my private chat that I have. If you do want to find any more information about me, just email me and we'll talk. KennyGlick@AOL.com. And generally I let people hang out with me now. My new way of doing business is just hang out hang out with me. I'm an easygoing guy. I drill these 4 or 5 concepts into your head. A lot of my, Isaacisms, I will, put those into your skull, and we hang out. We have a lot of fun. And because people want to be at the desk, once we start making money, if you like to cook, I could teach you how to make a nice meatball. I have a lot of Italians in my family. I'm a Jewish fella, by the way, and I make a ridiculous sauce. I make psychopathic raviolis and stuffed shells. Make an incredible just amount of food because I was taught by my wife. My wife's aunts have all married into a large Italian family. So we sit, we make some money. I treat my room like a family and everybody in there. So what I do now is I'm like, come hang out for a month on me. Let me show you what I do. If you can't grasp some of the concepts within a month and I don't show you how to make money, we part as friends. And then if you want to stick around, I just do a one-time, lifetime membership to basically be Kenny Glick's friend. And, we could talk about that after you spend a month with me if you like what I do. And what gets people in trouble, some people show up at 1:30 on a Thursday afternoon.
Where are your picks? Where's all your genius ideas, Kenny? I saw your video on YouTube. It says you never lose. Where's your picks?
You can't come into my chat room on a Thursday at 2 o'clock expecting some monster idea that's just going to blow your mind. It's a lifelong dedication that I ask people to do. Because if you're going to be a trader, you have to take it serious and learn the concepts. And I'm not saying mine are all you have to learn, but I show you some basic concepts that will help you succeed. And the hardest part is sticking to those few concepts that you have proved, or I have proved, that work pretty well. So that's me in a nutshell, my man. Thank you so much, man. I've heard so much about you, and so many people were so excited that I was on your show. And you're doing an awesome job, man. I mean, from Australia, yeah, fantastic stuff. I'm really excited that you had me on. Thanks a lot.
Right back at you, man. I appreciate it. So you gave us your email, you gave us your website. Are you also on Twitter as well?
Yeah, I'm at Hit the Bid Radio.
At Hit the Bid Radio. Good stuff, man. All right, well, let's call this a wrap. Kenny, once again, thank you very much for doing this. I appreciate it.
No, I appreciate it too, brother. This was awesome. Thanks a lot.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Listening to Chat with Traders podcast. My name is Aaron Fifield, so welcome and big thanks for tuning in. What you're listening to right now is not a regular episode. This is a special 6-part mini-series in collaboration with Quantopian. For those unfamiliar with Quantopian, Quantopian is a crowdsourced investment firm who provide pretty much anyone with an internet connection to data, a research environment, and a development platform to write their own algorithmic strategies. Select authors then may also license their strategies to Quantopian and get paid based on performance. Now, the overarching theme for this mini-series is a look into the workflow of a professional quant trading firm. I will say I would consider some of the topics discussed to be quite advanced, but if you're into this sort of thing, I think you'll really enjoy it. If not, then that's also totally fine, but I feel like this first episode at least has relevance to traders and investors of all styles. Because this episode, to kick things off, is titled You Don't Know How Wrong You Are. And we specifically discuss numerous biases and the many ways that you can actually be wrong without knowing it. Anyway, I want to keep this intro short and sweet because you'll hear more about what to expect from this podcast series very soon. And I still want to mention a couple things that are important to address. So first thing, to find any of the links and resources mentioned throughout this series, you can go to quantopian.com/chatwithtraders to find everything there all in one place. I'll also have the same on the Chat with Traders website, so whatever is easiest for you. Second, like I said, after this first episode, some of the topics get a little complex at times. So if you want to ask something, you can go to quantopian.com/questions and submit your questions there. That way we can collect them all in one place and we will do our very best to answer as many as possible on the 6th episode, which is actually dedicated to Q&A. And thirdly, this series is sponsored by DataCamp. So if you're keen to learn a programming language or further develop your programming skills, I really encourage you to check out datacamp.com. I've done a bunch of their Python online courses and they're brilliant. They also have many courses teaching R, all of which are centered around data science, stats, and finance. So visit datacamp.com and create a free account to get started. Just to repeat, that's datacamp.com. Check them out. Now, without any further ado, please welcome Delaney from the academic arm of Quantopian. Let's get into it. All right, so Delaney, what's up, buddy? How you doing?
Not too much. I mean, I say that semi-dishonestly because things are, as usual, incredibly busy here, but nothing too much this evening. I've just got this and then I'm heading home.
Good stuff. Yeah. I can imagine. You've got QuantCon coming up too, so I imagine that's just amplified things.
Yes. Well, thank you for giving me the opportunity to right off the bat start pitching this. But yeah, we have a QuantCon Singapore coming up. It's the first time we've done it not in New York City. So we're excited about that. It's going to be in November, I think on the 10th or 11th, where there's a few days of events, but the URL is quantcon.sg in case anybody wants to check it out.
Good stuff. Yeah, I'm really keen to make it along. I don't know if I'll make it out there to the Singapore event, but if not, definitely the next New York one or something. I'm really keen to make it along. But anyway, man, I'm really excited to be doing this. So just to set the scene here, give us a rundown on who you are, your background, and tell us a little bit about Quantopian too.
Sure. So I'm Delaney. My last name is long and complicated. So it's out there on the internet. You can find it if you want to. Mostly I just go by Delaney. My background personally is in computer science, statistics, and math, kind of, at the intersection of all those three. And I joined Quantopian right out of school, actually, and I currently run the academic arm of the business. Namely, kind of what Quantopian does is we try to democratize quantitative finance. Quantitative finance is one of the fields in which the barriers to entry are just amazingly high. I think that some of them are so high that you don't even know how high they are. A lot of people, kind of will sit there and they'll say, oh, well, I have this great idea for how I could trade stocks, but there's just no sense of the path that you would go through to actually get that from idea into real implementation. So what Quantopian does is we try to provide as many of the tools and data sets that banks and hedge funds would have access to as possible, and provide them to everybody in the world, regardless of background or geography, and make it so that anybody has a shot to actually try to implement some of these ideas. Personally, I actually didn't know much finance before starting at Quantopian. My background, again, is in kind of computer science and stats. And I was so fascinated by what you could do with this stuff when I joined Quantopian that helped me realize that a lot of people do come to our platform to learn. And almost accidentally, I ran into a professor at Harvard. Actually got introduced to him by someone else who was taking his course, but I ran into him and basically discovered that he was using one of the same technologies that Quantopian uses internally to teach his course, namely these Jupyter notebooks. And they're such a powerful teaching tool. And what we said is, hey, well, why don't we use the same technology and try to teach quantitative finance to our users? Because, you know, it's one thing if you have a great idea already and you're educated, but another barrier to entry is that nearly nowhere teaches quantitative finance. And since we want people to be, writing great strategies on our platform, we want people to be educated in doing that. So we've actually created through the process of working with a lot of professors at schools, including Harvard, Princeton, MIT, MIT Sloan specifically, Cornell, and many others that I don't have time to name. We developed the Quantopian lecture series, and that's where honestly I think a lot of content that we discuss over the next podcast is going to be drawn from. The lecture series are kind of designed to bring you from kind of knowing nothing about quantitative finance, but knowing a little math and a little programming, to really actually being able to compete with a quant in industry. And again, like the goal of this is Quantopian's primary business model is to allocate money to the best ideas that are produced on the platform. And so we actually recently had some big news in which we entered into an agreement with Point72, in which they would give us, through a separately managed account, access to up to $250 million, subject to some constraints, to allocate out to our users' algorithms. And so now the idea is that we're trying to grow the size of allocations that we can make to algorithms on our website, and pay the users a percentage of profits that they make on the algorithm. So that's our main business model, is doing a profit sharing on algorithms that are sourced from our community. And kind of our dream user, our dream use case is someone who comes from a background or region where they traditionally would just not have access to quantitative finance. They just wouldn't be able to do this, but through Quantopian are able to kind of, work hard, be smart, design a really good strategy, and actually get an allocation and make kind of on the order of the same amount of money that a professional quant would for doing the same work. So our goal is really to make it way more meritocratic than it currently is, and try to flatten out the playing field within quant finance.
Yeah, right. Now, just to pick up on a few things you said there, right back at the very beginning, you mentioned that the barriers to entry to becoming a quant are very high in most cases. Why are these barriers to entry so high? Like, is it the knowledge that's necessary? Is it the expensive data that's required? Is it the tools? I mean, is it a mixture of everything? Why are the barriers so high and unattainable for many?
I think it's an all of the above circumstance. There's a lot of industry forces in finance which push towards secrecy and push towards not sharing what you have in any way. And if you look at the way that traditional finance firms have operated, they've operated in this way that like all intellectual property that is generated at that firm belongs to the firm. And it is incredibly rare for a firm to open up that intellectual property in any way. That is kind of a firm's lifeblood in many cases. And in the traditional business model, your activities are highly dependent on your ideas being new and your ideas being unique and that nobody else can figure them out. What that's led to is this circumstance in which not only in many cases is the academic field kind of far behind industry practitioners or just kind of going off in another direction that's not really related, but it's really, you just don't even know what has to get done. Things that would be kind of absolutely essential to a quant workflow. And as an example, I'd say like strategy capacity analysis, in that every trading strategy, has minimum and maximum capacity that you can put through it. And quants do all sorts of analyses on that capacity to kind of figure out how much they should be allocating to each strategy in their portfolio and how they should adjust that over time and things like that. If, you're not already in that community, you just might not even have any idea have to be done. And there's so many sticking points that you can get stuck on when you're trying to do this on your own.
Yeah, so you brought up the fact of, there's a lot of secrecy that surrounds this. A firm does need to be somewhat secretive about their operations, though, don't they, to, be viable and stay in the game, essentially. Is that the case? Like, that level of secrecy is necessary?
So, I mean, if you make the argument that if assigning secrecy some kind of linear score between 0 and 100, and you make the argument that some level of secrecy is necessary, I would say yes. But where it falls in there is highly dependent on the business model of the firm, lots of other factors. I mean, as an example, one of the first things that Quantopian did is that we actually open sourced pretty much most or all of our code base, not all, because, we still had some proprietary code, but kind of most of our code base. And there may have been some time in the history of the business, I'm not sure, but there may have been some time in the history of the business in which all of our code base was open sourced. But we have a GitHub page. For those of you who are technical, you'll know what that means. For those of you who aren't, GitHub is just basically a service that companies use to store all their code that they've written, and you can make it open and freely available or closed and private. And we've made our backtester code, many of our libraries, just open and freely available. And that was something we did right off the bat. And the hypothesis was that open source code, you can have thousands of eyes on that piece of code and thousands of people looking at that code and finding bugs and making it better. And that's what we observed. We have, I don't even know how many views we've had on the Zipline, which is our back tester, our Zipline code base. And as a result, 4 years times, thousands of eyes looking at that code have produced so many bugs. So many bug reports have come out of, having that thing be freely and available and open. And I just can't imagine that a system that's written internally at a hedge fund and maintained by 5 engineers who look at it maybe, 8 hours a day each. I just can't imagine that system would be, in any way bug-free, because we have found so many bugs and we're still finding bugs in our system, after 4 years. And a bank that, has 2 years times 5 engineers looking at this thing, there's just no comparison.
Yeah, and that actually reminds me, on the Quantopian platform, users use Python as the programming language. Pandas, which is a Python library, if I understand correctly, that actually was originally developed by a man who worked within a hedge fund. Is that right?
Yeah, that's exactly right. I believe that's Wes McKinney you're talking about, if I'm not getting my people confused. And he was working at a hedge fund, and he was saying, well, Python's great for most of what we have to do, but there's some key things that are lacking. And so he said, well, why don't we just build those key things that are lacking? And these are kind of general basic tools that could benefit everybody. And I'm talking like people in finance, people in science, people in data science, all across the field. And so he built those tools, he made it open source. And as a result, Pandas has become this amazingly useful library, amazingly high quality library of code that's in use at so many funds all over the place. But, it's not a zero-sum game. Many people think of it as a zero-sum game, and some very specific parts of finance, if you zoom in close enough, are a zero-sum game. But in many ways, it's not a zero-sum game. And I think that that's kind of the failure of logic when people try to keep everything super secret all the time with no exception.
Okay. And just so there's no confusion here, would you mind explaining what a zero-sum game is?
That's a good point. So in economics, specifically kind of game theory, which is a branch of economics which deals with what decisions kind of should one make if you're trying to optimize some, utility, some objective function. You're saying, I want the most money or I want the most happiness. And you're trying to say, what decisions should you make in the presence of other people also playing the game often? It's not just you who's making these decisions. A zero-sum game refers to the case in which, the amount that you get and the amount that the other person or other players get have to add to the same thing. So, or have to add to a single quantity. So if you get more, it means someone else is getting less and vice versa. And that's the notion of a zero-sum game, is that you have to compete. And your competition and your success hurts others, and your failure benefits others. And that, again, it's true in some cases, but I really don't think it's nearly as common as people think it is. And in fact, one interesting thing that I could talk about for hours, and we don't have time to delve into, but many people learn basic game theory, what are known as equilibriums, which are kind of optimal strategies to take. Game theory equilibriums in school, especially if you'll take like kind of intro to economics courses. And those equilibriums kind of, in the same way that many physics theorems are proved in vacuums with no friction, those equilibriums are often proved mathematically, assuming many things. And these things include assumptions about like infinite computing power and perfect information, and never seeing this person again ever. Like these are called like single play games. And what computer scientists have done recently, they said that really does not sound like a reasonable set of assumptions to model the real world. And so they went back in and they've simulated these games in the presence of things like inefficient information transfer and inconsistent geographical distribution of people and all sorts of real world type conditions. And what they find is that whereas the very sanitary, I would argue unrealistic assumptions that are made in the original equilibrium proofs say that you're always better off kind of backstabbing people, and you're rarely good collaborating because the risk of someone else backstabbing you is too high. What's found is that when you re-simulate these games in the presence of real world conditions, oftentimes the reverse holds true, and cooperation and generally being nice tends to be kind of the optimal strategy in those cases.
Right. Okay.
Again, you can tell I could rant about this for a while because it's a sticking point for me that so many people go through these intro level courses and graduate into life thinking that screwing over other people is the best thing to do.
Okay, no, that's excellent. Now, just to pick up on something you brought up earlier, the $250 million from investment from Steve Cohen at 0.72. What does this mean for users? Like, how is this actually going to change what's been happening sort of to date and moving forward once this investment sort of comes into play?
Sure. So, when we talk about anything to do with allocation, I just have to be, a little careful to make sure I don't say anything inaccurate because, we now have to start preparing to make sure that we're SEC compliant. They monitor any statements you will make about, investments. And in general, also, I like to be accurate about these things. But specifically, what this means is that 0.72 has agreed to make available to strategies on Quantopian up to $250 million. And that's going to be released over the course of a year. And there are certain, performance constraints that are going to have to be satisfied of the strategies that are picked. So it's not just like $250 million cash is getting delivered to anybody here. It's a well-reasoned deal. And what that means, though, is that previously, any allocations we were able to make to the strategies that we liked in the community tended to be very small. And they were basically kind of test allocations that we made off of our balance sheet. And now what we can finally do is start ramping up the size of allocations. And our goal is just to ramp the size of the allocations up higher and higher until the portfolios that are being managed by algorithms on Quantopian are kind of, as big as the portfolios that you would see at large financial institutions. And therefore, the people who wrote those algorithms can get paid on the same scale as people at the large financial institutions. And again, all of this is contingent on the strategy itself performing and Quantopian being able to secure capital to allocate out to algorithms, but that's our goal.
Yeah, no, that's really excellent. I mean, it's a huge win for you guys and obviously users of the platform too. So no, that's very cool. Now let's get into this. So, this is going to be the first episode of about 6. We're going to be doing another 4 episodes after this and then a Q&A at the end. What's the overarching theme of this series? Obviously, I've given a quick summary in the pre-recorded intro for this episode, but let's hear your take on what someone can expect to learn from listening to this series.
Sure. So, like I said, I think what we're trying to do here is we're trying to give more windows into the workflow of a professional quant or a professional quantitative finance firm. And some of this is really complicated stuff. I'm not going to sugarcoat it. Some of this is really hard stuff. And, you shouldn't expect to listen to a podcast and then, come out being able to do some kind of multivariate portfolio optimization analysis. But the goal is to kind of give you some holding points, give you some points, some skeleton, such that if you're interested in learning more, you kind of see some of the paths that you can take and point you to resources that you can use to start fleshing out your knowledge of the system. So again, like the goal is going to be to give you like a broad understanding of the lay of the land, and how quants work and how they're different from other traders and, what they do and what they don't do and what they worry about at night. But, not necessarily to be able to execute on any of the techniques that quants use, because honestly, that just requires more time to learn and more hands-on experience. One thing I will say, just right off the bat, is Quantopian, again, maintains this lecture series as a resource in addition to tutorials. And if you go to quantopian.com/learn, /learn will get you to a page where you can see tutorials if you just want to learn like how to get started on the platform. And also it will have a link to the lecture series where you can kind of get at more of this stuff in a much more hands-on way and actually play with the code and see what happens. In addition, we'll also try to set up a post on our blog so that we can kind of collect any of the resources and links that we talk about in these podcasts and make there be kind of a single source for people who want to just go there and look at it all at once. But that's something we'll be setting up at some point. And depending on the magic of free recording, it may or may not be available at the time you're listening to this podcast.
Yeah, we'll definitely sort something out in that regard. But anyway, the title of this episode, being the first episode, is You Don't Know How Wrong You Are. Do you want to explain why we've titled it this?
Well, mostly because you don't know how wrong you are as the listener. And what I mean by that is one of the main differences, I would say, between a non-statistical and a statistical framework for thinking about the world is that a lot of statistics is an effort to quantify certainty and quantify uncertainty and say, more so than make this choice or don't make this choice, really look at like the distribution of outcomes that you could have after making a choice or not making a choice, and try to estimate hey, how certain am I that this choice is the right one? And how uncertain am I about, these choices that I'm making in general? And one of the things that, I find pops up quite consistently, especially when I talk to people who aren't from a quantitative background or kind of came from a non-quantitative background and transitioned into trying to do more quant stuff, is that something that you learn when you go through a kind of a classic statistics education at either undergrad or graduate program is you learn a lot of these biases and a lot of these things that can come back and bite you and just be completely invisible if you don't know about them. And one of the examples of this that I'll just go over briefly to start is something called multiple comparisons bias. And multiple comparisons bias refers to, it's a fancy name. It sounds complicated, but it refers to something that's pretty simple and kind of core. And in fact, I think everybody is vulnerable to this. Like even you making your life choices, about in general, regardless of what you're doing on a computer with finance, are vulnerable to this. And what multiple comparisons bias means is the following. So when you are looking at some event or some piece of data and you're trying to decide, whether some other thing is true, whether this data is significant, whether it reflects some overall trend, you do some kind of test. And that test might be a rigorous statistical test that you do on your computer. That test might be something just inside your head that you just say, yeah, I think this is significant. It could be either. It could be, you get into a room, a bunch of people talk about it, and then you all end up voting. These are all processes that transform that data into a yes-no decision. And whenever you have a test like this, if you make, each test is not perfect. So there's a chance that you get the wrong answer, right? And so let's look at the case in which, you're looking for examples of when to trade, and your data is flowing in, and you're looking for examples of when you should pull the trigger and actually place a position. And every time you look at that data, you're making a test. You're saying, should I trade or should I not trade? And there's a chance that there's a false positive, right? There's a chance that your test misfires and says, yes, you should trade, when really you shouldn't trade. And there was something, maybe the data just popped up, happened to look like the pattern you were looking for. You don't know. Something happened that caused it to be a false positive. And because your test is imperfect, the rate of false positives is not going to be zero. You're going to get some percentage of false positives. And as you make more and more tests, the overall number of false positives that you should expect to get gets higher. And what I mean by this is, let's say that the chance in every test that you get it wrong is 5%. Let's say the chance that you get a false positive is 5%. Well, if you run 1,000 tests, and that's not too unreasonable. You make thousands of decisions every day in your regular life. If you run 1,000 tests, you should expect to be wrong 50 of those times, because 5% of 1,000 is 50. And you should expect 50 false positives to pop up from a body of 1,000 tests. And the danger is, let's say that, you look at 1,000 different choices and you run your test on each. You will get 50 choices that look good just based on random chance, and some of them may be good and some of them may not be good, but, you don't know. There's no way to distinguish between them just from the data you already have. So that's an example of a bias that a lot of people just don't even think about when they're going through their lives, when they're trading, whatever they're doing, but is really core to how a statistician thinks about the world. And is an example, I think, of people just not knowing how wrong they might be when they make decisions.
Right. So first thing I want to ask you based off of that is, what is a false positive? Maybe if you could just explain that for anyone listening who might be unsure.
Yeah, so I think a lot of the language in modern statistics came from how it was developed, and statistics was developed. There's a few major uses when it originally started, getting off the ground, and one of those was kind of medical. That's a natural source of you want to gather data about how sick people are and when they get sick, and let's say you're testing for a disease. You say someone is positive or negative for a disease, right? Let's say you're testing someone for the common cold, and you have some test which is based on the symptoms you see, and you write the symptoms down, and the computer, says, here's a score, and if the score is above something, you say, yes, they have a cold. If it's below something, you say, no, they don't. So, very common workflow. So in that case, a false positive would be when your test says, yes, they have a cold, but they don't actually have a cold. And the test saying yes was based on the data randomly lining up in such a way that it looked like they had a cold when actually they didn't. And this can happen equivalently if you're saying, I'm going to test to see if two stocks move in the same way, if they're correlated, and if you look at many, many pairs of stocks and try to say, give me some pairs that move in the same way so I can try to trade off of them, you're likely to come up with some pairs that just have happened to move similarly in the past, but that's not really indicative of any relationship. And it's because the data just happened to kind of line up in that way. Does that make sense?
It does, yeah. So, just going back to that example you gave there of the stocks, I think that's a really good one. So, you said it just so happened that the data happened to line up and these two stocks appeared that they were correlated. Why were they not correlated? Why was it a matter of fact that the data just happened to be that way, so that it looked correlated? Why were they not actually correlated? Does that make sense?
Yeah, absolutely. And I will say that as we talk about this, if anybody is interested in kind of seeing this in a more rigorous setting, we have a lecture called Pairs Trading in the lecture series. And that pairs trading lecture actually deals with a situation that's pretty similar to this. So if you want to actually muck around with real examples of this and see this all laid out in front of you, check out that lecture. But we'll start with a super simple example, right? Let's say that you represent stocks as up or down, right? You don't actually care about the magnitude of the returns, but you just have up or down at each minute or day, whatever your sample frequency is, right? And so let's say that you're looking at stocks and you have 1 minute worth of data. So again, super simple example, but we'll blow out from here, and hopefully it should become like apparent how this works. But let's say you have 1 minute's worth of data and stocks can go up or down, and you're looking at two stocks, right? What's the chance that they both end up moving in the same direction? And it's not a trick question. The answer is if one can go up and if one can go down, then it's a 50% chance that they line up. And you can do out the probabilities on a piece of paper if you want to convince yourself of this, but it's basically the same as flipping two coins and saying what's the chance that they both come up the same. Not that they both come up heads, but what's the chance that they both come up the same? And so once you have that, fixed non-zero probability, well, let's say now you have 2 time points, and then you say, what's the chance that both stocks ended up, going in exactly the same over those 2 time points? And it's some probability, you can work it out, and then 3 time points and 4 time points, and you extend it all out. And so now it's like to 100 time points, right? So if you have 100 time points and you're representing the stocks as just up or down, the chance that, they're both have going to done the exact same thing on all of those time points is minuscule, right? And so if you looked at 2 stocks and you said, wow, they have been exactly the same over the last 100 samples, what a statistical test is really getting at is like, what is the likelihood that I would have observed this behavior if there's no underlying relationship? And the likelihood is super low. If they're just moving randomly, the chance that they would have lined up over 100 time points, super low. So in practice, though, they're not just moving up or down, and there's going to be some noise, right? And so what you do is you look at the two movements and you say, how similar are they, right? It's not just exact or not exact. It's like, how much of the time do they both move up? How much of the time do they both move down? And so the probability that two stocks line up in a way that's like enough to pass your test starts increasing. It's not like, something minuscule anymore. Now it's, let's say, it's 1% that the chance over 100 time points, they move similarly enough so that they pass your test. And so again, now we're at this point where it's 1%, and there's a 1% chance of a false positive in which you have two random stocks, but they have happened to move similarly enough over the last 100 time points that they pass your test of being related, even though they're not related. And so if you do 100 different tests on different pairs of stocks, you should expect to get one that pops out, one pair, because you should expect 1% of those tests to have false positives. So does that make sense in how, basically what you're looking at is the false positive rate is the rate at which two random things can line up enough to pass your test, but incorrectly. And different tests have different false positive rates. And in statistics, one of the really nice things is that you can calibrate the false positive rates, and you can kind of test what they are, and you can know about them. And one of the problems is that if you're just making these decisions in your head or in some other method, it's pretty much impossible, not impossible, but it's pretty close to impossible to really effectively calibrate those decisions and know what your false positive rate is.
Okay, so it really kind of comes back to the underlying relationship, and there actually being some meaning as to why those two stocks should be correlated or shouldn't be correlated, right?
Yeah, so statistics is really about testing for relationships in your data and just deciding what is the certainty I have that this relationship is real or that is just kind of nonsense. And again, two things can line up so that they look like they're related and they're actually not. And that happens all the time, all the time. And a famous example of this is, I forget which website does this, but if you kind of Google weird correlations, you will find, I think, if I'm remembering correctly, you'll find websites that show you correlations on historical data. And so I just pulled one up, and this website is called Spurious. Spurious is the statistics word for kind of not really meaningful. Spurious correlations. And this they give you a random correlation. And so the random correlation they give you is if you look at the last 10 years in the US, and you sample let's look at the last 10 years in the US, and if you look at the number of people who drowned falling into a pool, and if you look at the number of films that Nicolas Cage appeared in, they line up pretty closely. Pretty closely, right? And you'd look at this and you'd be like, oh my goodness, there's likely a relationship there that I should look into this. But of course, what's happening is just that there's just so many things you can keep track of, that over that incredible universe of things, the chance that two of them don't happen to line up over some time period is super low. So what they're doing is they're just saying, because there's so many possible relationships, there's so many things I track, there's so many possible relationships, I just have to look at 1,000 relationships and one will pop up that looks pretty close. And that's this notion of kind of multiple comparisons bias.
Right. No, that's awesome. I think you've done a really good job of explaining this, Delaney. I appreciate you really fleshing this out. So sticking in line with the theme of this episode, you don't know how wrong you are, let's go into some of the other biases. Let's talk about overfitting. What is overfitting? And maybe let's talk about some best practices for how to avoid overfitting.
Sure. So again, if people want to like muck around with this more, there's a full lecture in the Quantopian lecture series on overfitting. And again, you can get to the lecture series if you go to quantopian.com/learn, or directly if you want to by quantopian.com/lectures. And overfitting at its core, I would say, is actually kind of one of the biggest problems that people deal with in finance. And what it is it's similar to multiple comparisons bias. So like kind of try to keep the same kind of ideas floating around in your head if you can. But the idea is that if you look at some set of data, and again, you're making decisions. You're looking at some set of data. Some of that data is going to be, if it's the right data set, some of that data is going to be like useful data. You can make decisions off of it. It's related to the thing that you're trying to predict. And then some of that data is just going to be random noise, and as an example of this, let's say that you're trying to model temperature, and temperature in some neighborhood, and you have a data set, and the data set is the temperatures of all the surrounding neighborhoods, as measured by the thermometers in the surrounding neighborhoods. You just don't have a thermometer in this neighborhood. And then also the number of pop songs that were played on a local radio station that day. Like one of those is unrelated, and it's just noise. It's pure noise. It's not related to the outcome in any way. And what overfitting is when you make a model that fits really, really well to the data set you have. In fact, so well that it's also fitting to that noise in addition to the real signal that relies underneath. And it's a little tricky to kind of get an exact sense of this without seeing an example. So again, for people who are familiar, I recommend just looking up overfitting, and there's a bajillion examples of it. Again, like I said, the lecture series has examples of it. But the idea is that, you construct a model which has 100% predictive accuracy over that historical data set you're looking at. And if it has 100% accuracy, it has to take into account, the noise that's coming from, your data not being perfect. And if it's able to take an imperfect data set and create and have a perfect prediction, then if you take that going forward, it's going to be too finely tuned in to all the little noise and little things that popped up, right? And so you could, as an example, if you're making a back test, right, what you could do is you could say, I have a back test, I have a trading strategy, and I want to be not vulnerable to another financial collapse like the one that happened in 2008. And so what I'll do, and this is actually where multiple comparisons bias can come in here, what I'll do is I'll look for signals that seemed to match with, the collapse happening in 2008. So what you do is you say, okay, well, in 2008, I noticed that, housing growth followed this pattern. I noticed that the LA Dodgers had won and lost in this pattern, and I noticed that the temperature in Sacramento followed this pattern. So my model for avoiding the next financial crisis is going to take those three variables and look and say, if at any point these three variables line up with what happened in 2008, I'm going to move to cash, right? And that's a particularly ludicrous example, but when you start saying, okay, well, I'm going to look at the movements of Apple in 2008. I'm going to look at, JP Morgan's stock price, which probably is related to 2008. Apple, maybe not as sure. And I'm going to look at the movements of, Pepsi Cola in 2008. Is that related? I mean, maybe, I don't know. What you can start doing is just looking for these incredibly specific patterns that have no bearing on what's going to happen in the future. And you've become overfit to this historical data. And it's amazing how easy it is to do that and how subtle it is to detect. And it's actually one of the biggest problems that we have to deal with at Quantopian every day, because we have to differentiate between algorithms who look really good historically because they're overfit and algorithms who look really good historically because they're going to keep performing well into the future.
So how do you differentiate between the two? Like, what are some of the things you do to get around this issue?
So really kind of like there's two main things you can do. And the first and foremost, and it's really like the gold standard for avoiding overfitting, is something known as out of sample testing. And again, now, we can go as deep into the weeds with this as we want. I don't want to necessarily kind of bore or scare people who haven't done much with the statistics in the past. But what the idea of out of sample testing is, you do is you develop your model and you do all of your model development and your strategy development on one data set, but you've saved some of the data. You haven't run out of data. You've taken some of the data and you just haven't looked at it at all. And I mean that, like, you haven't even explored it. You haven't poked around it. You've just cut it off. You've taken your Excel file. You've cut it off under a certain number of rows. You've taken that. You've put it into a safe. And then what you do is, once you're done your strategy testing, your strategy training, as you call it. We call it training and then testing. You've got you're training your strategy on the in sample data that you use, and then once you've done that, you say, okay, now I think it works really well on this data set, but I want to test whether it's just fit to noise in the data set or whether these are like real patterns I found that will continue forward into the future. And so what you do then is you say, I run my model on the testing data set, which you haven't looked at all, and it hasn't been used in the construction of your model. And because it hasn't been used in the construction of your model cannot be, overfit to the random noise that occurs in the testing data set. And so its performance over the testing data set is usually far more indicative of the quality of your model than the performance over the training data set. But the problem is that you only have a finite number of tests, and rarely is just your model work on the first pass. So generally you'll have to save several out of sample testing segments from your data, or wait for new data to be collected as time goes by, or something like that.
Okay, so what's a good ratio to have of in-sample and out-of-sample data? Like if you have let's say 10 years worth of minutely data for the SPY, how would you segment that data into in and out of sample?
Sure. So, I mean, again, we're getting into things which are very well studied in statistics, and I may miss crucial papers, and if you're a statistician and I say something right now that's just completely wrong or completely misses a key paper, please angrily write to me because I want to know, but not too angrily. How I would approach this is basically the following. I mean, this is where it kind of gets into more of an art than a science to an extent, but generally some people like doing 90-10 as a split. One thing you have to be careful about is that with market data, things change over time. That's known as non-stationarity, if things change over time. And so if you're developing a model on, 2000 to 2009, and then you're saving 2009 to 2010 as your out-of-sample test, well, 2009 to 2010 may just have completely different behavioral characteristics than the 9 years prior. And so it may not be a great test of your model. That's just something to consider. And so doing things rather than splitting across time, sometimes it can be better to split across, say, tradable assets, and just take a bunch of your tradable assets and move them into your out of sample test period, out of sample test set. So that's one way to handle it. Again, in practice, there's lots of resources for this online. If you just look up out of sample testing, you can get there's lots of people who do things like cross validation. Some people do this thing called jackknifing. Some people do things like bootstrapping on limited data sets. Lots of different crazy things you can do. But at its core, the concept that I really want to get across is just this idea that you need to take some of this data and not touch it until you're done developing your model. And the other thing that's dangerous is that, let's say that you are developing some model and you follow this procedure really well, and you develop the model, and then you save 10% of your data, and you go ahead and you test your model on the other 10% of your data, and it doesn't work, so you give up. Okay. You come back 2 months later, you have a new idea. So you develop your model in the first 9 years, and then you test it on the next year. And it doesn't work. Okay, you do this like 10 times, right? Well, now we're starting to get into multiple comparison bias territory, in which if you try enough ideas, one of them will get past the out of sample test purely based on random chance. You know, it's just there's some chance it gets through. So it's just important to realize that these biases kind of pervade in many different directions, and it's hard to account for all the different directions that they pervade. And you can pretty much never completely avoid these biases. You can just minimize the chance that you run into them.
Okay. I like how you brought up the point about, different sets of data.
Non-stationarity. Is that what you mean? Yeah.
Yeah. How there's different market conditions, so if you have a strategy that you've tested from 2000 to 2009, and then you run it on 2010, might be very different market conditions in 2010. So it's not a fair test. I really liked that point that you brought up. Just moving on now to another type of bias, and that's survivability bias. Take us through that. What does this refer to, and what measures can a trader take to eliminate this?
So again, I'll just pick on that language point of eliminate, because basically just to drive this point home, you can't eliminate these biases. They are kind of things that are always there in some quantity, and your best bet is just to try to reduce that quantity as much as possible. With survivability bias is the notion that let's start with a simple example. Let's say that you have 1,000 coins, okay? And you flip all of those coins once. You go down in a row and you flip the first one, the second one, the third one, the fourth one, et cetera. And then when you've gotten through flipping them all, you step back and you say, okay, how many heads did I get? And well, the answer is that if they're fair coins, and your flip is a fair flip, you should get about 500 heads. Right? So you say, okay, I'm going to get rid of all the tails. Just knock them out of my set. Okay, now I have 500 coins left, and you go down and do everything again. You flip them all, and you get left with 250 heads. And you knock out all the tails, and you just repeat this process. Well, it turns out that there is a kind of a decay of how many heads you should expect after a certain number of flipping processes. And so survivability bias refers to the fact that if you look at one of these coins, and you say, oh, wow, this coin has gotten 10 heads in a row. Well, you might not be looking at all the coins that didn't get 10 heads in a row and are just never coming across your radar because of that. So let's take this analogy and let's put it into traders, right? Let's say that you start with a population of 1,000 traders, and they're all making trades. And let's say that they're all making random trades. There's literally no skill in this population of traders. Well, after 1 year, there's some chance that you were up or you were down. And let's say it's 50-50 because kind of these traders either place largely up bets or largely down bets with a lot of leverage. And so the traders that, got the market wrong, they're all going to have lost all their money and they're going to be out of the business. They're not going to be posting on the trading forums. There's not going to be any news articles written about them, and then you go for 2 years, you go for 3 years, you go for 4 years. Well, there's still going to be a few left. It's not going to be a ton, but there's still going to be a few left who just based on random chance have gotten it right every year and made tons of money. And generally, these are the people you hear about. These are the people, and again, I'm not saying that everybody you hear about is unskilled and just lucky. I'm saying that it's hard to distinguish. It's really hard to distinguish because you hear about someone and they say, this person has gotten 70% per year for the last 3 years. Well, what about all the people who didn't get 70% per year for the last 3 years and dropped out of the running and aren't on TV right now? So survivability bias is this kind of very pervasive notion in finance that whenever you're looking at performance results, it can be really hard to tell if they're based on luck or they're based on something real. And actually, out of sample testing is one way to try to get at that. You say, okay, well, I don't know if this is based on luck, so let's test it going forward for another, year and see, if this guy can make mostly right trades. That's one of the ways you can try to get at it.
Okay, excellent answer. And just moving on to the fourth bias, which I'd like to cover, and that's our data cleaning bias. What do we need to know about this one?
So, this is a fun one in finance, and other people may call it something other than data cleaning bias. That's just what I call it. So when you are using data to set up some kind of trading system, and I'm sure many of your users get data from many different places, right? Some of your users may just get kind of daily data that they scrape off of Yahoo. Some of your users may get, they purchase data from some data vendor, whatever, it comes from all over the place. And I think I might have just said user rather than listener, which just shows you how deeply dug into the startup culture I am here. So the idea is when you buy that data, oftentimes, in fact, I would say, I don't know, I don't have statistics on this, so I'll just say oftentimes, that data will have corrections baked into the data. And what I mean by this is, let's say that, your data provider comes out and they say, the price of Apple today is $1 trillion per share, and, you as a human say, I don't know about that one. But, an algorithm that's making decisions may say, oh my God, this is the greatest short opportunity of all time, right? And so this data says Apple is $1 trillion per share. And then they come out the next day and they say, the price of Apple today is $101 per share. And we have issued a correction for yesterday. The price yesterday was actually $100 per share, and someone put their finger on the zero key too many times or something, So that's a correction. And the data that you look at most times that you get from data vendors has had this pre-cleaning done to it. They've gone back and they've wiped out the cases in which they were wrong live. And so when you are testing a strategy on this data that you get from your data vendor, you will not have any of these bad things happen in the back test of your strategy. You won't be able to say, oh, how does my strategy do if my data vendor just gives me a completely wrong piece of information? Is it robust to that? And so you may have these inflated performance numbers based on your data that you're backtesting on being higher quality than the data that you're actually going to get in a live feed from the data vendor. This is kind of one of those catastrophic scenarios often where an algorithm could be vulnerable in some weird way to some weird extreme piece of data coming down the wire. And, you could make some really horrific trade and end up having to lose a lot of money. But this is just something that you will not notice necessarily unless the data that you're using has kind of a representative amount of dirt in it compared to what you'd get normally.
Okay. So why do these bad prices or these bad prints occur? What triggers that?
It can really be anything. I don't know if you've ever used a piece of software and had something weird happen, but just back that out to imagine that piece of software is producing data. It's really, they can come from anywhere because the stock exchanges are running a piece of software, and then oftentimes there'll be one data vendor that consumes it from the stock exchange that will then sell it to a second data vendor, which packages it up. And then maybe that second data vendor licenses it to a third data vendor, which sells it on a retail basis. So this data oftentimes will change hands and go through many different systems. And it's really difficult to track where in those systems, you might have weird bugs like this pop up, but they can be things that are as inane, like I said, to someone literally putting their finger on a button too many times, which I think that's happened in the past, to as subtle as just a rounding error in a computer software that was hard to catch that caused the price to wrap around from 1 cent all the way up to infinity dollars or something. Like little things like that can happen.
Right. Okay. And so how does a quant deal with, misprints or bad data, unclean data in a live environment?
So there's a few different kind of main ways to deal with it, I think. One way is basically kind of ignoring outliers. And this is a common tactic in statistics, which is just to predefine before you've looked at your data, kind of say, there's a threshold beyond which I think data is probably just like noise or something wrong with the system, and set those points and maybe have those points change as the data that you come in change. So a common thing would be to say, maybe to make it so that if the data is more than 3 standard deviations away from the current mean over the last month, then just don't look at it, or don't pretend it doesn't exist. So that's one way. And that's known as outlier, getting rid of outliers. And then there's another way, which is called Windsorizing, which is similar, except that instead of getting rid of outliers, you just set them to be the maximum threshold that you could, feasibly observe. So if you get a price for Apple and it's $1 trillion per share, and the standard deviation of the price of Apple over the last month has been $10 a share, and the mean has been $100 a share, then you say, okay, well, mean of 100 plus 3 times 10, which is the standard deviation, that's $130. So, I don't know what's going on here, but I'm just going to say this price is $130, and so you limit the damage to your system in that way. And a third and more structural way that quants will deal with this, I think, is really the most powerful, which is you say good quants are really good at admitting when they don't know stuff. And that's actually one of the things that kind of defines and kind of can set quants apart, is that they're really good at admitting when they are wrong and uncertain and don't know stuff. And again, that gets back to this core of statistics, which is quantifying uncertainty. And if you're really good at kind of saying, hey, you know what? I don't really think that, the chance that one stock is going to have a misprint is too high for me. So what I'm going to do is I'm just going to invest in so many assets that the chance that, enough of them have misprints at the same time to really damage my portfolio is very low. So this idea of accepting that bad things can happen and then adjusting the structure of your portfolio or strategy based on that acceptance is I think, very common in quantitative workflows, and gets at, again, like I said, one of the ways in which quants might think differently from more traditional or discretionary traders.
Okay, another really great answer. I like this point. All right, Delaney, so let's shift gears here a little bit. Talk to us about quants. When did they come to be? What's the history there? Like, when did quantitative trading actually become a thing?
So, I'm not an expert on the timelines of how things started happening, but my general understanding is that kind of in the 1950 to 2000 window, and really when computers started being available, is when quants started popping up. And the idea was, well, you're sitting there and you have access to all this data, and why would you make kind of by hand decisions on this data when you could gain a ton of information based on looking at, summary statistics, trends, all of the stuff that, statisticians look at in their day-to-day work. So just as computers proliferated, it became more and more available. And as more and more of this data became quickly available, more and more, quants started being, popping up on Wall Street, and assets under management has been, kind of slowly trickling out of from, more traditional traders towards quants. And whereas quantitative investments, like purely algorithmic trading, still makes up a smaller percentage of assets under management. What's interesting is that so many firms incorporate some level of quantitative analysis. So it might not be that everything is controlled by an algorithm, but it might be that they have traders whose trades go to a risk system, which is quantitative. It might be that they have some analyst who uses some quantitative measures of some investment's quality before they go and pitch it to the board. Or, there's many different ways that you can incorporate quantitative analysis into your strategies. It's not just everything being completely algorithmically driven. And the other thing is that I believe the majority of trading volume right now is driven by quant strategies, algorithmic strategies. So one thing that's interesting is whereas, a smaller percentage of AUM is quantitatively managed, quant strategies tend to trade more. And so because they're trading more, they're actually a higher percentage of market volume. I believe, I could be wrong on that. I don't actually have the statistics in front of me. And so what's interesting is that nowadays, if you as like an individual go to place a trade, you're no longer really competing against people like you, because that trade is going to be matched against, I think probably most likely, a trade made by some kind of algorithm, whether it's an execution algorithm or a market maker algorithm or whatever it is. And so to an extent, when you're trying to enter into a position, you don't just have to worry about other traders anymore. You have to worry about, is there an algorithm that knows something that I don't? And that's why it's selling me this stock.
So this is probably a good point to ask, like, how have quants evolved since first sort of coming onto the scene? Like, are there trends evolving of current new ways of how quants are trading and looking to gain an edge?
So a lot of this stuff is really hard to know because of all the secrecy in finance. And, it's really hard to know exactly what people are doing inside the firms. And you can kind of try to reverse engineer it based on what departments they're hiring from and all that. But in general, I think that quants haven't changed a whole ton since they got started. And part of that is because, a lot of places actually didn't trust, they just didn't think quants were as valuable as they were. And so a lot of I think quant shops got started as quant shops. It wasn't like quants went to work for a large institution all the time. So, one of the things that has always separated quant shops is a lot of these people are much more, Silicon Valley, not Silicon Valley, but just laid back in their culture. Quants much more often tend to be closer to scientists than they are to, more of the suit wearing types you'd see on a traditional, trading floor or bank. And, it's just kind of an interesting little, different community that exists on Wall Street. And part of that is because a lot of them are hired from academia. A lot of quant shops, now and always have hired from physics and math departments. They hire from computer science departments because these are the people who are used to thinking about the world as kind of a thing that you can model and a stream of data that you can work with. So I don't necessarily think that quants have changed too much. I think that what they work on has changed. But I don't know if necessarily the roles have changed a tremendous amount over time.
Okay, sure. And I know one of the interesting points we were discussing before we hit record were some of the exotic data sets that are being used by quants today. Do you want to tell us about some of these data sets, some of the more obscure ones, and how they're actually being used?
Yeah, this is I actually have a lot of fun with these because it's just so sci-fi. When you get into some of these things and start actually being oh my goodness, they're actually doing that. So let me tell you one of my favorite examples of something that quants came up with to try to get an edge on the market. And one of my favorite examples is the following. So computer vision is actually pretty good now. And what I mean by computer vision is the ability of a computer to look at an image and tell you interesting stuff about the image. And one of the things that's actually kind of a very well-solved problem, because many different parties have been working on it, is identifying cars. And, car companies have worked on it. DARPA, which is the U.S. Robotics and Computer Science Defense Department, has worked on it. Now, of course, like Tesla and anybody else who's developing self-driving cars has worked on identifying cars. So there's all sorts of freely available scientific research on like how to get your computer to identify whether or not something in an image is a car. And so what some quants did is they went in and they said, oh, also, we have Google Maps now, right? We have satellites, and I don't think they use Google Maps, but they have satellites that get satellite imagery. And there's many companies which will sell you imagery from their satellites, kind of live imagery they get, or maybe they'll take 1 or 2 pictures a day or even more frequently, depending on how the satellite orbits and everything. And so what these firms did is they said, okay, we're going to go in, we're going to look at the satellite imagery, and we're going to count the number of cars in parking lots outside of retail locations. And by counting the number of cars in parking lots outside of retail locations, you can actually look for when there's going to be changes in earnings and more accurately predict sales figures for these retail chains. You can look for downward or upward trends. You can look for shocks. All these things that basically anything that doesn't match what you'd expect, you can say, in what direction does it not match what I expect? And therefore, I expect a positive or negative surprise when they actually release their figures next quarter. So what they did is they just did that. They said, we're going to count the cars. We're going to say if we expect a positive or negative surprise, and we're going to enter into positions based on that positive or negative expectation. And I just think that's a pretty futuristic and crazy way of getting at this information.
Yeah, satellite imagery is super crazy. I recently interviewed Michael Hallsmore from QuantStart, who I'm sure you're familiar with, and he also spoke about that. It just totally blew my mind. It's it's just so out there. I mean, while these sorts of data sets, like, as the example here, satellite imagery, it sounds very sexy, it's very edgy. Have these types of exotic data sets actually shown any sign of producing significantly greater returns than more traditional data? I mean, I know it sort of comes down to how you actually use it, but, broadly speaking, are you able to shine any light on that?
So one thing that I will say is, like, my opinions here are kind of, again, it's hard. I don't have this data in front of me, and I haven't done an analysis on this particular data set. So for like any particular data set, I don't know, like when it was able to produce better returns, if it was able to produce better returns, how it was able to produce better returns. But my understanding is that basically these types of techniques, and another type of technique, which I'll talk about in a minute, but these types of kind of getting at these exotic data, were able to, basically be incredibly valuable, to the point that my understanding is that the cars in parking lot thing is actually like washed out now because everybody started doing it. So it's no longer a novel piece of information. It's just like kind of fully incorporated. But again, I'm not sure. I believe that's the case. And I was actually recently at a conference in Hong Kong put on by Macquarie Bank, which is, I'm sure you're familiar with, coming from Australia. At that conference, they had, one of their presenters was Terabella, which is a satellite imagery startup, which was recently acquired by Google. And Terabella was showing some of the new imagery techniques that they had. And not only can they create videos, satellite videos of like planes flying over the land, which is more for fun, I think, than for quantitative techniques, but they were able to do things like, what you can do is for every GPS location and time of year, you know exactly what angle the sunlight is going to be hitting the ground, right? And you can just kind of compute that, and you can say, okay, well, I know what angle the sunlight's coming from. So what you can do is you can look at the tops of oil tanks. This is just one example of like what they can do. You can look at the tops of oil tanks and say, I compute the size of the shadow on the top of the oil tank. And something that not everybody knows is that actually when you drive past these big oil tanks, the top actually raises or lowers depending on the amount of oil that's in the tank. And that's just so that there's just not this huge amount of air in there. Probably one of the reasons is to prevent a fire risk. But the top raises or lowers depending on how much oil is in the tank. And so what you can do is you can actually compute for oil refineries and oil storage locations how much oil is in the tanks. And what they were showing is they can do things like look at Iran and look at the refineries in Iran and actually show like where they're moving their oil around to, and look at the refineries in the Middle East and show how the oil is being moved around, and basically get the jump on big announcements of like, cuts to production or increases to production, or whether a company says they have more or less than they actually do. They can they know that because they can actually just track where the oil is being stored. And like, as a result, I think that people have actually started putting up like tents over their oil drums so that these satellites can't, the Iranian government doesn't want the US knowing where they're moving their oil to. So that struck me as another example of like something that you can do with this data, and a kind of just a new piece of information you can learn, which was just been completely impossible to hold, 5 years ago.
Yeah. I mean, it's just so crazy to think that people are actually doing this. I mean, it's just wild to think about. But anyway, Delaney, let's leave it at that for now. So like I mentioned earlier, we're going to be doing another 4 episodes following this one, plus a Q&A. Would you like to give just maybe a brief overview for some of the upcoming topics we'll be discussing?
Yeah, so I think the next 4 episodes are really designed to try to get into some of the major components of how a quant actually works in their day-to-day. And I think the purpose of today, and I felt that we actually were able to hit a lot of these points, is just kind of give people a sense of what some of the differences are between kind of a more traditional trader and a quant, and what quants do differently, and how quants think, and what quants worry about. And now for the next 4 episodes, we'll try to dive into specific parts of their workflow a little more. So something we'll talk about is what's known as alpha factors. And alpha factors is the idea of by valuing everything in the tradable universe, can I produce a ranking of things based on their future values that produces a trading strategy which has alpha? And if you don't understand what that means, unfortunately, there's not really a greater way to explain it without really getting into it. So you'll have to wait until that episode. And then we'll have an episode on how, well, in reality, quants really don't trust any individual alpha factor to work well on its own. So they actually will end up combining alpha factors together and combining different methods of predicting stock movements together to try to get a better picture of how the market's going to move as a whole, and therefore be able to, make better trades. Episode 4, we'll talk about, okay, well, let's say now you have this combined alpha factor that you actually think works pretty well. Well, the next step is actually taking its output and converting it to trades on the market. And we get into this new game there of risk optimization and portfolio optimization, and the idea of how do you decide whether or not to enter into a new portfolio. And it turns out that quants have all sorts of definitions of portfolio risk, and quantitative hedge funds will basically, every trade they make, before they make it, will go through this extensive optimization and risk calculation, which just says, is there a better way to make the trade? And if we make this trade, will we be violating any of our risk tolerances? And if the latter is true, the trade is not made. So every single trade will kind of enter through one of these checks at a quantitative firm often, and these things are done in the course of like less than a second. Oftentimes way faster than that, obviously, if you're doing something higher frequency. And then episode 5 is, machine learning is a really popular concept. It's a really popular topic all over the place, not just in finance. A lot of people constantly ask us, hey, you're going to have lectures on machine learning? Are you going to do this with machine learning? You're going to support machine learning on the platform? And machine learning is another one of those things where it's a really, really powerful technique, but it's also really easy to shoot yourself in the foot with machine learning. So we're going to talk about that on that episode. And then episode 6, as you mentioned, I think we're just going to have a chance for us to iron out some of the kinks that maybe came up and things I didn't explain very well or others didn't explain very well. And here it depends on people's schedules, but we'll try to bring on not just myself, but we'll try to bring on Jonathan Larkin, who's the Chief Investment Officer at Quantopian. He's worked at some really large financial institutions. We'll try to bring on Jess Stouth, who's our VP of Quant Strategy, and she's actually in charge of selecting which strategies are or are not included in the portfolios that we develop. And Thomas Wiecki, who's our in-house director of data science. And, he's a PhD in neuroscience from Brown University and works a lot on the strategy selection side. And also Max Marginot, who's and I completely mispronounced his name there, so I apologize to him. But he is someone we just hired actually to work on the lectures. And Max's background is in statistics, and he can explain some of this stuff really well. So we'll try to bring those people on as well to answer some of these questions more specifically.
Yeah, it's going to be good. It's going to be good. So where can listeners go in the meantime to get these resources? Maybe if you just want to give that URL you mentioned earlier again.
Yeah, so for now, let's go ahead and say the best way to get these resources is going to be quantopian.com/learn, LEARN. And that's going to bring you to a page where you can, get started with tutorials, or you can kind of try to dive into these lecture concepts. And I think I mentioned some specific lectures during today's podcast that you can dive into that were related to the concepts we discussed. And so you can find those in the lectures page. You can go there directly, quantopian.com/lectures.
All right, Delaney. Well, this has been a lot of fun, man. I really look forward to picking up from where we leave off right now on the next episode. Thanks very much.
Yeah, absolutely. It's been a lot of fun. I appreciate the chance to talk to you and indirectly to many more people about this stuff.
Cool. And guys, thanks very much for listening. We'll catch you on the next episode.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
And we're live on match day as Doug reaches for a buffalo wing. He's got it! Oh, and he's gone for a can of Pepsi too! What a finish! There's no doubt about it. It just tastes better. Match days deserve Pepsi.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Well, here we are, traders. Episode 100 of the Chat with Traders podcast. Triple digits. It's a century. Wow. With that, I have to say, whether this is your first time listening right now, or if you've listened to every single episode 3 times over, I genuinely want to say thank you. And I appreciate you for supporting this podcast. It's certainly been a journey this far, and I feel as though things are really just beginning to warm up. Now, my guest for this special milestone is someone who I've been trying to bring on since before episode 1 was even released. But persistence has paid off. So folks, I'd like to introduce you to Bao, or maybe better known as Modern Rock on Twitter. Bao is an independent day trader, who made the large majority of his fortune trading penny stocks on the OTC bulletin board market. Before trading, he was a software engineer in Silicon Valley, but I won't say too much more about his backstory because we discuss his early days when he encountered much adversity at length during the first part of this interview. Following on from this, we talk about the biggest trade of Bao's career, discovering your own niche, managing confidence, consistency tips, how to progress as a developing trader, and heaps more, as you can imagine. Lastly, if you do like this episode and you haven't already done so, please leave a review in iTunes. Just go to chatwithtraders.com/iTunes and follow the simple steps. It's a quick and easy way to show your support for this free podcast, and it helps big time. Anyway, guys, without any further delay, I'm your host, Aaron Fifield, and for episode 100 of the Chat with Traders podcast, please welcome Bao, aka Modern Rock.
In my opinion, what the most valuable thing that people are missing is the mindset of like, you know what, man, it's a process. It's not just jumping in and learning how to freaking short a stock or, you know, trade a parabolic. You know, it's just, you know, you got to set your life up a certain way. Otherwise, you'll fail. That's my opinion.
All right, man. Well, let's just start off. Let's go like way back, like way back. I know you were born in Vietnam. You moved to the United States. What was that like for you? Let's just start right there.
Oh, this is before the immigration of any Asian. So this is like 1980. You know, when I moved here, it was in Oregon. I was the only Asian in the whole school. The other minority was one black guy in my class named Ray Ray, and me and him happened to be friends. So this Asian kid, me and Ray Ray were the only two minorities in a school in Oregon where it's completely white. So, you know, right off the start, it was just, you know, I already was having bullies and all that stuff. So, right, you know, and so you basically either have to grow a thick skin or get into a lot of fights and get thrown out of school. So I decided, you know, I'm going to suck it up and make it my effort to say, you know what, screw you. You know, I'm going to grow up one day and be your boss. So that was my whole thinking throughout my childhood growing up. My whole thing was study hard, work my ass off, and they don't know who the hell I am. You can beat me up all you want, but one day I'm going to be your boss and you're going to come and beg me for a job. So that was my mentality growing up. And actually, it did. I seen some people like also, I remember you from high school. I'll go, screw you. You used to pick on me. Now you're coming and begging me for a job. So, you know, that was like basically every immigrant's dream, you know, like, you know. So I have a lot of friends that either join a gang or get into fights, you know. I just decided just to stick to myself, you know, physically get beat up once in a while. But then, you know, I studied hard, became a nerd, and then I'm talking to you.
Sure. So why did your parents decide to make that move from Vietnam? And what was that like? Was that a tough move to make, like, for them? Like, I don't really know what your situation was like.
Well, this is Vietnam, so it's during the war and all that stuff. So I don't want to get into too much of it, but it was like during the Vietnam War and all that stuff. So it was basically like very, very similar to how it is now with Trump and all that stuff. So that's why I'm very adamant about it online, because like, you know, if they stopped immigration from Vietnam, I wouldn't be here. And everyone now is like, oh, you know, you got it made. You're living the American dream. But it's like, it's a long process. And, you know, you can't discriminate. Not everybody's a bad person, you know. Everyone comes to America looking for an opportunity. It's not just America. It could be anywhere. I would have been successful in Vietnam, too. You know, it doesn't matter where I am. It's based on you. But the fact is, you know what? There's a lot of innocent people, good people, and then they're not all bad just because they can't speak your language, right?
Totally. So what was life like sort of after school? Maybe walk us through that bit.
Well, I moved to California, which was a kind of culture shock from Oregon when I was probably in the 4th grade. And, you know, I pretty much stuck to myself. I was kind of a weird kid because, you know, you're always feeling different and you're the only minority all the time. So I actually skipped a grade, so that made it even worse. Because I guess they thought I was bored. I wasn't bored. I was just didn't have any friends. I stuck to myself. So, you know, so then they advanced me one grade up. And so, I don't know, I was just going to school, just being a normal kid who's trying to fit in.
Right. And did you go to college or like study anything after school?
Yeah, I went to UC Davis. So this is a very interesting story too. So So I got into a bunch of different schools for engineering. And I actually got into UC Berkeley. So I'll tell you how I got into. So this is an interesting segue into how I got to trading. So I was an engineer, and I got accepted to all the schools I applied to. And so when I graduated college, there's different levels of discrimination. Okay, if you have no college education, you can only be so far. But then I had a good college education. I went to UC Davis, which is a good school here for engineering. But then there was a different level of discrimination. I wanted to get a really high-ranking job when I graduated. And over here, it's all based upon what school you go to. Did you go to Ivy League? Did you go, So I did get into some of the top schools. Like I got into Berkeley, but I didn't go because as an immigrant, no one told me that was a good school back then. I didn't know. I went to a really horrible high school, so no one told me how to prepare for this. So this is, and so they rejected me from all these jobs. So I had one job offer coming out of college. Remember, this is all relative, right? So other people that didn't go to school go, wow, you had a good job. But for me, it's like, dude, I worked my ass off. And no one would accept me because I was discriminated because I was a minority and I didn't go to the top schools. And so basically, I was discriminated being not going through a top school. So I said, screw this. So I was like, I did engineering for like a bunch of years, and I just felt like they were not advancing me because I didn't go to, let's say, Ivy League school, right? And so I moved to New York for work. I quit my job, and then everyone was starting doing day trading. So then I started doing day trading. The reason I did that because, I was fed up with my job where they were discriminating me upon, all this stuff. So if I had went to an Ivy League, which I got into as well, I would have been so easygoing, would have been complacent. So this is the whole thing about America. Once you're complacent, you really don't want to try and do something different or try to advance yourself, because it's too easy. So the reason why I kept trying and trying is because nothing was easy for me growing up. If it was so easy for me, I would be such a lazy kid. I wouldn't do anything. I would have got a cushy job being an engineer, But the fact is, I had to bust my butt all the time. It made me realize, you know what, man, I could do better than this. And so therefore, I went to trading because everyone was doing it and I liked it.
Cool, man. Well, a couple of things. Why did you choose engineering over everything else you could have gone for?
Because as an Asian kid, you got a choice between engineering, law school, or being a doctor. And engineering was the least of the education I needed.
Right, that's funny. So, that's a good point you bring up about people, having it too easy, being too comfortable. What would you say to someone who's maybe in that kind of mindset, living like that, wants to go further, but just kind of lacks that motivation? What do you think needs to change in their mind to be able to push forward?
Well, they need to hit rock bottom. They need to have some sort of adversity, right? There comes a time when too easy, it's like something's going to happen to your life and you don't know how to deal with it. And that's when, let's say your parents always gave you an allowance. My mom never gave me an allowance. I had to work my ass off, get to school and go get a job, And so imagine if your mom cut you off. Now you're like, oh crap, I never had a job in my life. What am I supposed to do? So now you face adversity. So the sooner you realize that, you know what, man, it's like instead of having to face adversity to learn from it, you can circumvent it. Be proactive instead of reactive, right? And so it's very tough as a kid, though, to teach someone like this. But if you're older, you can understand. You don't have to hit rock bottom before you realize, that your life is going to be going to hell.
Yeah. I mean, in some ways, it is kind of refreshing to have a failure like that because then you've sort of got nothing else to lose and you've just got, the only way you can go from that point on is upwards.
And that's why I think that was the reason that got my trading career successful. Because when I started trading, how I got trading was like I had a good job. So I was doing software stuff. And I was making a lot of money. I was making like $250,000 a year back then, which is a huge amount of money today, inflation, right? And so I like trading, but I treated it as gambling. Oh, I would lose my money. I would refill my account because why? I had a slick job that always afforded me to pay. Every time I lost, I don't care. I put more money in, right? And so if you always have that safety net, and once again, complacency, right? I was complacent with my job. I made a lot of money, but I was bored of my job. I wanted to try this trading thing because I loved it. It was exciting, but at the same time, I was complacent, and I had a safety net, which was my job. My job always afforded me to bail me out of every single bad mistake of a trade. I would lose all my money, refresh it. And so after a while, I was like, dude, so I was up. So this is the days before pattern day trading. So I only, you can have 20 grand in your account and you can still trade. So I would have like 20 grand in my account, and I would be up like 30 grand on that account in one day, like 3 hours, but I wouldn't take the money. I was like, dude, this would go up to $1. I could be rich. I could be a millionaire. And then the very same day, I went from, so my account had 20,000. So I was up 30. So it had 50,000 in it. The same exact day went up. I ended the day with like 5,000 in my account. So at that very point, I realized, you know what, man, this is stupid as hell. I worked my ass off and I kept refreshing my account. Something has to change. And so now I'm stuck sitting with like my money's completely wiped out in my account, holding this garbage stock that went up 300% in one day and then it's straight down. And so what I did was like, you know what, man, I'm going to invest in myself. I realized, so this was a turning point in my life. Before I would dabble in trading, I didn't take it seriously because I had a backup job. So now what I did was like, you know what, I make money every single day and I always blow it on one stock because of greed. I don't take the money and I think it's going to go to infinity, and it always comes down and I'm stuck holding the bag. And so what I did was I took money out of my house. This is a dumb thing. I don't advise everybody, but for me, I look back and I was like, I was profitable in every single trade except the times where I got greedy and I don't take the gains. So I actually took a mortgage out of my house. So I own a house. So I took a mortgage out on that house for like 50 grand. But now it's a different story. I have no backup, no nothing, no safety net. If I lose this 50 grand, I lose my house. I'm screwed. You see what I'm saying? So this is the adversity. My back is to the wall. This is rock bottom for me. There's no more playing around, no more bullshitting, right? And so I became very disciplined. Instead of swinging 30 grand up and down, I would take my $3,000 a day and walk, because that was my entire nest egg, right? If I lose this, no one's going to bail me out. I don't have rich parents. Everything I worked for, I bought the house, but now I took the money out of the house. And so with that mentality, trading became a serious profession. It was not gambling anymore. Before I was gambling. So once your mindset switches from the fact that, hey, something is gambling, it's a coin toss, 50-50, to, you know what, man, this is not gambling. You can become the house if you play smart. And so my mentality switched, and so I became very conservative again. And so I started, slowly trading and making money and not doing these wild swings like a gambler would.
That's a crazy risk to take a mortgage out on your own house. I mean, why did you do that? Like, did you need that 50K so bad? I mean, you said you had a good paying job at the time. What motivated you to take that 50 grand mortgage on your house?
Because it was a bet on myself. At the same time, I hate failure. And I was like, you know what, man, I cannot let this be a failure. The thing is this, I had enough confidence in myself to know that, I'm an engineer, so I take calculated risks. And so I went back to my trades and I examined why I lost. It's not because I didn't know how to trade. It was just because I was too damn greedy. And the greed stems from the fact that I had a good paying job. And so what happened was this. I took the money out, and then I started doing well by taking small gains. And so I gave myself, this is a crazy story. So I gave myself a goal. After a while, I was making more money trading than I was my job, right? And it comes to a point where it's like, okay, you can't do both. You have to choose one or the other. And so what I did was I gave myself some crazy goal, which was 2 times what my pay would be. So in order for me to quit and go full time, I needed to trade and profit and have in my account 2 times what my yearly income would be. So that came out to be $500,000. And so after a few years, and I was like, oh shit, I reached that point. What am I going to do now? So now it's another risk. So basically every time I'm doing it, I'm investing in myself, and the difference now is like, you know what, man, I'm going to quit my job and do this, but it's not gambling because dude, I built my whole life up to this point. And I know I'm not going to throw it away like I used to, because I have no safety net anymore, right? I have no job, everything. So I pretty much went all in. I quit my job and I started trading. And so that's how I guess I quit my job. I transitioned from the corporate world by saving money and then using the day trading to make money. Because a lot of people want to quit, but they need to prove themselves first, right? So they need to give. So for me, I say you need to save at least 2 years of your income in order for you to quit your job. Because otherwise you'll be stressed out having to pay bills every month. And you have to be able to prove yourself that, you know what, you can support yourself doing this shit. I want to play football in the NFL, but I'm not good. You see what I'm saying? It's like everyone wants to be a trader, but everyone wants to be a poker player. But you have to be able to be realistic with yourself as well.
For sure. And one thing I found kind of interesting at the start of your response there is you said that you take calculated risks. What do you mean by calculated risks? Would you mind fleshing that out a little more?
Calculated risk is basically not a coin toss. I always look at the failure. If I fail, what's going to happen? So when I quit my job to do this, the only reason I would quit is I said I saved 2 years, right, of trading profits, right? And so, yeah, so what's the harm? I have enough money to live off for 2 years, and if I blow it, I go back to my job. So I always have to have like some sort of like backup plan. But it's also not a safety net kind of deal, but it's like I worked my ass off to get to this point. But at the same time, it's like I'm not stupid to realize I'm gambling, like YOLO. People say, you know, you only live once, YOLO. It's like, no, that's how you freaking die, dude. If your mentality is YOLO, it's like, what if you don't die today? You live tomorrow. Now you're broke. You spent all your money partying and, you know, and gambling.
Exactly. And just going back to the point, before you quit your job, what were you doing at the time? I got a feeling you were working in Silicon Valley at the time. What were you doing there?
Yeah, I was a software engineer doing banking, online banking stuff. Then I moved to New York. Then I did sales for a company, Fair Isaac, FICO score. They do the credit. So like whenever you apply for loan and stuff, there's a credit score. They invented the credit score, Fair Isaac, FICO score. That's what I did. Yeah, we did some crazy shit. Rules engines, neural network, artificial intelligence stuff. So I worked with a bunch of nerds.
Full on. That's very cool. So walk us through maybe the next couple years of your trading career after you made that jump to go full time. How did you go during those first couple years?
I was doing quite okay. I was very conservative. So I'll tell you the good and the bad part of what I did. So when I did the full flip over, I traded very small, to be honest. Like each position would be like $5,000, $5,000, $10,000. It wasn't a big position, and I was consistently making money every single day. So when I quit, I was making like $300,000 to $500,000 a year. You know, just trading very small. I would never lose, dude. I would just freaking make my grind. It'd be like a grind, but I loved it because it was my passion. When I quit this, it was never meant for me to be rich. I never thought I was going to be rich. I just thought, shit, I hated my corporate job. Hopefully, this passion of trading will make a little bit like the same. It's okay if I made less. I never anticipated to ever making a lot of money. But I just loved it so much where I was like, you know what? If I can support myself doing this, I'll be very happy. So for me, it was the passion. It was never about the money. The money, one day I woke up, I realized, oh shit, I had some money. But it was never about the money. You know, I would just love to do what I did. So what I did was I was very conservative because remember, this is all I had. I quit my job, dude. As an Asian guy, you don't quit your job to do this stuff. My parents, everyone called me crazy, called me a gambler. It's like, what the hell, you're a gambler? He's like, you know, they're ashamed of me. And so there was no way I could have failed. If I failed, I'd be the laughing stock. I had to pretty much commit suicide.
That's pretty drastic.
Hey, for an Asian family, that's not drastic. That's the honorable way out.
Right. So, I mean, tell us a little bit more about that. I mean, like, what were some of the comments you got from your family, from some of your friends at the time, even some of the people who you used to work with, what did they think about when you told them that you were going full-time into this to be a day trader?
As expected, like gambling. Even today, man. Even today, people say it's gambling.
So do you think that a lot of your friends and family think that you've just gotten lucky?
A lot of them do, but I think after 10 years, they realize, oh shit, he knows what he's doing. And so that was the reverse. So this is the thing that's kind of sucks. So in the beginning, it was like, oh, you're gambling. You just got lucky. One day you're going to lose all your money. You're going to lose all your money tomorrow. Watch. Oh, you didn't lose your money yet? Next week you're going to lose it. Oh, you didn't lose it this year? I guarantee you next year you're going to lose it. And then now it's kind of like, oh shit. Oh, it's easy. He wakes up and he makes like $1 million a day. Easy. It's easy work. See what I'm saying? So I get the full spectrum. So so basically there's really no appreciation that, hey man, this is hard work. So I go from it's a gambling, you're lucky, it's gambling, to, oh, it's so easy for you. You can just do this in your sleep. I was like, no, dude, I gotta wake up at 4 a.m. every day and bust my balls, right? And so it's like, I don't know which one's worse. I actually want to go back to the first one, because now it's like, oh, it's easy. When I go out, Bao will pay for it. He'll wake up tomorrow and make the whole paycheck. And I'm like, no, dude, it's not guaranteed. You remember? It's gambling. So now I'm convincing people, because now I'm actually convincing people it's gambling, just so they leave me alone, because they don't ask me questions and stuff, which is a true story.
So one thing which I can't ignore, which you said, we can't skip over this. You said you were pretty much making money each and every day. Like, to some people, that just seems so unrealistic as a trader to make money every day. Like, how were you doing that? Like, how were you able to make money pretty much every day? So
this is what I learned a long time ago. So when I first started trading, I was trading everything. Penny stocks, $100 stocks, all sorts of stuff. Anything that moved, right? Then I realized, dude, man, I don't know what the fuck I was doing. I would make money, lose money, but the thing is, I was never proficient or the master of any one little thing. So I realized you have to pick one little area and become the master of it. So I like to call it like finding your niche. So that's kind of like my saying I've been saying for a long time now. You got to find your niche. It may not be pretty or popular, but you know what? You're going to become the master of that one little area and be successful at it. So what I did was I became a bulletin board penny stock. So that was my niche. People would make fun of me and say, oh, you're not trading IBM. You're trading what? This weird ass stock for 2 cents, 10 cents? So I have friends that used to do prop trading back then. They would trade $100 stocks, GM stocks, and they would just laugh at me. But they don't know how much I made. They would swing up and down 10,000 a day, 2,000, They were never really consistent, right? But I'm just turning my money every day, and so, but at the end of the year, if you don't have any big losses, it adds up very quickly, And so that was my whole thing. I became, so the thing I like to say is like, it's better to be the master of one than the jack of all trades. All these guys, oh, I know how to do everything. Well, I don't know how to do shit. I only know how to do this one thing, but I do it damn well. You see what I'm saying? So in my opinion, that is the best way to make money trading. Pick one area and you become the master of it. And I happen to pick an area where I don't have to compete with the smart guys. The smart guys are not trading these little stocks. They're trading freaking IBM. These analysts on Wall Street, Goldman Sachs is not trading me. They're fighting Amazon. Why the hell am I going to compete with them and Amazon? You see what I'm saying? So I picked an area where I was like, okay, only a bunch of dumbasses. So I'm competing with dumbasses. I'm not competing with the infinite resources of Goldman Sachs. And so that's why I became successful. I picked an area where not many people traded, and back then it had a lot of liquidity, man. And so I just kept my mouth shut and just worked in my little niche.
Yeah, so I think this might be an interesting point, is you said there that you're not competing with Goldman Sachs on these trades that you're entering into. You're competing with, as you called them, dumbasses. So what difference does it make, though?
It's because no one's really going to overpay for a $100 Amazon stock. You got big funds pushing it down. So for those type of stocks, the price imbalance is not going to be much. In order for you so this is how trading works, right? You take advantage of the price fluctuations. So if a stock is priced too perfectly, it's not going to fluctuate up and down much. And the people that's going to control that stock are the guys with the big heavy pockets, the funds. And so, whereas if you trade the little stocks, which I used to do, now the SEC kind of shut it down, so it's a kind of dead market now. But so I became the Goldman Sachs of the little stocks. You see what I'm saying? So I can muscle stuff around. I'm not the guys at home who have a full-time job anymore who, this stock is up 25, 50%. Oh shit, it must be keep going up. So they're going to load up on that stock, go to work, and come home and check their account. You see what I'm saying? And so a lot of times if a stock is up 100%, they're like, oh my God, I'm going to hold it for life. This thing is going to make me rich. And so during the day, the stock tanks. They're not there. They're not selling it. You see what I'm saying? There are no algorithms for them. But Amazon, those guys are there all day long, dude.
So what you're saying is that a lot of the patterns and the market behavior was a lot more predictable and easier for you to read and anticipate, essentially.
That's exactly right.
Got it.
It was you pick the most simple area to do, and you just kind of like, and it's unregulated kind of deal. No one's looking at that little shady little area, right?
So the point you're making here about finding your niche and kind of dominating it, how would you suggest other traders think about deciding on their niche?
The thing with me is you have to do it. And then I realized, shit, man, I'm losing my money on all these stocks. And so I got to eliminate trading these stocks. What am I making money on and what am I losing money on? Everyone's different. You can be the master of trading Amazon. I'm not saying don't trade Amazon. For me, it didn't work for me. I have a lot of friends that trade that stuff perfectly. But for me, I couldn't do it. You see what I'm saying? There's certain stocks I couldn't do. But there's certain stocks I excel at. Some people are like, I can't touch penny stocks. I get killed. And so it's not for them. So you have to basically go back to your trades and examine which ones you win and which ones you lose. And I was like, dude, I kept losing it when I'm trading like Amazon. So that just cut it off altogether. I don't even need to bring up the symbol. So basically review your trade. It's very simple. If you go to the casino and you make all your money playing blackjack and you lose all your money playing roulette, stop playing roulette, dude. Unless it's for fun, right?
Exactly.
This is going to be an extremely busy month. I have to watch 104 soccer games, follow the pregame, the postgame, yell useless opinions at the TV. It's a lot. So I knew that when it comes to screening for colon cancer, the choice was clear. The Cologuard Plus test. It can be used at home and can only take 15 minutes, so I can do it during halftime and not miss any action. If you are 45 or older and at average risk, ask your healthcare provider about screening for colon cancer with the Cologuard test. You can also request a prescription at Cologuard.com.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
It sounds like once you went full-time, a lot of it sounds like you almost had it too smooth in some ways. Like you were making money pretty much every day.
That was the negative. So let me tell you the negative and the positive of that.
Yeah, well, that's what I want to get to is like, what challenges did you have? Like, what were some of those greatest challenges you encountered?
You remember when I said when you're too complacent, shit goes to hell and all that? So it was very predictable for me to make my little small money because I never took a chance. I was like, why rock the boat? I'm happy doing what I'm doing. It's working. But the things I realized, you know what, man? Things like this don't last forever. You find a little niche and you take advantage of it. Like you milk the cow. Eventually, the cow's gonna die. So what you need to do is milk the cow for as much milk as it can before the cow dies. And so my problem, I thought, the cow's gonna live forever. So I kept on milking a little bit, and then And then towards the end, I realized, oh shit, man, I'm making money every single day trading super tiny size relatively, right? So once I started upping my size, then it's like, oh crap, the same strategy did work. But by then, everybody else caught on. Everyone started trading it. And then the Wolf of Wall Street movie came out. And the SEC started banning all these stocks, halting all these stocks. They're saying it's a scam. Then they started, then the market makers saw that I was making too much money and they were losing money from me because I would like kill them in a trade and then they would shut me down. So then at the end of my career, what happened was this. I got shut down from most of the routes. They wouldn't let me trade anymore. And the SEC shut down pretty much all of those kind of plays. Those bulletin boards started to come back now, but for a good 2 years, from like 2 to 3 years, it was dead, man. They shut everything. Wolf of Wall Street made it very popular, that movie. So they thought everything was a scam, and so they shut everything down.
What do you mean by the market makers shut you down and banned you from routing to certain venues? What's that about?
So when you trade these bulletin board stocks, these penny stocks, you have to route it to, let's say, a night capital markets or a Schwab or something. So it's not like how it is in NASDAQ. NASDAQ, you have an ECN, which is an electronic system. Over there, you have to route it to a market maker, like NITE, N-I-T-E. And so there's no way to go around them. If you want to fill the stock, you have to route to them. And when they really, at the end of the month, they realize their P&L is down, and they're like, who the hell is banging me for this? And so I got shut down. And so, which leads me to this, the biggest trade of my life, which I guess a lot of people like, I guess my claim to fame. I don't know what the word, but this was not what I think is my claim to fame. But so it was Fannie Mae, FNMA. That one day I made 1.5 million in like 4 hours. So after that, the market makers shut me down. I killed Citadel. I raped all their. So basically, in order to get this, I had to basically play against them. So they would show huge sizes, like hundreds of thousands of shares. I would just sweep them all, and they're like, so now they're dead. So basically, so my whole career culminated to this one day, May 29, 2013. Where I decimated the market makers. And the very next day, all the algos disappeared from that stock. And then I got banned. They shut my accounts down. And so that was the beginning of pretty much the end of the penny stock era.
How did you know you were banned? Did they just actually close your account, or did they send you a letter? Like, what happened?
They called my broker and they said, you better shut him down before we shut the entire firm down.
And are there any legal, like how does that stack up legally?
See, that's what screwed up, man. This whole, you cannot fight a $1 billion company. If they want to shut you down, they shut you down. What are we going to do? They claim that they reserve the right to do business with anybody they want. And so they say they don't have to even give you a reason why. They never gave me a reason why. They just shut me down.
Right.
So one day I woke up and every single broker said, they shut you down, dude.
So you obviously got to keep your profits.
Oh, yeah. I just was not allowed to trade anymore. And so that led to another thing. So I never thought this stuff would end. And so I really never thought about what would happen if this thing was over. And so the biggest day of my life, my career-wise, should have been the happiest day. But in essence, I look back, and I already told my friend. I told Nate, he runs Investors Live. He told me, dude, this is the worst day of your life. I go, I know, man. I go, you would never hit this high ever again. And so after that day, the whole thing unraveled. And then and I had to find a new niche to trade. So imagine, I've been doing this since I started trading. This niche, right? And now it's like the niche has been taken away from me. They shut the whole thing down, right? So then I had to transition to now NASDAQ stuff. And so that's but let's go back to people think this was my biggest achievement. I don't think so. My biggest achievement, in my opinion, is being consistent all those years. It's not even talking about the money. I could care less about how much money it was. It was just basically being able to every day perfect a system where, dude, man, it's like a 90% success rate. I'll give you an example. My best year, I only had 8 days, something like that, 7 to 10 days out of 330 days of trading. Only 7 to 10 days where I actually had a loss. I was like 320 wins, 10 losses days. I mean, so that to me is like proves that it is not gambling if you are disciplined enough and stick to your game plan. So I had that niche mastered. Oh yeah, and then that day they took it away. So.
Okay, so a couple things. 90% success rate. When you say a 90% success rate, you're talking about like your P&L at the end of the day, right? Not your actual strategy. Like not every trade you put on.
Yeah. So I mean, I hate talking about success rate, win rate, but I track it like how many days. Yeah, you're right. It's not. Yeah, I mean, I made tons of trades. I made like 500 trades a day. I made like 1 million trades during that time. So, but at the end of the day, as long as your P&L's up.
So when you made $1.5 million in a single trading day, what did that feel like before you got shut down, before you realized you'd been shut down? What did it feel like that night?
So this is how you get to that point. I didn't even freaking know I was up that much. So I was so into the trade, I didn't even look at the P&L. And then when I turned over and I looked at P&L, I almost shit myself. and when I looked at it, that's when I started to bail. Maybe I would have made more if I didn't look at it. So the thing is, like, when you get into your groove, it's not, for me, like I told people, don't believe it. It's not the money, man. If you're passionate about what you're doing, I care less, If you're passionate and you're good about it, the money will come. Don't think about the money. Think about mastering your process, your niche, your work, your passion. You master your passion, and then the rewards will come. For me, trading I never thought I was going to make money. What the hell I need money? I mean, I'm a very simple guy. If you look at me, I don't, this was just my going back to the kid. Remember when he said, one day I'm going to be your boss and say, screw you. All you bullies are going to regret bullying us. So my whole lesson was kind of like, you know what, man, I was trying to prove to the world I had a chip on my shoulder, and then that's what led me to always try to be the best at what I did.
Yeah. Now you talk about like needing to really love doing what you're doing and have a actual passion for the market. I mean, why do you feel as though you have a passion for trading? Like, what gets you excited about trading if it's not just for the money?
In the beginning, it was gambling, and gambling for Asians is very exciting. Things in our blood, dude. For an Asian tradition is this, dude. Asian New Year comes, the whole family gambles. The first thing you do is you gamble. When you wake up, that's what you do on Chinese New Year. It's to gamble. That's the funniest shit. So gambling is part of our whole culture. But I was never a big gambler. I mean, this is how so when I was making a shitload of money, I would go to the casino and I would never bet more than $25 or $100 on a single blackjack hand. I mean, this is how I am. I was like, why would I gamble when I trade for a living? It's stupid it's stupid to be the chump at the table versus being the house when you trade, So that was so that kept me out a lot of trouble when cause my mentality was never like to gamble blindly, but the excitement of trading is just, it's the same thing as when people gamble, but the difference is this is a calculated gambling. I could bet anytime I want. Not when I'm betting a big hand of blackjack and shit, I have 16. What the hell am I going to do? There's absolutely no control.
Yeah. I think a lot of people who are on the outside of trading have a hard time getting their head around that kind of concept, that a lot of traders actually don't enjoy going to the casino and gambling. You know what I mean? Because they feel as though they genuinely don't have an edge unless they have a strategy down pat. You know what I mean?
Dude, I to this day, I go to Vegas, I don't even gamble. It just freaks me out, dude. I hate that.
Yeah. I went to Vegas for the first time, I think 2 years ago. And I think I spent about $50 gambling the whole 5 nights I was there. And I don't know if that makes me really strange, but I didn't see the point in it.
Did it make you scared? For me, it scares the shit out of me, man. It's just because I'm a control freak, man. It's not the money. It's just the fact that, fuck, I'm so stupid. It's like, this dude just took my money and I have no choice but to give it to him.
Yeah. You're like, oh, man, I could have spent that on so many better things.
Yeah, so
maybe walk us through what happened after you got shut down. I mean, you had to kind of reinvent yourself in some ways. How did you go about that?
So life is full of adversity. So that's the whole theme of this interview. I'm trying to stress, you know what, man? If I can do it, anybody can do it. It has nothing to do with being anything except, like, you know what, man? Have trust in yourself, have a plan, not be a good person. You know, don't cheat, don't steal, don't do any of that shit. You know, just work your ass off. People beat you up like they did me. It's okay. You are always going to have adversity, regardless of how rich or powerful or experienced you are. So now, once again, I thought I had the whole world in my hand. I mastered this niche. I'm like, damn, I'm going to be filthy rich. This is, you know, like my biggest year would be like 3.3 million. You know, that's crazy doing this shit, right? So that's sort of shit. So I was like doing like 7 figures for a long, you know. So it got to the grand scale where, dude, man, if I could do 3 million a year for fucking 10 years, I'm fucking filthy rich, right? Boom, SEC comes, shut the whole industry down. So now I'm like, holy crap, I've just reached the pinnacle of my career, and they just took everything away from me. So now I have to start over as a newbie. So now I have to reinvent myself, figure out a new niche. So now I started trading NASDAQ stuff. And it's a whole different ballgame, man. I was like, fuck. You know, I used to be the Goldman Sachs of the bulletin board. I'd never lost big trades. Boom. When I started over there, I started taking freaking $100,000 losses. I've never taken that much loss before. My biggest loss trading penny stocks was $300,000. But that was because I was up 3 million that year, so I didn't give a fuck. But which is stupid, but you know. But besides that, I'd never taken these crazy losses like 100 grand. My biggest loss would be like 25 grand, 50 grand. I mean, and compared to how much I was making, that was like nothing, you know. I have months where I was making like $1 million in a month, you know. But anyway, so when I switched over, now I'm like a newbie, dude. Every niche, every different thing you do, you're no longer the master of it. It's like, yeah, I understand the basics of it, but shit, man, in order to know it inside and out and to be able to make money on a consistent basis, you can't just be a jack of all trades, right? You gotta be like, you gotta pick something, a discipline, and do it. So I sent you that spreadsheet where it shows like this loss on Lake, L-A-K-E, for $126,000. I mean, so when I switched over, those are the type of losses I was seeing. So now it humbled me hella fast. It was like, I was like, oh shit, what the hell am I going to do? I'm not fucking good like I thought I was. I came over and I thought, hey, I'm gonna freaking be the best NASDAQ trader in the world too. Nope. Rude awakening. So I had to pretty much humble myself, start over, take money out of the accounts, and just make sure I don't fucking blow up. Start with very small positions. And so this is the same thing. You have to build your experience and your confidence. So my confidence was whacked down to nothing. Remember, I came from like a $3 million year to like making like nothing. Just starting over, you know? And which is, in essence, is good. Making nothing is better than losing 3 million. You see what I'm saying? So a lot of people like, oh, this is easy. I can switch and do something. You know, I used to be the king of this. I'm going to be king of that. No, dude. You see what I'm saying? You have to be able to humble yourself and say, you know what, man, I am now an amateur once again. I'm a student.
So how did you move on from that point? Like you said, you came over to NASDAQ stocks. You started taking these really big hits, like $100,000 plus losses. I mean, what was the cause for that? Were you too cocky? Did you just think your same strategy was going to work in a different market that moves in different ways? You know, what was the root of that?
Because back in the bulletin board days, there was not enough liquidity to get into $1 million of a stock. So to lose like $126,000, I was in like $1 million of that stock. You see what I'm saying? And so basically it's just like, holy crap, I threw the kitchen sink at it and that thing won't budge.
So how did you go about finding a new way of trading? Like, what did you do? Like, because you said, you're now essentially an amateur all over again. How did you develop a new strategy to profit in this new market?
So, you know what? In my opinion, I am still learning. I never wanted to teach when I was trading bulletin boards, just like I don't want to ever teach now, because I never think I'm a master. I think the moment you think you're a master is when you get dinged, dude. To me, people go, teach me. I'm like, dude, I'm still learning. Same thing was when I was making millions a year. I was like, I'm still learning, dude. And so the caveat is I would always be a student. I would be a student for life. But what I'm doing now is I'm starting over. So now I'm thinking, how did I become so good at trading the penny stocks? So I'm trying to get back into that mindset where, I start back doing smaller trades and figure out, trying to find my niche within this new market. Because still, when you say, how did I find my niche? I think I found my niche, but who knows? It's still too soon. The only way I'll know is in another 10 years when I look back, right? Because when you're in it, you really don't know. And so I'm always trying to learn, in my opinion. That's the best way to do it. It's like you stay on your toes and you always try to learn. So I examine what I'm doing wrong. So now I cut off a lot of stuff. I used to trade a lot of ETFs, and I got burned on a lot of stuff. So now I cut them all off. So it's the same process as before. You find out what the only way to know is to do it. And unfortunately, it's a cost of tuition. I lose these dollars. And you can either think of it as two ways. Think of it as, I got unlucky and I lost $100,000. Or for me, it's more of like, dude, that was $100,000 lesson. That was tuition. And I better make damn sure that I got my money's worth from that education, right?
Yeah. It's an expensive price to pay. So how do you... I think what might be cool if we could talk about is maybe sort of the psychology and a bit more about the mental aspect of trading. Like, how do you have the confidence to pull the trigger after a bad trade like that?
Yeah, that's the biggest thing. When you're making money, your confidence is off the charts. And you know how it is. When you're confident, you can do no wrong. And then boom, sometimes you get overconfident. There has to be a balance. So when I'm on a crazy streak, I start to get cocky and I go, and I think I could do no wrong. And then that's what happens. So in my opinion, the biggest hurdle for any trader, any experienced trader is you can make money, let's say 100 days in a row. Is that one loss can wipe out your entire year. You see what I'm saying? It doesn't matter how much you made before. It's how to control that one loss. And so that was what I mastered before. I mastered before how to immediately just take the loss and not have it affect me. And so, but when you're a novice once again, every loss you use is kind of like a personal loss. Like, damn, I suck. You see what I'm saying? Sometimes you take it too personal. So you gotta be almost like a robot to like. So I call you have to be like I call trading like a reflex. And this is how algorithms and algos they're robotic, dude. Sometimes you have to be robotic. It has to be like a reflex for you to like, I see the situation. Either I go in or I go out. You don't hesitate. You don't think. You don't. Every time you doubt yourself is when you get screwed up. And so that loss I did, I was like, oh man, I don't want that loss. I could have easily taken like $5,000 or $10,000 loss, which is a lot, but it's better than $130,000. And after a while, you're like, so before that would never happen. But when I started new, I was like cocky. I was like, dude, that's embarrassing. I don't want to take that loss. or like maybe it's tricking me. It must be tricking me. If I take the loss, it's gonna go my way. Nope. So you make all these excuses in your head. And so what happens is, dude, I wasn't ready for that kind of size to trade. So you have to build yourself up, first of all. It's like everybody wants to get to that next level. Getting to that next level doesn't just mean increasing your size, dude. You need to be able to have enough bankroll to be experienced enough to be able to take the hit, things like that, right? And so a lot of traders want to go quickly. And so my advice to them is, dude, your bankroll is huge. In order to get to the next size, you better make sure your bankroll can support that. And then when you lose, like, okay, I'll go back to your question, like, it's the confidence. So what I usually do, which helps me, because I've taken a lot of these losses when I switched over. I've never had so many losses in my entire life of this size until when I switched over. I mean, they're like 6-figure losses, like boom, boom, boom. And I don't know how the hell I didn't lose all my money, but I would make it back. But it's like, but the thing is, like, it just kind of like every loss you make, the confidence level is just multiples higher, like exponential, right? It's not just $100,000 you lose. It's $100,000 to like the factor of 10, how stupid you are, and oh my God, like, what am I gonna do now? I lost my money, stuff like that. So how you rebound? Well, you have to start from basics. So I rebound every time I do that. I would rebound by making one trade at a time. Make $1,000 trade. Make $2,000. You see what I'm saying? So have a couple days of green in a row. So I get back to my old routine. A few days of green in a row, then you start to forget, and you're like, oh no, now you become more confident. Then you can increase your size once again. So it's always getting back to basics. After a big loss, always get back to basics. And after a big win, you better be disciplined enough to also get back to basics. Instead of saying, oh, I have a big win. So the problem with winning, to me, is this. It's very dangerous. I know a lot of people who have a good streak and then they just blow up. It's because they always think, I had a good streak. Oh my God, imagine I put in twice as much money. My streak would have been even more huge, right? So now their next trade, they're like, dude, I'm going to double up the next trade because I was right the last 100 times I did this. And then boom, you're dead. So it's all part of the discipline, right?
Yeah. I'm glad you brought that up because I did want to ask you about like the other end of the spectrum about how you handle, large winners and, when you do get on a good run, how you like don't get ahead of yourself in some ways. So, because I think that's equally as important, right?
Yeah, that's exactly what I said. You got to make sure, because when you get on a streak, like I said, man, the one thing is you become cocky. You're like, shit, I should have put more money in that trade. I knew it would go up. Why didn't I put more money? So what I'm going to do in the next trade, I'm going to do a makeup trade. That's the makeup trade that kills you. I'm going to make up for the fact that I was a pussy and I didn't put more money in that last trade that I won. So now I put double the money in. And you know what happens, right? It always goes down. So I call it the makeup trade, which is equivalent to the revenge trade. So when you're down, you want to double up so that you can make back your money quicker, right? So that's the revenge trade when you're down. So when you're winning, you do the makeup trade because you're like making up for the fact that you're too chicken to put more money in. But a lot of times I tell people this, dude, it's not trading smaller size can actually make you more money because you can hold it longer. You can be more clear-minded and not be freaked out. Because if you're scared, it means you went in too big. It's like if you get shaken out, it means you went too big. So you have to find the right balance of size. Because a lot of times, like if you were smaller, you wouldn't have been shaken out. Because you're like, okay, I'm still with my plan. I'm not going to go broke. But if you size it way too big, any little deviation in your in your price, you're going to get shaken out.
Yeah. So I mean, here we've kind of talked about how to get the confidence after a losing streak and how to keep a level head when you've got a streak of winners as well. What about when you realize that you're just not trading as well as you normally would? You're not trading at your best. You're just sort of maybe out of sync with the market a little bit. Like you just can't get a good gauge on what's going on and you're just not really getting anywhere. How do you deal with that?
Yeah, I mean, I've gone through slumps a lot of times. The only thing you do is scale back your size and stop thinking about how stupid or an idiot or like when I trade, I don't think about anything. I just think about trading. It becomes like a reflex for me. The moment I start thinking about money, how I gotta pay bills, or oh crap, what that loss could have paid. I start doubting myself. When you start second guessing yourself like that is when you're just doomed, dude. Maybe you should just not even trade that day. You see what I'm saying? Yeah. In order to trade comfortably, you have to get your personal life in order. So that's the key thing that listeners should understand too. It's like when your personal life is shit, your trading is gonna be shit.
And when you say personal life, like what sort of things are you talking about? Like your relationship, your job, like?
Exactly. All that stuff. It's like you're fighting with your freaking spouse, your girlfriend, and then you go back and you're pissed off and you're trading. It's going to affect your trade, right? Or when even if like you don't have money. If you don't have money to pay the bill, stop fucking trading. Get your life in order before you trade. Because if you have no money, it's like entering a poker table and you're the shortest stack. You're going to freaking lose. Those sharks are going to kill you, right? So sometimes it's best to like, save up and like come to the battlefield with a gun. It's a minimum of a gun instead of a freaking knife. Some of these guys, they try so hard to trade. They're like, oh, I got $400. What the hell is $400? The commission is like $20 already. You're dead. You see what I'm saying? But it's okay if you understand that that's a tuition you pay to learn. A lot of these guys like, I have $1,000, pal. Let's make me rich. I'm going to turn $1,000 into $1 million. Bullshit. That $1,000 is basically your tuition money, dude. You have to understand that he's going to be learning, right? Don't fall for these furus. I call it. So I coined this term a long time ago. So you hear that around the internet? That's me. I coined it. Furu. F-U-R-U. It's basically a fake guru. So you see all these guys selling shit and selling services. I'm the guru. I'm selling you all this crap. And they're like, oh, I turn $1,000 into $2,000. I'm like, dude, I don't know how real or unreal it is, but that's not realistic. That one guy may be able to do it, but you ain't going to be able to do it,
That's funny. I was waiting for you to bring that up.
Yeah. And so, I mean, it's a basically simple rule of thumb, dude. If you have the secret formula to make gold, why the hell am I going to sell it to you for $100 a month? I had the formula back then for bullion ports. I had the formula to make gold. I knew the formula. I would never sell it for any price. You see what I'm saying? So it's like, don't be conned by these guys. It's like they can't trade, therefore they sell you this crap. And so so I want to say one thing. I tweeted something right before this thing. Because they're asking like, oh, who are these life coaches? Oh, this guy's a life coach. He teaches people to be successful. I go on his page and he talks about how I used to be broke. Now I'm successful. So I tweeted, I said, reminder to myself, if I ever become broke, I will sell a course on how to become successful rich. That's pretty much what they do. It's like, I'm poor, so I'm going to sell. So I tell these students, like, don't fall for that stuff, man. So I created a site called the Trading Fish. It's M Rock Rules on Twitter, and pretty much I have like tons of tweets, and it was my way to give back on teaching people the basics of trading and how to be there. So M Rock Rules. So basically people say what maybe one day I'll do a course, but I'd rather do it for free for now. If I ever win the lottery, I would definitely do it for free for everybody.
For sure. And that's I definitely suggest anyone listening to this podcast right now to actually follow, what is it? At MRock Rules, and the rules is with a Z, right?
Yes, with a Z. But it's on my page. It's on my all the information is on my Twitter page, _rock. So I have that part.
Yeah. A lot of good info. Now, just while we're still talking about psychology here, I know a big issue for a lot of traders is FOMO, fear of missing out. How do you suggest others try and combat this fear of missing out?
Don't worry, I still have that same exact problem. You never have the same problem. The fear of missing out. It stems from greed and envy. Because I'm like, oh shit, man, I don't want to miss out because my friend's gonna make hella money. And then you just look at your friend. You see what I'm saying? So all these questions are all personality questions. So like I tell people, trading. Only a small part of trading is mechanics. I can teach anybody the mechanics of clicking the buy button, the sell button. But the problem you have later on is the mental aspect. When people blow up, it's never because they don't know how to trade. It's because they broke a rule. They know they should not be adding to losers to infinity. They know that they just got to take the loss, or they know that they shouldn't be entering something early because of FOMO. So it's a lapse in discipline, and so it's a mental thing. So when people ask these questions, the only person that can answer is yourself. It's like, why are you entering it early? Because of what reason? So for me, I have a lot of problem where. So for me, an example would be like, oh man, it just sucks if I hear my friend or whoever make all this money and I didn't make it, and I like, damn it, man, I must suck. There's two ways I can look at it. Like, damn, I'm an idiot, or I'm smarter than this guy. How the hell he make more money than me? And so that's where all these problems come in. So then the next trade, I'm going to double up on my size, and then boom, you get hit. Or I'm going to make sure I don't miss this trade. And then that's the fear of missing out, and you enter early and get crushed. So, see, it's all psychology. So shut everything out. So sometimes it's better not to fucking even go on to Twitter, to go online. Don't talk to friends. Just concentrate on yourself. Don't need to ask people how much they make, because that's only going to affect your brain too. Be happy with making what you're making. So imagine you're happy making $100 a day. You hear your friends making $500 a day. That's going to really screw your brain up, and it'll throw your game off too, you know? And so a lot of times it's like, dude, man, turn everything off. Just focus on yourself. And back when I started, it was really helpful because they didn't have Twitter, didn't have anything like this. And so I think that was another reason why I was successful. I was just basically in my own element, in my own zone, and not have to worry about how much people are making or competing or talking crap about you. You see what I'm saying?
Were there any other traders who you did speak with frequently, though, when you were coming up as a trader?
So I had a really good system. So I needed to teach someone a system. So I don't want to really throw his name out or anything, but he did quite well. He made millions of dollars. So my system did work.
What do you mean by he made a system or you made a system?
Well, I had a very good system of I figured out a certain pattern. You know, after a while, so that's how I made money every single day. So basically, I became very good at that one niche, right? And so I needed someone to help me find those stocks. So there's a certain criteria of stocks, certain pattern to look for when you scan. So I've mastered. Back then I could look at a stock and tell you with like 85% certainty if it's going to go up or down, based upon like certain criteria. And so I showed someone how to do this, and so they found the stocks. So the more stocks you find, the more you can make, right? And so I used to I would hold like 10 positions overnight. And each one would make me a bunch of money, and it adds up, right? I don't need to make much. You hold 10 positions overnight. Each position makes $500. That's $5,000 just off the bat. 5,000 every single day, multiply 300 days. That's $1 million right there, right? Without having to trade.
Okay, so there was no one when you were still kind of learning the ropes on how to, find your way as a trader. There was no one who you were kind of who you could speak to and ask for help and that sort of thing?
I started so long ago. There were none of this stuff. So when I first started, there was this guy, Stock Gappers. And so it was in New York. He used to be my friend. And so he ran a chat room. So that's how I got into it. He was doing it. So I started doing it. And so I guess, we haven't really talked for a long time. But so that was the one person that started this whole thing. But he kind of disappeared. And but really, no. There was no Twitter back then. There's no nothing, dude. So it was just I just did it myself. There's a lot of people that I helped, like Nate. I've known him since he was like 19. There's a bunch of people in his chat room. I was like the oldest guy though, so I started all this stuff a long time ago.
Sure. So I think what might be really beneficial for people who are listening to this podcast is if we can kind of, I guess, summarize some of what we've been talking about and kind of bring it all together and really drill down into the trader development side of things. So, if you had to start all over again, how would you do it? Like, with hindsight on your side, what steps would you take? Like, think about someone who might be listening to this podcast that's been keen on trading for 6 months, 12 months, 2 years, whatever. They're still in that, I guess, what you could classify as the beginner stage. Where do they go?
The number one thing you should study is charts. Go to like stockcharts.com or something. There's a bunch of like online reading how to read a chart stock, learning resistance, all that. To me, charting is the number one tool when you start out. If you know resistance and support and can draw a trend line, half of your problems are over. So that's number one. Number two is determining what stocks to trade. That's half of the easy part of trading there. It's like there's a bunch of different stocks you can trade. It's like, why choose one over the other? So learning what I can't really help. The only through experience you can figure it out, like which stocks you should avoid, and like choppy stocks with no trend should avoid. I outline a lot of this stuff on my free tip MROC rules as well. But basically, so there's two things, right? You have to learn to chart, dude. Figure out. So you have to learn how to do a scan. There's a bunch of free scans online you can look. And so based upon that, you can look up the chart and see which stocks are smooth to trade and which one's just choppy and will fake you out. People worry too much about level 2 and all that stuff. It's like over time you'll figure it out. But charting is the most important thing. Learn and read a chart. Don't look at level 2 when you start out. For bulletin boards, level 2 is very important. For NASDAQ, it's not as important. Charting is more important. Together, you need both. But if you start out charting, and basically have some rules you print out, you don't break. Rules are very important when you start out. It helps you from blowing up. So I provide a lot of these rules on my free tip site too. And knowing the right broker to use, because it sucks now because now there's a pattern day trading rule. You have to have 25,000 a day trade. My suggestion is, if you don't have that, is to split up your money. I don't know how much money you have. Let's say you have $5,000. Instead of putting it into one account, you can put it into 2 accounts, and so you have twice as many trades a week, right? Another thing would be, until you get to over 25 grand, it's very hard to make money, man, because the fees will just kill you. The moment you make over 25 or get 50 grand in your account, you can open up brokerages where the fees are pretty much free. Like I get rebated for ECNs. Like every time I put an order out for ARCA, I get rebated. So basically, if I get rebated, it's free. They pay me to trade. And then the commissions, so it offsets commissions. So basically, in theory, I can trade for free. Whereas if you have a small account, it'll just nickel and dime you, dude, to death. And then all the money you make is just going to be paying commission and stuff. But like I said, when you start out with that small account, you have to remember it's tuition. And so my suggestion, just like I did when I started out trading, I didn't jump in, dude. I worked my ass off. I went to get a job. I saved. So these guys that want to get started, nah, dude, you have to put in a lot of work before you even get to the point where you can open an account and be serious. So basically, get your life in order. If you don't have a savings, why the hell are you trading, dude? You can learn. Nothing wrong with learning. But get your life in order before you can do this. Like have some savings. You see what I'm saying? Stuff like that. So because that teaches you responsibility. Versus if you have nothing going for yourself in your life and all you have is this trading account, you're going to treat it as gambling because you have nothing to lose. YOLO. You see what I'm saying? And so my advice to everybody is like, dude, go to school. I worked and traded at the same time. I had a job, so you basically got to get your life in order, because I guarantee you don't have your life in order, your trading is going to go down the tubes.
Now, I think this kind of leads on from that point, and I think this is something that a lot of traders maybe struggle to get their head around and think about, and there might be a bit of a disconnect in some ways as well. How would you categorize the major milestones or stages between being a new trader and the level someone like yourself is playing at, like, someone who's made millions of dollars trading? What are the milestones to get to that level? Like, what are the different stages?
So that's a very good question. So the first milestone is to understand all the terminology of trading. What is a buy order? What's a sell order? We laugh at that, but when I figured it all out, I was like, oh, crap, that's a big milestone for me. Another milestone would be charting. Oh, I know, I can see a resistance line and a support line. So that's a very good point. It's like education, any formal education, you need to have milestones and mini goals. Don't just say, I want to learn a trade. Well, that's like a million steps between there, right? And so put yourself milestones like today, I'm going to learn how to learn support graphs. What's a resistance line? You see that? So charting and all that terminology, and then learning my platform. So I'm an engineer, so like whenever I get a new platform, I customize it, I tweak it. I know every single thing about it. And so that's another milestone. So comfortable I can do anything as a Flash. You know, some people just, all I know is buy and sell. No, you need to go and play around with every single button, because that'll teach you like all the stuff about stocks. And the next milestone would be getting, if you're not a pattern day trader, get over a pattern day trader. And for me, a good gauge is this. I created an Excel calendar where every day I would put in my P&L. And green is up, red is down. And so every day, make yourself accountable. Put it in. So your goal would be, I'm going to try to get through this week without a single lost day. You see what I'm saying? So that was how I started doing the green challenge streak I had. And so after that's why I was like, dude, I hated when I was down. So I made sure I would close at the end of the day up all the time. So just being conscious of that and gave myself a goal. I was like, oh my God, I had 5 days in a row of being green. You know, that's a big accomplishment for some people, you know, for a lot of people. So maybe that's something they can try to do. Because once they get consistency, that's the ultimate goal of a day trader. It's not how much money you make, dude. It's being consistent. If you're consistent, you are making money. You know, it's not, my goal is to make $1 million. Nah, dude. Your goal is to be able to have 5 winning days in a row, and the next day you lose, you only lose a day or two of work, or not even a day or two. You see what I'm saying? It's not going to wipe out a year of your gains. So basically, the ultimate goal is to be consistent.
Yeah, I like how you highlight consistency as being something that's like just extremely important. What tips and pointers do you have for someone to try and gain that consistency? Like, is there any key ingredients to that?
Once again, it's your discipline and your rules. Print it out, stick it up somewhere. I bow this all the time. I know I shouldn't be adding to a loser over and over, but you know. And then so I implement a bunch of different things. One thing would be if you're up for a day, just eat the loss and not turn a winning day into a losing day. That could be one of your rules you can have. You see what I'm saying? And then just walk away before you lose it all. Another one could be max loss. Like if I have $5,000, $10,000 day loss, don't trade anymore. So you have to. Everybody's different. You have to know your own. Like for me, I break all sorts of rules because I was able to get away with it in the past. Which is also the problem when I transitioned to a new niche. You see what I'm saying? That's why I blew up like that, right? So you have to have some sort of rules. So it's like if I taken my own advice, like I would have a hard stop at losing 20 grand. I would be losing $120,000 that one day. I would calm down, you know. And so you know yourself, and so you have to place upon yourself these disciplines.
Yeah. Now, this is a question I ask quite frequently, as listeners will be well aware of. And I do like to ask this question, so I'm really keen to hear how you answer it. Why do you believe most traders never succeed?
Because they treat it as gambling. There's a couple of things. One is they think it's gambling. YOLO. They have no plan, no system. The stock is up 100%. Why aren't you taking some off, dude? You see what I'm saying? YOLO. Another thing is lack of preparation, lack of... So there's this whole reason I told you about the backstory and all this stuff. Because it's very important. You have to be a responsible person, first of all. You have to be real. You have to be respectful of money. If you treat this as gambling, you're not very respectful of your money, and you're gonna lose your money. Discipline. A lot of this, once again, comes from personality. See, it all is in your person. It's not mechanics. Not because you're stupid. You can be stupid and make a killing in this industry. it's whoever has the most discipline and can stick to their game plan is the one that's going to be successful.
No, that's really good. Well, let's start to wind things down here. Just a couple questions I'd like to ask you. I guess this one's kind of outside of trading. Is there anything you do outside of trading to, grow your wealth, or that you have interest in? Anything else you do? Like, do you do any longer term investing? Do you do real estate? What is there anything which you're involved in besides trading?
Yeah, that reminds me of something very important as a trader in general, and as also someone up and coming. Get a network of friends that are traders. Get some that are mentors that are above, and more importantly, get some that's on your level, so you can discuss that's how things are going. Have a trading partner, have a trading buddy. I feel that is going to speed up your success, because if you have a buddy who's on your same level or whatever, both of you guys can work together to learn. Okay, but anyways, but yeah, outside of it, in my opinion, trading, dude, man, trading is the hardest freaking industry in the world, because that's the only job I could work for a freaking entire day, and not only do I not make money, I have to give someone money. Even guys like McDonald's will make more money. Even sleeping in will make money a lot of times, right? And so when you have it, you got to save it. So real estate is the best place to put your money, in my opinion. Rent. I don't really want to talk about this stuff, but rental incomes would be like the best thing to do. Okay. But the more thing is save your money.
All right, Bao. Well, are there any final words of wisdom which you would like to leave us with? Is there anything you'd like to add or into what we've already discussed? Take the mic.
Slow and steady wins the race. Slow and steady. Consistency is the number one thing. Don't get ahead of yourself. Know yourself. Discipline is the main thing. Don't compare yourself with others. That's the worst thing you do. You can see someone with a nice car, and it's passion. You have to make sure you want this for the right reasons. My passion was never about doing this to be rich, get a nice car, stuff like that. If you're doing that, dude, there's so many other things you can do to make money like this without jeopardizing your fortune. Otherwise, you're going to lose. So be passionate. Passion is the number one thing. And be passionate for the right reasons, okay? For me, it was helping my family. Things like that, not just having fancy cars. And I think if you do that, karma will reward yourself, and you work harder. You have a main driving reason. Because if your only passion is to have a nice car, and when things get tough, you're like, oh, screw it. I don't need that nice car. I'm cool with my Honda. You see what I'm saying? Versus, I have to do this because my family's depending on me. You see what I'm saying? There's a big difference. You cannot quit when your family's depending on you, but you can quit when your Honda is just good enough for you.
I truly appreciate you coming on, man. This has been a lot of fun. Yeah, thank you very much.
Awesome, dude. Thanks, Aaron.
You've reached the end of this episode of Chat with Traders, but rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast on iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Evening. Buyer's remorse. Buy a new car? I'll be moving in. Let's get started.
Sorry, I think there's been a mistake. I bought it from Carvana.
You what?
Yeah, great price. I even have 7 days to love it or return it.
So there's no...
No buyer's remorse. More like buyer's rejoice.
I guess I'll let myself out. Congratulations. I mean it.
Buyer's rejoice. Buy your car today on Carvana.
Limitations and exclusions may apply. See our 7-day return policy at Carvana.com.
Chat with Traders, collaboration with Quantopian, episode 2. Hey, what's up, folks? Welcome to the second